get started. As everyone should know, this is the November 20th, 2014 meeting of the Retirement System Investment Commission, and we will now get underway and call the meeting to order. And we will start with the consent agenda, adoption of the proposed agenda.
Just need a motion for that.
I have a motion to do that. Second?
Second.
Second. All in
Yes.
favor? Aye. The agenda is adopted. Secondly, we'll go on to item 2. First item is the executive staff planning stage.
That's your report, yes, sir.
And as I understand it,
Yes, sir. Mr. Chairman, is that this portion of the agenda is really relating to my executive planning stage. So you will, I believe that the documents, the necessary documents related to my EPMS planning have been posted for your review and comment. And if there are any comments, that if you could, I believe, just direct those to Mr. Farmer. Mr. Farmer. Yeah, he'll but that's that was really just more of an information purposes to let the commission know that my documents have been posted and that has been initiated. So.
okay, any questions? If not, we'll move on to the next item, which is the committee composition. As you remember, at the last meeting, we had some discussion on committee assignments, and we asked that if there were any requests for committee assignments that we be so informed. We did not receive any. The one change that I would like to make is that I would remove myself from the HR committee and replace myself with Mr. Reynolds, and and I think that is the only change so far. Now, I think, Mr. Gillespie, you had some comments you wanted to make?
Yeah, I was going to just pass out a letter for consideration. These are kind of longer term, just related to committee operations, really kind of two. I understand that Peggy's busy, but ultimately I think, HR, we got to give some consideration to the person who's local, right, over at PEBA eventually. So, I mean, that would just be, I think, for consideration, just trying to anticipate future HR things. I think having the local person might be beneficial. Second thing would be to make sure the vice chair over time at least is strongly encouraged to attend all the committee committee meetings so that they're familiar with all the operations by the time they rotate into the chair. So, but I did put those in writing for everybody's just kind of future consideration as it relates to committee. So.
All right, why don't we
if
look at those, and then we
just
can
pass them
take
out.
those up? Sure,
Yeah.
take them up in February.
I can help you get that.
Yeah.
She down there or no? Okay, thank you. Okay.
All right, next item on the agenda.
We just need to ratify your.
I'm sorry.
To ratify your.
I'm told we need to have a ratification of the change in the committee composition. So is there any comment or any discussion? If not, may I have a show of hands? All in favor? Aye. Any opposed? None?
Is the treasurer?
Mr. Treasurer, are you on with us now?
Yes, I am. I'm sorry I'm late. I was in the conference call center, but it, some reason didn't connect me, and I'm working now to disable those noises. Sorry about that.
All right, so,
I don't know how, you want to know how we voted on it?
Yeah. Do you,
did you, were you on when we voted to ratify the committee composition, Mr. Treasurer?
I'll vote no.
Vote no, all right,
I think I know how that ended up, so I'll vote no.
all right,
Thank you, sir.
all right, okay. Next item is item 3, is the audit committee report.
Yes, the audit committee met. I mean, it's relatively brief. I mean, the big item, obviously, we have the job search ongoing for the ERM, compliance and ERM position. Related to that, did have a call with Rick Funston. How does he say his last name? Funston. He had some, I think, good things for us to keep in mind as we go through, finding the right person for that position. Other than that, that's it from the audit committee.
Any questions for Mr. Gillespie?
Oh, I guess one other item. We did review, the audit committee is responsible for reviewing Monica and Andrew's position. So we did complete their job review stuff with John Farmer and discuss, personnel that were responsible for reviewing as well. So.
And planning for next year. And the planning portion.
Huh?
You did the planning portion, the EPMS planning.
Oh, yeah, and the EPS planning portion. I guess I should mention one other thing that got discussed at the last audit committee. Budget obviously is tight because of the way the budget approval. And audit committee, when it lays out its audit plan for the year, also lays out its budget. And previously, I think that had been done back in July or June. So we are sort of potentially revising the audit plan in light of budgetary constraints.
Anything else? If not, we'll now move on to item 4, the executive director's report.
Thank you, Mr. Chairman. The first thing I would like to cover, you'll see in front of you at your places some what I think are some very good looking brochures and issue briefs, and these were put together by our communication staff, really in order to provide some information about the commission, our goals, our investment beliefs, strategy, leadership dynamics, performance, those types of things, and we've been Ms. Orlinda Doherty, who's on our communication staff, has been attending a great many benefit fairs across the state, talking to our beneficiaries. Really, anytime that we engage with our stakeholders, with our beneficiaries, Ms. Doherty's there, and she talks, sets up a table, talks to them, hands out the brochure and the issue brief. It's been very well received. I know that I was at a retiree, a state employees association retiree luncheon last month. Ms. Doherty was there, had our table set up, providing this information, and I said it's been very well received. I think it's really highlights our beneficiaries first attitude that we're establishing, and I think that it's been very successful in getting the message out about not only what we do, but also how well we do it. So, but I wanted to make the commissioners aware of that. Also, the last Monday, to give the commissioners an update as well, the more senior executive staff and I had an off-site planning meeting. We spent the whole day with a broad range of topics related to the organization, discussion topics, everything from culture to communication to compensation, governance, those types of things, taking a very 30,000-foot view of the organization to try to come up with some really good ideas, very much of a brainstorming session. I think it was very successful, very helpful. We got a lot of great ideas, and we're going to try to integrate those ideas throughout the organization. So, but we are taking the time, certainly, which I think is very important, about setting a very positive direction for the organization moving forward. So, but I wanted to make the commission aware of that.
Can we ask a question on that? Just what were maybe like the top 3 items that came out of that?
Probably the culture was. I mean, that was something that we spent a lot of focus on, because I think that that's something that, really establishing a centralized, solid culture across the organization is something that is very important for us. We're talking about engaging staff and helping us develop that, because that's certainly not culture is not a top-down thing. Culture has to develop very organically. So we're really trying to figure out how we go about doing that and establishing culture organically. Really, hopefully, centralizing around maybe 3 very, very short, very core values that we're going to engage the staff in helping us develop that. I would like to think that the first one is the beneficiaries first, which you've seen around the office. Also talking about governance, organizational structure, making sure that we're communicating well across the organization. The establishing a very collaborative organizational structure. Also, but keeping in mind the various functions that we have and the checks and balances that we need to maintain, but in a way that's very positive. So, and probably the third thing is developing working with ideas about working kind of hand in hand with a compensation consultant about establishing not establishing, but making sure that that we're balancing the performance incentive aspect of PIC along with potentially some long-term incentive to really encourage our staff to put down roots in this organization and really buy into the organization and become part of it. So, and also, last but certainly not least, is setting out a clear direction, career path for individual staff members, helping them get to where that they want to be, and also benefiting from that plan, benefiting the organization as well as the individual. So those are very broad, but that's really the focuses of what we were talking about. So.
Just going back to one thing, obviously, we seem to be doing a very good job of communicating with the public employees groups. But I was approached yesterday by a couple of retired municipal policemen in Aiken, and I asked them what they thought about the retirement system and if they were getting information. So they said they really weren't. So I guess my question is, aside from the retired and active state employees, what about the police and fire and these other people in our pension fund what sort of flow of information are we getting to them, or are they getting the same kind of information, or where does that stand? Danny or Peggy, I guess you would be the
Well, if I could take that first. I've met with both police officers, the representatives of the Police Officers Retirement System, the Law Enforcement Officers Association, and in regards to that, last week or this week I met with the teachers. We're going to have a quarterly, coming up in December, we're going to have a quarterly stakeholders meeting where we bring all of those groups in. All of those groups have indicated that they have mechanisms for us to push down information to their members. So we're really going to start engaging with them and doing that and getting that type of information out. So and also extending I probably forgot to tell Peggy this, but also extending the invitation for both Peggy and I to appear at any type of which I did with the teachers this week, is extending the invitation and the opportunity for both Peggy and I to appear at any type of meeting or function that these organizations, our stake organizations have, so that they really get the full range of the retirement picture, so that they get both the benefit side and the investment side. Peggy and I have definitely made that a priority in our outreach. So
we're making that effort.
Yes, sir, and trying to also coordinate that so that there's a coordinated overall retirement message as well. So
good. Well, as long as we can get the message out to all of them.
Yes, sir.
All the various stakeholders.
And Mike and I've also talked about that quarterly stakeholder meeting, making that a joint meeting so that PIVA's not setting up a separate one, and stakeholders feel like they need to divide their time between the two of them. So we've talked, and I think he's talked with Danny about some structure around that.
I think it's important that we have a unified message.
Quarterly stakeholder meeting.
Good. All right. Thank you.
Yes, sir.
Next item is the executive offsite.
But that concludes my report.
Oh, is that okay?
Yes, sir.
Was there? Did you have something to say about the offsite planning meeting?
Yes, sir. I covered both of those. Yes, sir. So
cover it.
we're ready for the CIO's report.
All right. Then the next item is item 5, the CIO's report. Do you have some comments, Herschel?
I do. Thank you, Mr. Chairman. We've got a pretty sizable agenda for investment items today, so I'll have some comments. We'll do our third quarter performance review from staff as well as with Suzanne with HEK. Then we'll cover our investment beliefs, and then we'll have several investment items to go through. But first, as we start, I'd send an email out to the commissioners, and I'd like to take a moment to again congratulate Brian Moore and recognize his promotion to director within the public markets. Brian joined us in 2012, working on private equity under Dave Plowka. And since then, he's actually done a lot of work on hedge funds as well as equities. And you'll remember not long ago, he presented the enhanced equity mandates to the commission. He's done a great job. He has a servant mentality, if you will. So he's really about service, not only here, but also outside of work. He's demonstrated a team spirit as well as leadership skills and capabilities. And so we wanted to recognize Brian for all of his achievements and accomplishments and that promotion. So If you see him here, then walking around, I'm sure he would have. There he is. Thank you, Brian.
Congratulations.
So, well deserved. Also, just an update on, we have 3 open positions we continue to recruit for. So we've, over the past couple of months, have done a lot of interviewing. So having John Farmer here as the Director of HR has been very helpful from a time perspective and communication and feedback to the candidates as well. We're in the process of, I believe, next week, we're anticipating making an offer to a senior private markets person, and we'll continue to search to fill the other 2 positions. So one of the things I wanted to do is just take a quick moment and just reflect on the asset classes and asset class plans on where we're at from, staff presented those asset class plans in June at WAMP, which became part of the strategic plan. And so from a global equity perspective, we continue to make strides and pretty much done with global equity right now, maybe a few tweaks around the edges. So we're in the contract phase now with the 3 enhanced index strategies that were approved a couple of meetings ago, or last meeting. Also with global fixed income, we'll have a discussion today, a little bit about that with some of the proposals there on streamlining those strategies there. Diversified credit, that's an area that we continue to search. Last meeting, I believe, or the meeting prior, we approved Guggenheim for a strategy, and we'll continue to take a look. There's some additional managers we need to add to diversified credit, as well as the private debt component as well. Hedge funds, our current exposure is a little over 12% right now. The plan level maximum is 15%. And you'll remember, starting a little over a year ago, we actually unwound the portable alpha component, which meant we continued to unwind hedge funds and reduce that exposure overall. At one point in time, the plan was at 20% allocation to hedge funds overall. Also, with private markets, as you all are well aware of, that's an area that, with real estate, private equity, and private debt, you have to continually make those commitments in the capital call. So it's not as you put money directly into the market, it has to be called down. So we actually have several recommendations a little bit later today for private equity and real estate. So we'll continue to work those pacing schedules. For real estate, it's approximately about $300 million. And then for private debt and private equity, about $500 to $600 million each. And so we have several more recommendations coming up for private debt and private equity. So from the AIP, some of the key initiatives as it relates to the investment staff would be for Statement of Investment Beliefs. This is also a Funston recommendation. So in June at the WAMP, we presented the first draft. We've come back in the last commission meeting, actually presented the second draft. We've received some comments in which we'll talk about those a little bit later on the agendas for the third draft. But once those are approved, those will become part of the SIOP as well. One of the other initiatives is the portfolio management risk management tools and systems. So we continue to work with procurement on the risk system, and we're getting closer. From the investment plan perspective, we continue to implement those as those were again adopted for the strategic plan. Those were discussed in June at WAMP. Some of the key follow-on points there will be to continue to rationalize the portfolio. So again, the goal is to take a look at where we have higher conviction managers, make larger allocations, and reduce the overall number of managers. So we continue to do that. Strategic partnerships, we've done a lot of work there over the past couple of years of going from 14 down to 7. We'll continue to scrutinize the partnerships to make sure we're getting the highest and best use and the best ideas. And if there are other ones that we feel that we can have a different implementation with, we'll bring those recommendations back to the commission. And then also a little bit later today, you'll hear about a fund of one recommendations for real estate. And so we'll talk a little bit more and do some education about that. Eric Ravelli will a little bit later today. But think about it as a little bit of a hybrid structure between a commingled allocation and a strategic partnership. So the idea is that you still get a lot of control and you eliminate some of the blind trust risk, if you will. So, yep.
Is it appropriate to talk about that structure now or when you get to real estate? Because I realize my questions may be elementary, but I'd like to understand a little bit more about what the difference in the strategic partnerships are and what you're proposing on the separate account for
Sure.
real estate. I'm not sure that I understand the similarities or the differences between strategic partnerships. So at whatever point in your presentation you could clarify that for me, it would be helpful.
Okay, so we'll walk through a lot of the detail in the presentation, but the idea is to have a customized solution with specific guidelines and more control for South Carolina as the investor. That's the primary purpose behind it. But we'll get into a lot more detail.
First, just before you go on, you mentioned that one of the things you're doing is you're reducing the number of managers. How many do we have presently?
So right now you have about 200 line items. And we've come in from
200
line items.
line items.
Yep, so that means that you may have 120, 130 managers.
Okay.
But some will have multiple strategies. So
I
if you
see.
have like
All right.
an Apollo 7,
And
an Apollo 8.
Do you have an objective in terms of where you want to get to?
So I think probably it's more of a what are the needs for the investment strategies and mandates.
So it's not an
that-
actual number you're looking at?
Right. You know, my general sense is it probably settles in around 150, 160
Line items.
line items. Right.
And Herschel, of that, how much is private equity and private debt? Because that's complex. Private equity and debt programs do tend to grow in numbers
Right.
over
And so,
time.
very good point, because as you constantly allocate on a vintage year, you're going to continue to add line items. But some of those will start to roll off, but not as soon as but at later dates. So, you know, probably I would say 75% of those line items are going to be more in the private markets area. So,
Right. So at that point, you rationalize it down, in terms of number of managers, where would you be? North of 100? Still north of 100?
I'd say ideally probably right around that.
Right around that one.
90s, 100, somewhere in that. So,
Any other questions at this point for Herschel? If not, go ahead.
okay, thank you. So I know we're about to have a more in-depth performance update for the third quarter, but just to give a quick update, since there has been quite a bit of volatility here for this current fiscal year to date, of the market at one point in time has had a drawdown of 10% from an intraday basis. The equity markets have so there's been a quick recovery from that. With that said, the plan had a loss of about 3.5% at one point in time, which is very close to the benchmark. Since that period of the low point, we've recovered back to about even. We're down about 10 basis points, and the benchmark is up about 25 basis points. So we're behind the benchmark a little bit right now, but overall, absolute value is back to about even from where we started the year with respect to performance. So I will stop there, and that's as of 10/31 estimate. So I will stop there and turn it over to Mr. Phillips for third quarter performance update, or through 9:30.
Thank you, Herschel. Good morning, everybody. Got a little bit more content this morning in the performance update, so I'm going to move briskly through it. If it's too fast, let me know. I noticed we just had 15 minutes for the total CIO section of the report here, so the update. So I'll move quickly through this, and just let me know if I need to stop or change anything. So all of my comments, as usual, are going to be focused on the first quarter of fiscal year 2015, ending on September 30th. Slide 2 here is a snapshot of the market returns of our benchmarks. You'll notice for the first time in many months, as Herschel alluded to, that we have several negative categories. And then for the added content that I mentioned here, rather than trying to map the benchmarks here to market segments and asset classes, we thought it would be helpful to provide some more some market context, I guess, before we get into the actual plan performance. So that should help add some color to everything. This is the first of 5 slides, each covering a different market segment. So the next several charts, or the next 5 slides with this one, have the same time scale on the horizontal axis starting in October of last year, and importantly covering the most recent quarter. So on each of them, if you'll draw your attention to July, August, September time frame, kind of toward the right side of the chart, that'll help explain some of the performance numbers that'll come later. So here we start with the sovereign yields. The black line here, the middle black line, is a relative baseline. It's the 10-year Treasury, 10-year U.S. Treasury. 1 year ago, we had 5 of 8 major developed markets with 10-year bonds yielding more than the comparable U.S. Treasury. We end the period with only 2 of the countries at higher yields. So even at a 2.3%, roughly 2.3% yield on the U.S. Treasury, which has been relatively stable for the period, the U.S. Treasury gradually became more valuable over the time. This was particularly poignant, if you'll notice, during the first fiscal quarter for our performance period, where it was almost the most valuable 10-year Treasury or sovereign yield in the world. Possible drivers of this dynamic, which will carry through the successive slides coming up, basically all point to some type of repricing of risk or market rotation dynamic, driven by any number of things, but a few samples are ending of the Federal Reserve's quantitative easing program, changing monetary policies globally and the effects on emerging markets, China's growth prospects, relatively stable U.S. economy relative to the rest of the world, growth and inflation questions broadly, but especially relevant to the major developed markets of Europe and Japan. That's just a small sample of a number of the issues, some idiosyncratic and event specific that came up during the quarter as well. But those were the broad issues or concerns, if you will. Similar trends in the global equity markets. Note the divergence in the U.S. markets beginning in June. Also note the downward trajectory in the EAFE category, which is a blue line, over the same time period, presumably the result of continued disappointment in the Eurozone recovery and the lingering weak monetary response in that country. For perspective here, the MSCI ACWI benchmark is currently approximately 50% U.S., which is the top gray line, 41% EAFE, and 9% emerging markets. So the divergence in the U.S. Combined with the weighting in the benchmark was quite significant. For credit spreads, in the top section here, the red arrow shows the increasing spreads in both investment grade and high yield categories during the quarter. And in the bottom section, we see a widening of the difference between the two. So high yield experienced a larger correction than investment grade. Or stated differently, risk began to be more appropriately priced with respect to investment in high yield grade during the quarter. So again, we have additional confirmation of changes in risk tolerance and the resulting performance that'll show up here in a few more slides. So on 6, we show commodities for 2 reasons. One, this is the asset class was the plan's weakest asset class during the quarter by quite some large margin, which you'll see in a bit. And specifically too, this category is not without its own specific kind of secular drivers and change that are driving pieces of the market here. So the largest 2 components of the benchmark is energy and agricultural sectors, roughly 30% each. They are the bolder lines here, blue and the dotted orange respectively. Each one sold off between 20 and 30% over the last several months. We know within the energy sector that the price of oil is at multi-year lows. That's the blue line. Driven by the increased U.S. supply that we all are well aware of, I believe, as well as an overlapping geopolitical issue that is ongoing between the Middle East and U.S. In the agricultural sector, this was a banner crop yield banner year crop yield for both corn and soybeans. These are the 2 largest components of the ag sector. So the prices here are reflecting record high supplies over the past year, driving the dotted orange line down. And then lastly, with currencies, returning to one of our first observations, this chart shows the relative strength of the U.S. In the currency markets over the same time period. So you'll note the black line, it's the DXY, which is the U.S. dollar index, and it started appreciating markedly and diverging from the others in the June-July timeframe, which was the start of our fiscal year. So, we were relatively fortunate, I guess, for the time period here to have the market dynamics line up very well with our reporting period, which is purely coincidence, but we had these correlated movements across market segments that showed up well here, and I thought provide some very good context for the upcoming performance numbers I'll show. So let me pause there, see if there's anything that I can expand upon. So getting into our regular content, the top red box here for total plan performance, we're down 1% for the quarter, 19 basis points behind the policy benchmark, which returned negative 0.81%. The plan also paid just under $300 million in net benefit payments. We adjust the numbers on slide 9 to include a contribution from the overlay exposures. So in sum, 5 of the 13 asset classes were positive for the quarter. Each of those was some form of an alternative asset class. Also of note, if you'll draw your attention to the columns for the year-to-date, 1, 3, and 5-year columns, there are almost no negative numbers in these columns. So anecdotally and hopefully temporarily, this is the first reporting period in some time to have broadly negative results. So our standard exposure report relative to policy targets, there were no major changes in category exposures. We remain underweight to diversified credit and real estate, two categories that we have been putting recommendations in front of you here recently and including today. And we remain overweight in the conservative fixed income category. This is the very highest level of contributions to the changes in value. Approximately $300 million each came from benefit payments and investment performance for the quarter. Components to this are broken out here. The second and third red bars on the left, I'll highlight these briefly. The largest negative contribution came from global public equities. It is both the largest allocation and among the weakest asset classes for the quarter. Commodities is a very small allocation for the plan, but it had extremely weak performance, so it shows up as the second most dollar-weighted negative contribution. These two categories combined for negative $302 million impact to the fund, a decrease to the plan. Partial positive offsets came from private equity, real estate, private debt, and hedge funds, the green bars to the right. Here we show the magnitude of the positive and negative performances irrespective of the allocation. So this is the first time that commodities really shows up in a significant way, which I mentioned before. So commodities on the right, we did outperform. So it's a little consolation, though, when you have an asset class that is down 11%, 11 to 12% in 3 months. We see global public equities here again. It's the fourth bar or fourth section from the right. The drawdown on an absolute basis is not devastating by any means, but again, it is 31% of the plan, so it was meaningful. So I'm going to skip slide 14 for just the sake of time. Unless there's any questions, we certainly could come back to it. This is just the relative performance of the previous slide. Switching to the overlay reports, the largest use of the overlay remained the synthetic component of global public equities. Note that this is, again, as of September 30, so the size did come down with the October funding of State Street in that category. And I'll show that better here in a second.
David, just
Yes,
at that point, just on that slide, it might be helpful. I'm not sure that everyone is totally cognizant of the relationship to the overlay, to the plan value, and so maybe you could have a little explanation as to the overlay, how it works, what it does.
Sure. So the overlay, we use the overlay to implement, I guess, in a more timely and tactical manner, the asset class plans when we can't get immediate exposure to the managers, and so to come to the commission and get something approved, as well as any type of market dislocations, we can act in the overlay category. We do this through synthetics, futures, swaps, that types of thing, those types of deals. Through we use Russell as our external implementation manager for that. So the implementation here that you see here is a component. Maybe it'd be better to go back to this chart. So here's where we incorporate the overlay components to each of the asset classes. So in any of these time categories, the overlay had some exposure, or we use the overlay for real estate or global public equity or GTAA, et cetera. The yellow highlights for market implementation, for portfolio implementation. For us, it gives us just a more flexible tool in a toolbox to get the market exposure, to maintain the targets within the ranges that have been approved. Mr. Chairman, is that helpful, or is more detail there?
Yes, thank you.
Herschel, would you like to add anything to?
Yeah, I would say too, on this slide here, like where there are highlighted yellow spots would be where the overlay is currently being used or has been used in the past. So if we fast forward to the other slide you were on, so for public equities, GAA, commodities, that's where we're actually using it at now. But even historically, for real estate, where we had on the REITs trade, that was a longer term, because we have longer term numbers, that's why that would show up there. But right now, we're currently using it's $4.4 billion of total exposure relative to the 29, would actually be the synthetic. So that green slice is what's overlay. So the other 25 billion would be in cash, securities. And then the other part here he's showing is actually the synthetic, or the overlay with Russell right now. So, and that has actually come down quite significantly.
I have that. I'll get to that here in a second. Okay. Yeah, I'll show that in just a second. Yeah. So part of the reason we break this out, one is it's important to show where what's being impacted by the synthetic types of securities. The other is important for the commissioners. These are synthetic securities. They're swaps or futures. They're different from the traditional implementation that we are more knowledgeable of in the long-only traditional managers account cash allocations, that type of thing. So different risk profile and therefore warrants a little bit more granular reporting. Okay. So part of that more granular reporting is here. So composition of the overlay. Bottom chart here on slide 16, we're sticking with September 30 data. The global public equity line here includes a Russell 2000 swap and the subsequent State Street allocation still shows up here. Both of these moved out in early October, and you'll see that here. This chart is rolled forward to last week in terms of time, so it is not ending on September 30. So beginning in October, which is the last 6 bars on the right, you can see that most significantly the State Street dynamic, which was $1 billion in exposure, came out of the overlay and went to an actual cash allocation, as well as the expiration of the Russell 2000 swap. That doesn't show up as much here as the $1 billion allocation, but you see the stair step down. The first stair step down, as you recall, was BlackRock allocation to a similar strategy as State Street. 2 months ago, 2 to 3 months ago? Well, it's on here. So in June was that allocation. So the overlay, to Herschel's point, on a longer term note, the overlay exposures have now been reduced from approximately $6.5 billion to just under $4 billion over the last 8 months or so.
Is that a positive development or just a neutral sort of thing?
I don't think you can classify it, Dr. Wilder, as positive or negative except at the extremes for use of an overlay and synthetic account. If it was higher and trending higher, then I think that is, again, not necessarily positive or negative. It warrants question from particularly you guys on the commission. We tend to keep a pretty close leash on it and make sure that we're knowledgeable of what's going on there, how it's being implemented, and the reasons for the implementation. So I think we take a pretty conservative approach to the use of it. Although, at least from my knowledge of public funds, we are probably a little bit more progressive, if you will, in actually having this tool in the first place. Is that fair, Herschel?
Yeah, I think so. And just to go back, because I know the composition of the commission has changed from even when I joined in 08, and going back to even before I joined in 07, I think that several commissioners remember that Russell was used as the overlay manager to help change that dynamic of the portfolio that was inherited at that point in time, which was the domestic portfolio of stocks and bonds. And then it was in 07 that statute and the Constitution changed that allowed to diversify into non-U.S. assets and alternative assets. But Russell was used as the way to reshape that asset allocation in a very timely manner until you had the time to go through due diligence, hire the managers, contract the managers, and then shift that allocation to the manager. So that was a tool that was used to keep and to stair-step into the asset allocation as well. Going back, if I recall correctly, I think that the actual top number that was used for the overlay was somewhere around 10 or $11 billion at one point in time. As we've continued to actually fund managers and have that allocation change, you've seen that come in. Also, with respect to, as David said, with what we're doing in the equity side with State Street and BlackRock, and then also the 3 additional managers that we've hired, we continue to see that stair step down. And so the ongoing utilization, again, of the overlay will be to help us maintain and get exposure to certain more equity beta, if you will. Or I shouldn't say equity beta, but to market betas, whether it's commodities, equities, what have you, to maintain balance and to stay within our exposures of the overall asset allocation. If we need to make a shift of, say, for instance, terminating a manager, then we can also use Russell as a transition to help go through that termination as well. So they'll maintain a market exposure as they sell down securities and replenish the new manager with those securities. Or if we just needed, for whatever reason, to reduce and terminate a manager at a point in time and bring the cash back internally, then they could easily do the overlay of that cash with whichever market security or market beta that we wish to have. So it's a very effective tool, but the key takeaway is it is getting smaller over time, and we'll probably have a little bit more of that to come out. But I would say that longer term, you'd probably expect still a few $1 billion in the overlay.
Is that helpful, Dr. Ron?
Thank you.
Okay. So refocusing here on the long-term plan performance, we had the obvious negative mark to $29.2 billion in total value. But keep in mind here, the time scale is a bit distorted on this chart. The last data point is only 3 months, not a full fiscal year. So, we're always working to make sure that it's up and to the right and not something else. Transitioning over to manager contributions in public markets. As usual, we present this on a fiscal year-to-date basis, so this is only 3 months and to some extent less meaningful than a longer term time. Nevertheless, the left box here, roughly half of the highest contributors are still negative, so that's the first time we've had that, but yet they are our highest performing public markets managers. Also in the left box, the highest contributors, note, were predominantly hedge funds. Right box, we have predominantly equity managers as the largest detractors. So again, getting back to the performance of the equity markets as well as the allocation size, we would have the natural conclusion to populate this box here. One exception to note, going back to, if you recall, the market commentary at the first of the presentation, pertaining to the U.S. versus the rest of the world. We see that actually materialize here in a pretty significant way. If you'll note, the Russell Large Cap Transition line is number 2 in the top left. That is a U.S.-based or a U.S. model portfolio, optimized portfolio to large cap S&P names, versus, on the other end of the spectrum, the BlackRock Global Equities line, number 43 on bottom right, which is essentially equities rest of the world. So again, the market dynamics that we showed earlier show up in a big way here on the contribution slide. Largest public market allocations, the cutoff here is a 1%, at least a 1% allocation. We have only 3 meaningful positive numbers. Again, one is the U.S. large cap that I mentioned previously, and then 2 hedge fund allocations. One correction I need to make on this one in a subsequent slide, so please disregard the summary statistics on the left side here. They are erroneous. This list is 54% of public markets and 44% of the total plan across these 19 public market managers. So I'm going to skip 21 and 22. I included this as a supplement. These are the same analysis, but on a trailing 1 year basis. I put them in here for your reference, but I will skip those for now. Again, those are public markets. Switching over to private markets, and again, we standardized here on a trailing 3 year perspective. So we continue to experience broadly positive contributions in our longer-term allocations. The only thing I think to note here is that our strategic partners continue to be well represented in the left box, and that's a nice result considering how we've emphasized those. Same commentary on the top 20 managers in the private markets. These managers, again, disregard the summary stuff on the left there. These 20 managers are 51% of private markets and 9.5% of the total plan. I apologize for those errors. And last but not least, two last slides. We have the risk update. These are internal reports only. This time we'll have the Goldman Sachs risk reports that we normally have for our next quarterly update. Note the quarterly spike that you can see just barely down here that we mentioned last time, but you see the full round trip of that during the quarter in that spike there. Otherwise, the main takeaway here is that we continue to operate in an extremely calm environment, almost still an unprecedented type of environment, at least from the perspective of volatility.
Can we ask a question there?
Yes, sir.
Right, so we got a little spike, right? We know that correlates to 3.5% move on the plan, right? So we know a move back to, risk here, do the math, right? I mean, that's going to be a big move. I mean, any portfolio actions, any thoughts resulting from that, right?
So we did. So there's another. Yeah. Oh. Yeah, so we actually did take a look at, when the market is coming in so fast, the ability to react in such a manner and having the tools there is one of those things. And we actually took a look at the number of times the markets come down 5% and then start hitting a 10% threshold. And one of the things we actually did is we actually sat down and looked at, are we ready to actually enter? And the conversation was, should we actually add more money back to equities, as opposed to reducing because of the drawdown of 10%. We did not, because we were already at that point in time short, because we had the small cap bias and we were already short a portion of that, so we did not make that decision to add more to equities. With that said, and I'm not sure, David may be getting to this in a second, we did unwind that position, and the synthetic short, and we also did sell out of some of the physical securities. So that's what we actually did from a risk reduction is we removed some of the higher beta component to the portfolio from the equity piece because of small caps. So, David, I don't know if you want to.
We took a small bite, kind of back on the way up here in S&P in the U.S. large cap sector. We did that in the overlay component, and I believe it was 100 million.
So we're layering in, and we only got 100 on our downward price path. So.
That's right. We had an order in to do more, but it never kind of came back and gave us that second chance. The only thing I would add, Mr. Gillespie, from this perspective, one is, recall that, below this line, this red line here, that's within our risk tolerance appetite, if you will. So movements, up and down within this are more or less what we expect. So to have that kind of a drawdown, if you will, is within that 5-year horizon that we applied for this to this analysis. And that observation, combined with the fact that we're coming off of such a very, very low level here, in some ways a return to some kind of normalized, whether it's this line or some other line here, some kind of normalized environment, actually is a good thing for us. Thus the reallocation that Herschel mentioned. It was not a cause for taking money off the table in the portfolio, if you will. So I had another thought on that point. Oh, if you recall too, from our last update, we had plotted the point on here that would have corresponded to the policy 10-year assumption line, and it was, even that was well below our threshold. So as long as we're below this and way below it in this term, I think it's a luxury to have the option to do what Herschel just went through, which is tactically take advantage of those drawdowns as opposed to being very defensive about them. Is that helpful? Yeah. Risk allocation on the right chart here has not changed meaningfully since June 30. So that will conclude my remarks. Let me open it up for any last questions or turn it back over to Herschel.
One, this is just kind of more a thought, longer term for the commission, but I literally typed in the wrong symbol, and I happened to notice it was a Guggenheim mixed credit product, a closed-end product trading at a pretty large discount, right? And it kind of brings up a lot of our managers do have multiple structures, whether they're BDCs, closed-end funds, right? Other types of structures, but it may be worth our time to investigate. Could we eventually use our same managers, but they're publicly traded structures that may or may not have discounts if they're similar to our strategies and our rebalancing decisions, right?
Yeah, there's one of the trades we've been looking at is when you do have a sell-off in the markets, especially with an ETF, say for instance high yield, that when the sales happen, they have to be able to meet the cash flow or the redemptions. And they are a forced seller of that set of bonds. So in those points of, not just, I'm talking actually more stress and more volatility than normal, you actually do tend to see a widening discount. And so from that perspective, would it make sense to allocate to the high yield ETF, which in itself then you can actually pick back up that discount as markets normalize as well, in addition to for the price appreciation. So that's one thing we've looked at. We haven't actually pulled the trigger on it. You make a very good point with respect to several of our managers have BDCs out there, and when you get periods of market stress, investors, for the uncertainty reason, will throw the baby out with the bathwater. So that in itself could create an extra value opportunity to participate in a much more liquid fashion from trading the shares of the BDC.
Just a question. Obviously, there's a difference between capital allocation and risk allocation. Could you talk a little bit about how you calculate the risk allocation and the differential? Just can you give us a little color there?
Sure. I'll do the best I can to give it justice. We've got some experts on the floor that can go way into the weeds better than me, but obviously the capital allocation is going to correspond back to our policy charts, which are here. So the capital allocation you'll notice is not too different, or shouldn't be different at all from this chart here. So getting back to the actual risk reallocation, what we do is weight the individual asset classes by volatility essentially, as opposed to the dollar amount. So in terms of what drives the day-to-day, if you will, changes in the portfolio, it's going to be the volatility of each asset class as opposed to the dollar changes in each of those asset classes. It makes sense.
And so the baseline is the conservative fixed income?
No, what's showing up here is that we're getting zero diversification out of out of conservative fixed income asset class. So it's not helping to balance the global equity risk profile.
And that's going to be based off of a standard deviation.
Right.
And then the Goldman Sachs report that we will get will actually be more of a
Factor-based.
based. So you'll have slightly different numbers. But as David mentioned, think of the left side, the capital being, that's your allocation based on dollars. The right side is your allocation based off standard deviation.
So it's significant that the Goldman Sachs perspective is not here because, as mentioned before in previous updates, it provides corroboration, if you will, from a factor approach as opposed to a statistical approach, or from a volatility approach here that we're showing. So, ideally, I would have both each time. Timing issues just didn't work out this time for us, but roughly the 65 to 75% range of equity risk shows up in both this one as well as in the Goldman Sachs risk report. And again, that's from two separate, distinct perspectives, and you're looking for corroboration there, not necessarily that they equal, but just that they're in the same ballpark. Is that helpful, Mr. Chairman?
Yes,
okay. You can come up here.
Sit down here.
Yeah.
Just have to drive somehow.
Yeah.
Thank you.
So I know that Suzanne Bernard from HEK would like to also make some additional comments for third quarter, so.
Yeah, just a few. Actually, if I may, if you don't mind, David, I'm going to go back to this for a second. Sometimes people look at these charts and they're a little alarmed. Hey, we've done all this diversification, yet we still have a huge impact from global equity. I can tell you if you were a more equity-oriented program, so let's say instead of 40% in global equity, you had, say, 50, 60%, you would see that global equity impact being somewhere close to 90, if not higher. So it's not uncommon for large public funds to have the vast majority of their success or failure riding on the behavior of the global equity markets, regardless of what their asset allocation happens to be, because it has such a powerful impact due to the volatility. So it's just something to keep in mind that while you may say, wow, that's still a lot, it's considerably less than your peers, and it's something that we think is a positive. We'll talk later about asset allocation impact and how you can weather various markets that we might have, but this is a key issue, and I just want to spend a minute emphasizing that. So, please.
What would a pie chart like that look like if instead of weighting it just by volatility, there was also correlation factored in there? Would global equity suck up even more of the risk in these other factors?
The way we do it is more regression based. So I'm not familiar with that exact methodology, but and I understand the Goldman Sachs approach is pretty similar to ours. You probably get a little bit more when you run this for Goldman Sachs approach on your current portfolio. So keep in mind, instead of 69, it might be closer to
75.
Okay. Yeah. If I were to run this, and that does take into account correlations. So it picks up things that have equity-like characteristics. So for example, your hedge funds have equity-like characteristics if they're equity long-short managers. Your high-yield managers will have equity characteristics because of the way high-yield bonds behave. So you get things that are coming into that aren't necessarily only global equity, and that's where your correlations really kick in. It's a key issue, Reynolds, in looking at how you behave versus how your assets might be allocated by asset class. So, what we have here, I'll go through quickly. It's mostly related to compliance. So we just want to always make sure that you know we're watching this and that everything is working as it's supposed to. So David's done an excellent job talking about the markets. Obviously, during the third quarter, we had massive correction in the global equity markets. Europe had some not so great news. U.S. seems to be U.S. dollar seems to be one of the few brighter spots out there. So in this environment, you return -1%, about 20 basis points shy of your benchmark. The positives, you did have strong performance out of your hedge funds, your global asset allocation, your real estate. The underweight you had to commodities, the worst hit asset category during the third quarter, and an underweight to emerging market debt both helped, and then an overweight to a couple of areas of fixed income that did outperform your policy. However, that was more than offset by your private equity and your global fixed income mixed credit all underperforming, as well as some underweights to areas that did do a little bit better during the quarter. So yes, we're looking at this quarter, but really all of the long-term news is good relative to your policy. A quick look at the markets. I'm not going to spend much time on this, but the one thing I would like to highlight, if I can do this without, is right here in the one-year period. If you look at the equity markets and just the divergence of returns, and that honestly extends out to even 3-year and 5-year annualized returns, just the divergence worldwide of the global equity markets. This is one of the reasons that we have recommended global equity managers to have a little bit of flexibility there. And flexibility is going to be a key issue when we talk about this asset allocation review that we'll be doing later today. According to the SIOP, we always use this report to provide any meaningful updates of changes that occurred during the quarter at your managers. A couple of things, none of them require action today. We have looked at them as not essential to the success of these managers, but we are going to come back to you within the next month with some additional thoughts on it. So at Schroeder's, a key individual that headed up their Latin American markets segment left. It's a meaningful change, but not one that causes us to recommend a sell immediately. We talked extensively about PIMCO at the last meeting, where we've moved them down to a hold. We think things have largely stabilized there, but we continue to watch that. Interestingly, a related note, GMO had Mark Seidner left to go to PIMCO. He was a key individual there. We continue to think GMO is strong, however. And then at Mondrian, they have been planning, I think in a very intelligent way, the retirement of their CIO fixed income. So we're continuing to monitor that as well. None of these require action. We've already talked about the overlays, so I won't go into that here, but this is basically what your asset allocation was at 9/30, the overlays, how those all kind of work out, and then in this last column here, were you in compliance with your SIOP? So here we have the allowable ranges, your policy targets, and where you actually were. So everything is as it should be. We've looked at performance. We have a couple things here that are hopefully useful, the 1-year, the 3-year, the 5-year, all net of fees, relative to your policy index, showing the difference, except for the third quarter, all above not only the policy index, but also above the 7.5% actuarially assumed rate of return. And these are annualized returns. Now, this is something we show every quarter. This is how you compare to other large public funds. And what we're looking at here on the vertical axis is return, on the horizontal is risk. So if you look at the 3-year number, you can see there's a very direct correlation between risk. Lower risk means lower return. Higher risk means higher return. That's largely because we've been driven over most of the last 5 years by a very strong equity market. That's been the place to be. If we'd known 5 years ago everything we know today, you'd put 100% of your portfolio in equities because it's been a very strong unidimensional market. That's great, wonderful. We've benefited from that because you have a big allocation to equities. You do not have as large of an allocation to equities as some of your peers. We've chosen intentionally to have a diversified portfolio that is lower risk and will do well in a variety of markets, not just unidimensional ones where equity does well. However, that means that your ranking in periods like that is not going to be as strong. So over the 3-year period, we are looking at a ranking that's around we'll look at that in a second. But I'd like to point out also on this 5-year period, while you're still probably not as high as you'd like to be, it's much more random. This shows how it looks in a universe of returns. So this is the 5th to the 95th is the kind of range within this bar. The middle is the 50th. You're the blue box. The green box is the policy index. In the first to the far left set, we're looking at returns, then standard deviation, which is a proxy for risk or the volatility of your portfolio. And then we show over here the Sharpe ratio, which is return per unit of risk, so the efficiency of your portfolio. So we show the 3-year and the 5-year periods here. It's in the 80th percentile for the total fund for the 3-year and about the same for the 5-year. That may be disappointing. If you look at standard deviation, however, it's also quite low. That's a good place to be. When we pull it all together, your Sharpe ratios are in the 21st percentile and the 26th percentile, so the top quartile. So while you may say, oh, on an absolute basis relative to other funds, I wish we'd earned a better return, quite frankly, your return per unit of risk is much better than the average fund out there. Also, we talked a little bit about unidimensional markets where equities are driving everything. Third quarter wasn't that market. We all know that. You were actually in the 33rd percentile for the third quarter and the 44th for the calendar year to date. So one of the reasons we do all these things we do in alternatives is to make sure that you're participating in up markets, but you're not going to get 100% of it because you don't have as much in equities, but that you're protecting yourself in down markets, and that's exactly what we were trying to do during third quarter. Okay, so while you underperformed your benchmark, you outperformed the vast majority of funds. I'm sorry, please, Mr. Chair.
I think as you pointed out, and I want to make sure that we all understand it, when you talk about that far left chart in terms of absolute returns, that's comparing us to all other funds that may have very different mixtures and very different asset allocations. And as you rightly point out, if you have a fund that's 100% equities, obviously that's a very different picture that would be presented if as compared to us, for instance.
Right.
So I think that's an important point.
It's
and then
tremendously
you
important.
rightly point out the Sharpe ratio where we stand substantially higher than the third quarter results. So I
Right.
think that's important to recognize.
It's a huge issue.
Hi,
And
Suzanne, can you hear me?
of course I can, Curtis.
Hey,
Mr.
well,
Treasurer.
good. Operator problems this end. I noticed we haven't talked any about the lag in reporting that a fund like ours should have. So the numbers that we get for the end of September might not measure, say, with the fund set at North Carolina, which is a very different portfolio. Do you make any projections about what will happen as those other numbers come in, lag ahead
Right.
from a lot of the alternatives?
Yeah, it's a problem you have with universe construction that not everyone's data comes in real time. So these are continually updated, Mr. Treasurer. So as we get data, let's say a first quarter data was revised because someone had private equity numbers come in that they didn't have when they did the first tranche of universe reporting. That gets modified over time. So if we were to go back and restrike first quarter universes, they would change slightly, usually a couple percentage points. We're not talking big changes. But they're continually fed and cared for so that we make sure we've got the most current data. But most folks have a... Oh, please.
I understand that, and I'm not trying to throw the monkey wrench in here in any way, but I do think it's important that our fund is going to be affected by a lag in reporting a whole lot more. And before we beat our chest too much, with this turbulent times we've just gone through, it might be wise if we take a good look at it over a longer period of time.
Certainly, and I wouldn't suggest that 1 quarter's worth of universes or anything to get excited about, just trying to show what it does do when the markets decline. Most of your private markets that don't necessarily report real time, such as private equity, some real estate funds, don't show meaningful quarter by quarter deviations that 1 quarter adding or subtracting is going to have a meaningful impact on your returns. Unless we have a really catastrophic type of market event, but we certainly didn't have that during third quarter. But it's an excellent point. There is a mix of data in here.
Thanks, Suzanne.
Of course. So just to make sure we're all clear on that return issue, it is important to note that that includes all public funds that have more than $1 billion that we were able to compile. So it's mostly data from a large number of custodians. I'd say it's the most comprehensive universe out there. However, keep in mind, some of them are fully funded, some of them are massively underfunded, some have different restrictions. It's a very wide range of funds with different risk situations and different just circumstances that they find themselves in. So you're going to have a wide range of asset allocation practices within it.
Suzanne, this is not just the BNY universe?
It's BNY, and we're also adding any funds that we have as well. So we want to get it as comprehensive as we can.
Thank you.
And we have a large number of public funds as well. Performance attribution, just briefly go over this. Let's start out with this chart here on the right. At a macro perspective, just for the third quarter, as we mentioned, you were down about 20 basis points, or 0.2%. Managers were really the primary reason. Your asset allocation impact was a net neutral, and then there's just cash flow movements and such that can't be accounted for in the math here. If you were to look here at the top, that's the various effects that the asset allocation had. So this is basically, we're looking at relative performance here. So what caused that 20 basis points lag? And you can see things such as you were slightly underweight to commodities, one of the poorer performers, that added 4 basis points. You were slightly, let me see, where's real estate? You were slightly underweight to real estate. It did well. That detracted 5 basis points. And then finally, this is your manager value added. In private equity, although it performed well during the third quarter, did lag its benchmark. Not going to go through this. This is each of the categories. David's already done an excellent job there. We do have some private markets performance. As the commissioners know, there is a separate private markets report that goes into this in much greater depth that we provide you. But just from a very macro standpoint, your internal rates of return since inception for your private debt, private equity, and real estate are all in the 11 to around 14% range, quite strong. And we show here what it looks like in terms of current net asset value. And then we have this thing called potential market exposure, which is basically if all of your commitments were pulled down today. That's not how these folks operate, but we always show that just so you have that information. That's it from us.
I did have one question here. Can we go to slide 51, red 51?
So which slide?
Red 51.
Red 51, so 12 pages
That's
forward
39
from where
right
we are
now.
Oh, I'm sorry, 51.
Oh, going the wrong direction.
Oh, okay,
There we
so
go.
we're going into the private markets report. Yes, of course.
Yeah, I was a little surprised by our venture count being so high.
Mm-hmm.
Right, at 10. Right? I mean, what funds are getting classified as venture? Because, I mean, I know we have the commitment to the guys in Raleigh, but, I mean.
Yeah, that went to Industry Ventures. And then we also had a commitment to Industry Ventures as well.
Mm-hmm.
I know there are a couple of smaller fund-to-funds that were there as well. So it's actually venture.
And it's largely older funds,
Yeah.
given the unfunded commitment number being where it is. I could get you a list of those, Alan. I'd have to dig into the report itself.
When it came up, because, just off the top of my head, it's, I'd only recalled like 2 or 3.
Right. And it's only about 10% of the fund. This
Right.
isn't an uncommon structure, by the way. As you well know, venture is something that it's difficult to get a full allocation to, and finding good managers and access. That's about the allocation that we generally recommend for larger institutional funds. So, but I can get you the full list. I just don't happen to have it in front of me here. So I was not going to go through the private markets report. Are there questions on it that anyone had? I'd be happy to go through it. Any questions?
Suzanne, just one question on the returns on the private market.
Sure.
Isn't there a significant deviation, or however you want to term it, in terms of private equity, that you don't really realize that until they sell something or the return, the investment is eventually terminated? For instance, recently, Wilbur Ross, I think just the other day, said in this recent period, he's liquidated 6 times as much as he's bought. Well, that's extraordinary. I mean,
Right.
so that you would get within that period, you'd probably get a big bump up in terms of a return, and then you might, for the next 18 months to 2 years, it could be absolutely flat. I mean,
Right.
is that common among most of the equity? I would think that'd be fairly common among a lot of funds?
It
Where you get
is.
substantial deviations of returns within periods of time?
Yes, and I was just talking with our head of private equity about this actually a couple days ago. In the financial crisis, a lot of private equity managers had to take write-downs in their portfolio. It was very poorly received. We've found that since then, private equity managers as a group in particular have kept valuations at very conservative levels. So when they do actually realize a sale, an IPO, even if they're holding stock that's publicly traded, they will do so at a discount because they're very conservative in their methodologies. So what we see happen in the private equity markets is when they finally do realize a sale, an IPO, they will take huge write-ups when that happens. So only recognizing those gains when they actually occur and it exits the portfolio. So that's when you see the lumpiness of returns on the upside. The downside is interesting that, again, going back to the conservative nature, they don't want surprises for their investors, so they will write things down more quickly than they will ever write things up. So you'll see that occur. And they'll do that and hold it at a more pessimistic scenario than they may actually be able to sell it at. So overall, we do see there's big spikes, there's big uptrends in realizations as you're getting toward the end of a life of a private equity. Does that address the question you had? Okay. So it's by no means a smooth set of returns. So as you've built your private equity program over time, and obviously we're realizing sales as well as investing in new, that's when you start to see the real returns come out as toward the end of the life of a private equity program, or a private equity manager, I should say.
Okay.
All right, if there are any other questions for HEK, if not, thank you very much, Suzanne.
Anytime.
I think we can now move on to number 6, investment police, Mr. Harper.
Thank you, Mr. Chairman. So I wanted to present to you, here's the red line version. Back in October, we presented the second draft. And going back to go back to the WAMP discussion, we had a much longer version, and there was a lot of discussion and input from the commissioners with respect to what the eventual look and feel for the investment belief should be. And the idea was to get to something that was a little bit more shorter, succinct, could fit on one page. And so that's what we've tried to do. We presented that last commission meeting and received some comments in that meeting and then after that meeting as well. And so we're looking at a red line version of what some of those changes are here. The largest change I would say would be to number 5, and that's really trying to pick up on expanding the very last sentence there that had been deleted, and that's using the active management when we believe there's value, and to put more around that we would use active management in various ways, but there's a lot of things we consider when we're doing that. One is the investment manager's capabilities, their skill set, the cost for going active versus the benefit of doing it, so the fees component of it. Obviously, the portfolio fit and the potential impact we believe that strategy will have or that decision will have. The investment structure, so we're going to legal structures. And then also, there's the overall active versus passive, public versus private. Is it something that we can do internally, or do we actually need to go to an external manager? And when I say internally, we do have the cash and short duration strategies, the overlay component to it as well. The overlay, the key thing there is while you're getting a passive implementation, you're getting a very, very low cost implementation at usually a couple of basis points. Also understanding and taking a look at the valuations of when we're making these decisions, and that's to pick up on the idea of being price path dependent. So the timing of when you actually buy that asset or sell an asset will matter over the long term as well. So that's probably the biggest change that we have here. But I'll stop there and see if there are any other questions.
Any questions for Herschel on these investment beliefs? Any discussion? Yeah.
Well, I mean, I think it's a much improved getting it shorter. I'm a little curious that you took out the across risk premium, and the only reason why I bring this up is because we just looked at the chart where equity risk is dominating our thing, right? But long-short equity or merger arb, right? That's an equity strategy, but it has much different risk return, right? So it's not really, like if you made a big allocation to merger arb, right? It's like, okay, is it asset allocation that's driving it, or is it strategy diversification driving your risk return correlation assumptions? So I mean, I think for a plan like ours, and as we think in risk space, right, you know, people tend to simplify it down to asset classes, but there are a lot of things you can do within asset classes that have dramatic impacts on the amount of diversification you get, right? I mean, what we saw in commodities, same sort of thing, right? Commodities went down big, but CTAs had a big quarter, right? I mean, there was a big difference in CTA performance and long-only commodity performance, right? So while asset class, I think, is important, I think strategy, you know, the implementation choice is important too. And I think too, sort of, I don't think plans spend enough time thinking about, you know, how do we diversify within our asset classes, right? I mean, traditionally it's small cap, large cap, international, but they have correlations of 0.9.
Right.
Right.
Yeah, so the thought behind that was going back to simplification, easier to understand, so I think a lot of folks get diversification. We're happy to leave that in there because I don't disagree with your point. But I wasn't sure if everybody would pick up on risk premium, what we're trying to get at there. But
I like it.
You like it?
I'm inclined to put it back.
okay. So we'll keep that in there.
And I appreciate you explaining that the goal of the commission, you know, I know my time here has been short so far, was to condense it, because I had sent Mike some information. I think he shared it with you at a conference. I got a copy of CalPERS investment beliefs, and it's very expansive. So
Absolutely.
comparing that to a very simplistic statement gave me some pause. So I appreciate you explaining that the commission has taken a focus of making that a very simple statement as opposed to putting all of that information in the statement of beliefs.
And I will make the comment too that, you know, obviously these are going to be up for adoption and approval and become part of the SIOP. But as we move through time, and if there are kind of more key things to refine things, that we can always come back and tweak as well. So.
Any other questions, comments for Herschel on investment beliefs? If not, then let's move on to.
We have a motion, Mr. Chairman.
Wait, I'm
Yeah.
sorry.
Yes, sir. You want to read the motion? Mr. Chairman?
Oh, I'm sorry. We
Yeah.
have why don't you read the motion, Mike?
Yeah, I will, yeah. Mr. Chairman, the motion would be, the commission adopts the RSIC's organizational statements and principles, investment beliefs, as presented, discussed, and I think amended during the commission meeting, and directs RSIC staff to make the necessary technical and formatting revisions to incorporate the approved investment beliefs into the Statement of Investment Objectives and Policies, the SIOP.
Second?
Second.
All in favor? Aye. Aye? Yeah, opposed?
Aye.
Motion is carried. It's unanimous. All right. So now we will move on to item 7, asset allocation discussion. Mr. Hopper?
Mr. Chairman, Ms. Bernard will lead this discussion. So we've taken a look at several iterations and thinking about different markets and things that have changed from an actuarial perspective as well to take a look at that, because one of our beliefs that we just adopted is we actually need to start with understanding the plan, and as Mike alluded to a little bit earlier, beneficiaries first, and that's where the crux of everything begins, is from that as our anchor point, if you will. And so obviously HEK has a lot of resources with respect to actuaries. They've taken in a lot of data. They've used that from forecasting things and taken a look at different capital market assumptions and different asset allocations and what those impacts to the funding ratio, employer contributions would be for different types of market environments. And hopefully I'm not taking too much of your thunder in the introduction here, but I think there's a lot of great work here to give the commission to think about different scenarios and what those scenarios would impact for all the plan itself. So I'll stop there and turn it over.
Maybe when you get into this, it might be helpful. There's been so much discussion here recently about what's happened in Detroit, to the Detroit pension system. There was quite an interesting article here just a few days ago, very critical of the actuarial people that were involved with the Detroit system. And there were some very interesting comments in terms of what their contribution was and what their responsibilities were and so forth. I'm just wondering if you could maybe tie this all together so that we have a more complete picture of how all this should come together.
Right. Okay, I will attempt to do that.
I know that's a big word.
Sure.
But I think it's, you know, we all read this, and we see what can happen in a bad situation.
Right.
Obviously, it's the kind of thing that we would all like to avoid.
Sure. Sure.
Definitely.
Happy to, and I think I know where I can weave that in. Is everyone all right with me sitting down here? I'm happy to stand up. I'm fine sitting down too, if that's all right with you. Well, just as a reminder, we did our full asset liability study earlier this year. So this is not an attempt to redo the asset liability study. Rather, it's to say, hey, there's been some kind of interesting things that have happened in the market and the actuarial world that changed the math slightly. And in this meeting, we've had concerns expressed about various economic scenarios that might come. And the question is, how are we prepared for some of these more miserable scenarios, and are there things that we should be doing differently? So that's what we've tried to do here. We think the bottom line is we think you're fine how you are. So please don't take that as some need to change. But we think it's healthy to go through how might things evolve under some of these different scenarios, knowing that this is a constantly changing world, and 6 months from now, the answers are going to be slightly different as well. So with that, why don't we jump on in? So we're going to start out with, there's a couple things that have changed that do affect the math behind funded status and where you stand relative to meeting your liabilities over time. And please know I'm not an actuarial expert, but I will do my best here. So one thing that's come out is the Society of Actuaries has changed their mortality tables. And you don't have to make a change because of that, but most actuarial firms are considering adopting this in time or currently. It's a discussion that's happening in corporate boardrooms and public pension fund rooms around the country. The baseline is that people are living a little bit longer than everyone expected. That's a happy news for everyone in this room, not necessarily a happy thing for your liabilities, because that means that, of course, people are collecting pensions longer, and that you need to make sure that what we have saved up for that is going to meet those obligations adequately.
And I would just point out that PIBA has in fact updated our mortality tables just within the past few years, and included in that an assumption that mortality improvements would occur over time. So we're not working with a stagnant mortality expectation. So just so that you know, we are incorporating that into our evaluations already.
I think that's a very good point, because I think
Right.
one of the criticisms of the situation in Detroit is the actuaries are working on mortality tables that were 20 years old.
Right.
So that the thing was way out of whack and balance.
The last formal update from the Society of Actuaries was a 2000 table, and they project increases over time, so it's not as if they don't believe that people are going to live longer as time marches by, but it's been a little bit better than they anticipated, so that's what needs to be adjusted here. So for public funds, your actuary has some discretion in how they do this. They can even choose to use your own population as the example for mortality assumptions. So there's a lot of choices they have, so please know that this doesn't mean your actuary has to do exactly this. But for plans that are moving over to these 2000 tables to the 2014 tables that are being released, most of them are experiencing somewhere between a 5 and 10% increase in their liabilities. So it's not an immaterial impact. And for corporate funds, they have to decide how they're funding that over time.
Just a question, when you said you did update them, are those for the population in general, or is it state-specific or region-specific? How does that work?
Our actuary looks at two things. They look at the mortality tables, and they also look at experience in our system. We have an experience study conducted every 5 years, and we will have another experience study conducted next year. And so when they updated that last time, historically we've updated those mortality tables during that experience study which is done every 5 years. When we updated it last time, we made a conscious decision that we were not only going to update it, but we were going to build in a projection that it's going to continuously be updated.
Right.
So we built in a mechanism to take that into consideration. It doesn't mean that mortality that increase might have been slightly more than what we were already projecting, but our actuary will evaluate that, not only do a comprehensive study every 5 years, but every year part of the valuation tells us whether we are on track with that assumption or not. And the preliminary information we have from our actuary this year is that we did not have any, real adverse differences between our actual assumptions and actual incurrences.
Interestingly enough, there was a chart that came out here a week ago that indicated that life expectancy in South Carolina was below the national average. So that's the good news for the pension fund.
So it sounds like your actuary has been feathering in real assumptions, real time. So that's kind of your best case scenario. So it's probably more accurate of your actual experience, and it's been feathering in these improvements in life expectancy over time. This is important stuff. I remember very vividly working with a group of Catholic sisters who had a pension fund, and they live quite a bit longer than the average life expectancy. These things need to be factored in, particularly in groups that can be smaller sometimes. So just so you can all feel good about your life expectancy, here we're showing how it's improved. Just what we're looking at here on the vertical axis is the life expectancy for people that are 65 at that point in time. So, so today, if you're 65, anyone in the room here, we've got males at about 87 years and females at about 89. But 15 years from now, a person that's 65 could be expected to live nearly 2 years longer. So that has repercussions. The Social Security Administration has been upping their projections as well, which is shown on that bottom table. So it sounds like you've addressed this largely. So I don't think this will have the same impact on you that it's having on funds that perhaps are not looking at things as real time. The other mathematical kind of input when we're looking at how this all fits together is what are the outlooks for the investment markets? What can they produce? Is it going to be consistent with what you're expecting them to produce from an actuarial standpoint? Now, before I get into this, please keep in mind, again, I'm not an actuary. Actuaries do look at very, very long-term periods when they are making their assumptions. So we're looking here at a 10-year and a 30-year, but they look even longer, really, in terms of public pension funds are considered to be a perpetual being. So they're looking at very, very long-term averages. So people can disagree on this. Our assumptions when we've gone out in the market, we do this annually, the last time we did it was 12/31 of 13. Ours fall right about the middle of what investment managers, other consultants assume. But obviously there's a range of assumptions in there as well. Before I move on to this, though, I want to make sure I actually go back and cover the issue that you may raise, Mr. Chair, about actuaries and some of the pension problems that have occurred. I think, and I don't know Detroit's situation intimately, but what we've seen go wrong occasionally in the past is where actuaries and perhaps legislatures that didn't want to increase contributions to a pension fund have worked a little too closely hand in hand, where that actuary does not have an independent opinion on what contributions are appropriate to fund this pension fund prudently over time. So occasionally you'll see unrealistic actuarial assumptions, mortality tables that aren't adjusted correctly, things that are a bit antiquated. Within the rule book, yes, but perhaps very, very much on the, if you will, aggressive side to minimize funding. And that's where things can go wrong. Where you have a healthy relationship with an actuary who independently determines these things, gives their best thinking, and that contributions and such are determined on a formulaic basis and consistently applied, we don't see those problems occurring so much. And we have you use a very reputable actuary. We have no reason to believe that anything is inappropriate there at all. So, I don't want to draw any correlations here. Also, the actuarial assumed rate of return that you're using of 7.5 is actually, I believe, on the somewhat conservative side. I haven't looked at it in the last 6 months, but 7.75 was the more common average out there. We have seen people ratcheting down their assumed rates of returns.
Detroit just dropped theirs to 6 3/4.
Right. Now, that it also needs to reflect your circumstances and how you are investing. So, for example, if you were a closed pension fund and you were just meeting your obligations and you're primarily in fixed income, there's no way you should be assuming 7.5, and no actuary would tell you that. They would probably be assuming somewhere in the 4s. So how these all fit together is important, and it would be important to have an actuary come and talk to you about that. But I think the key issue is, do the actuaries ever have a motivation other than best thinking and meeting the needs of the beneficiaries when advising on things such as actuarial assumed rates of return and contributions? And I have no reason to believe you have anything but best practices here. So I think that's where it goes awry, and it's usually more at the municipal level than at a state level.
Well, I think just one statement on the assumed rate of return. The actuaries may opine on that, but for South Carolina, the rate of return is embedded in the statute. So
Yep.
that's not something that's purely in the purview of the actuary, although
Good
they
point.
do opine on that.
Right. And sometimes people don't take their actuaries' recommendations, because obviously when you lower an actuarially assumed rate of return, it means greater contributions, and that's not always a popular stance. Okay. So, capital markets assumptions. We update these quarterly. We have an entire group that does nothing but capital markets assumptions. They're looking at what are the visible elements that contribute to returns. So, for example, in the stock markets, you're looking at dividend yield, you're looking at GDP growth, you're looking at inflation. And then, is there any potential for PE expansion, or are we in normal ranges or contraction? And then we're looking at that on yields in the bond market, basically looking at what signals are out there that tell you where the markets are heading over the next 5 to 10 years. So how can you extrapolate that? It's very little market prognostication. It's really trying to be as concrete as we can be about this. Volatilities and correlations are generally historically observed with some adjustments that we make. So, with that said, this is how our capital markets assumptions have changed, and these are our 10-year assumptions. I'll show you our 30-year assumptions in a minute. These are nominal returns, so they include the effects of inflation, and that's an important distinction that we'll talk about in a minute. If you can look at where I've highlighted here in the yellow, this is how things have changed and where they've changed more meaningfully from 12/31/13, when we did your asset liability study using those numbers, and our most recent statistics through September. What you see predominantly, and I'm sorry, I should have included high yield bonds in this yellow category as well. These are areas where we've seen meaningful change, and they've all been meaningful declines in expected returns, predominantly across the bond segments of the market, not surprisingly given how we've continued to see interest rates drop. Notably, these are also areas that have experienced also some reductions in assumed volatility. We also show what they look like over time, and you can see on a year-by-year basis they do at times change meaningfully. I think probably something that comes across pretty strikingly is if you went back to 2011, we had an 8.5% global equity assumption. It's now down to 7.3%. And that's been because of the continued strong market. Dividend yields have gone down. So the other thing that I'd like to point out here is inflation. You assume a 2.75% inflation in your actuarially assumed information. We have 2.2 right now in the market. That's about a 50 basis points difference. That's important because when we look at this on a real basis, you'll see that really what we need to do is earn 4.75 on a real basis. So think that maybe these numbers are a little low because our inflation assumption does not match that of your actuary. We're a little bit more conservative on our inflation assumption. And in theory, inflation passes through all asset classes over time. It's not always how it occurs, but that's generally what we see. This is a lot of information. I apologize, the type isn't probably the greatest for everybody, but this is our 10-year capital markets assumptions. What I want to point out before we dive too deeply into this is if you're trying to hit 7.5% over the next 10 years, there's not a lot of asset classes that we believe on a base case basis are likely to produce that. So let's start out here at the top. In the equity area, we're close. We're at about 7.3. Emerging markets equity a bit higher. You go down, you really have to get down to private equity and infrastructure to get any other asset classes that are really reliably producing that. The bond markets are anemic. Obviously, we're in a very low interest rate environment with little room for continued decline in interest rates. They're anticipated to go up in the short term. That is going to have obviously a negative impact on bond returns. Equity markets have had an extremely strong run. While they may continue to do well, are they going to do anywhere near as well as they've done over the last couple of years? And alternatives, private equity, for example, have their appeal, but you don't want to be risking up the portfolio to make a gargantuan allocation to private equity just to try and reach for an actuarially assumed rate of return. This is over 10 years. This is correlations. I'm not going to go into that. And then here's 30 years. And again, what you see here, again, this is nominal. And you see a few things that are a little bit better. Global equity closer to that 7.5 at 7.4. Emerging markets. So you see a few more things in here in the equity areas that could produce. You get down here to broad hedge funds, a little closer at 7.2. Private equity infrastructure. But let's look here at the geometric return. Really what you have to produce over the long term is about 4.75 on top of your inflation assumed rate of return. That's a little bit more rosy picture. The equity markets producing in excess of that. The bond markets we still think are probably going to be anemic in that space, but that's not why you're investing in them. You see some things in emerging markets bonds that are somewhat appealing, in the alternative space that are appealing. So when we look at it from a real standpoint, over the long term, we continue to think that you can produce a 7.5% return or something close to it on a real base. I'm sorry, in the real basis it'd be 4.75. When you use your inflation assumption, I think that gets you closer to the 7.5. As a reminder, what did we look at earlier this year? And this is using what we had at fourth quarter of 2013. So this was looking at your targets. And then we use as kind of a straw horse this 60-40, no alternatives. And I'm not trying to beat up on this is a bad allocation. I'm just trying to look at it as a relatively simple portfolio versus what you have, which is a lot of diversification, a lot of moving parts in terms of your alternatives allocation. Is it worth all of that extra effort? What is it producing for you in terms of return and risk reduction? Which is why you would invest in it. When we did this earlier this year, you obviously are seeing a 10-year return that's better with a lower expected risk. So the Sharpe ratio, which again is return per unit of risk, is much more attractive. If you get out to 30 years, you're getting a little higher return scenario as we just looked at. Again, better risk return. This is how we looked at the world in capital markets modeling. It doesn't change much in terms of our kind of base case scenario. We're still looking at something very similar to that. And basically, when we're modeling all the different ways that your performance can evolve over time, we're not just looking at that expected scenario, of course. We want to include a lot of different economic scenarios. They aren't randomly generated. They are actually, they have logic to them. So how do they behave together? So these are two simple ways to look at it, and it's basically what are inflation and bond yields doing in low, moderate, and high scenarios? What are the weightings that we had in our capital markets assumptions? And then the same thing on return-seeking assets, or how equity markets perform in high, moderate, and low return scenarios. And you can see kind of how those shake out in terms of expected scenarios, where the extremes here, kind of a low inflation, high return seeking, which is kind of what we've had the last couple of years, that this has got a relatively low weight going forward, and the opposite of a high inflation, low equity environment has an equally low weight. I'm not going to go through all of this, but just as a reminder, what we tried to do here is to look at your contribution rates 10 years out, your funded status 10 years out, using these different types of scenarios. So you can see here, low growth, high inflation. Not a very pretty one, that's why it's red. On the flip side, high growth, low inflation, green, because everyone would like to see that. And then the range is important as well. So what we were trying to do here was to look at it using your current targets, and then if you were to just be simple and have 60-40, not do all this. So this is contribution rates. So in contribution rates, lower is better. You want to be more down here. Your worst case scenarios in this are low growth, high inflation. Not surprisingly, having a diversified portfolio in those types of environment gives you some better better outcomes. Still not appealing necessarily, but better outcomes. And then in terms of funded ratio, similarly, in protecting against that downside situation, you do better with a diversified portfolio than a non-diversified portfolio. Where you may not do as well, and it's about the same, but oftentimes in very high growth, low inflation environments, a simple 60-40 portfolio might outpace a diversified portfolio, as we've seen. And then this is, again, looking at your contribution rate and funded scenarios in various economic environments.
What is our current contribution rate?
For the employer or the employee?
I assume you're talking about combined?
Yeah, that's combined.
I'll get that for you because I don't have what they're increasing to July 1, so I'll get that for you.
We had that in our full study. I just don't have the slide in here. I'm sorry, Dr. Wilder.
8% for employee and 10.9 for the employer, I believe, for SCRS, the larger plan.
So it's approximately 19 plus or minus currently.
Right.
But it ratchets it up like 3 points, doesn't it?
No, it will go up slightly July 1 of 2015. And the preliminary results we've gotten from the actuary, we expected that the contribution rates were going to go up each year for the next 3 years until 2018. But based on the results for this year, the preliminary results, we won't be putting into place another increase in 2016. We delay a year, so there will be one for 2015, but that's based on last year's valuation. For this coming year, we won't be, the actuary's not recommending an additional increase because of the returns that were generated on the portfolio last year, as well as some of the changes that were made to the benefit structure in 2012. So those two things in combination have worked to mitigate that additional contribution increase that would be required for the following year.
Right, that's an important point. When we did our study, we were using actuarial information from the prior year. Your experience was better than expected in terms of returns, so that actually would raise all of these numbers in a positive way.
Susan, I have a question. How do you account for the substantial difference between the funded status of, say, I think the last figure I saw was for the Fortune 500 companies, on average, they're 85% funded.
Sure.
As opposed to public pension funds, which are substantially below that. Is that a result of, well, I think it's got something to do with the requirements for federal requirements,
Yes.
SEC requirements for funding of private pension funds, but is it also a function of bigger contributions, or is it largely the requirement of the greater, of the legal requirement to fund those private
Right.
pension funds?
The latter. When they brought in place the Pension Protection Act, it basically created, I'm simplifying a complex act, but it basically created a mark-to-market environment in the corporate defined benefit space that made rather severe penalties to delaying funding. So you had an increase in PBGC premiums. If you're underfunded, you have to do notifications to your participants that are rather alarming. So most corporate defined benefit plans have chosen to pre-fund heavily, at least to 90%. It has also created a disincentive for people to have defined benefit plans because it can be so lumpy and so big in bad markets. So what we've seen is a huge divergence in asset allocation practices of corporate plans and public funds. If we looked at it 10 years ago, they were pretty similar, some differences, but they're both return-seeking long-term investors. Now corporate defined benefit plans are basically looking to hedge their liabilities, and when their liabilities move, they want their assets to move. So they've started to favor long-term bonds because that more closely approximates how their liabilities move, particularly long-term corporate bonds. And then they'll have a smaller pool of return-seeking assets. So it's not uncommon, for example, to see a well-funded corporate defined benefit plan at 60, 70% in long-term bonds. So they behave very differently now. Now, also many of them have chosen to freeze benefits and start just offering defined contribution plans. Some have closed down their plans entirely. Some continue to have active plans, but that's more the minority today. So one could argue pros and cons of this. I think obviously funding and making sure that a pension fund is well funded is a positive thing. However, it's made the rules and regulations and penalties quite onerous for a lot of corporations, and they've chose to just get out of the business. And so instead now participants are relying on defined contribution plans, which can be great, but they don't provide that mortality kind of tail. So if you live to be 100, might you outlive your assets? You don't have a defined benefit plan. Is that backstop for an insurance policy? So I'm sorry, I don't mean to go off on a tangent there, but it's been kind of sad to watch, because I think there's room for both defined benefit and defined contribution plans out there, and the rules that have been put in place are very difficult for corporations to continue to offer that.
And Suzanne, have you seen any impact on the markets overall because of that movement on the corporate side from moving away from more of the equity-focused portfolio? So that's a huge amount of capital moving from
Right.
equity to more of a fixed income, especially with the closure of so many plans. So what kind of impact have you seen that on the markets overall?
Right. Interestingly, what ends up happening a lot of times is they'll draw back their equity after the equity markets have done well. It's kind of the opposite of what you might anticipate. The people draw out when it's doing poorly. Nope, they draw out when it's doing well, because your funded status is now increased, and you can, if you will, immunize a larger portion of your portfolio. So where we've seen it, we've not seen it as much on the equity markets. Where we've actually seen it has been on the long corporate side, because there's a finite pool of assets out there and a lot of people wanting those. So there's synthetic ways to get that as opposed to holding the physical bonds. It is something that, you know, if supply doesn't keep up with demand, there's going to be some challenges in investing in that marketplace. So we think there's some investment reasons that cause it to not be as efficient a market as it perhaps once was. That you have greater demand definitely today than you did 10 years ago for long corporate bonds, and a very low environment to issue debt, so that has kind of an interesting combination.
So, Susanna, just to kind of put this in perspective then, as far as public pension funds are concerned, to improve their funded status, we have two ways to do it: added contributions or market performance.
Mm-hmm.
Obviously, market performance is always questionable. So over the long term, obviously, greater contributions would be a more significant factor. Is that a reasonable I mean, obviously, we'd like to have both.
Yeah.
But
Yeah, we'd love to be wrong on our expected scenarios, but under a very low inflationary environment that's had a long equity run with bond yields where they are, there aren't a lot of places to get excited about for consistent, reliable beta. So yes, market returns are expected to be less than they were 3 years ago, 5 years ago. And that would mean that contributions play a larger role than they normally would. So where are we on this economic environment of ours? We have a group of about 15 people that look at, mostly economists, looking at what we call our medium-term views, which is not trying to be so much tactical, but rather saying from a 1 to 3 year standpoint, what are the most attractive areas to be in? So basically what I just went through causes us to rank order them this way, that alternatives, and when I say alternatives, I mean hedge funds, private equity, real estate, all the esoteric stuff is our most favorable area, followed by equities predominantly. Well, we think both non-U.S. and U.S. are attractive there, and then bonds, not surprisingly, are anticipated to be kind of the least favorable in the 1 to 3 year period. This is not a 30-year period, this is short term. but it has ramifications for how we choose to position the portfolio. And before we get into this too far, I just want to make sure we're all clear on the distinction here. We're talking about what is a good strategic asset allocation that's going to do well for you in good times and bad. There are tactical things that staff does, as Herschel was discussing earlier. You've given many of your managers the optionality to move to where they see value. So, for example, your tactical asset allocation managers, your hedge fund managers, even global equity, they have this latitude to try and find attractive opportunities. So you're allowing them a bit of latitude as well to try and navigate the short-term vagaries of the market as well. If you ask us where we think the most attractive elements are in the equity markets, it'd be topped by large cap and emerging markets equity, with small cap being really the least attractive. In fixed income, we like local emerging markets debt as opposed to U.S. dollar. We do like TIPS over treasuries right now. And government bonds, non-U.S. bond, and long duration we think are probably least attractive in the short term. And then on alternatives, we do like hedge funds and real estate. You'll notice private equity is not on here because this is a 1 to 3 year view. We don't include things that have long lockups. So when I'm talking real estate here, I'm talking more core real estate, REITs, that sort of thing, rather than value added and opportunistic. We don't think you should try and time over short-term periods movements in or out of private equity and long-term real estate. Those are things we think you should have long-term allocations to.
Just in that prior chart,
Yep.
where you had the one just before that, oh yeah, EM local debt as a favorite position. I guess that would assume a weaker dollar rather than a stronger dollar?
Right, right, or at least a flattening
Over the next
dollar.
1 to 3 years?
Yes.
Okay.
Okay, so what does this all mean? Let's pull this all together. So our group in the UK and the US got together and really looked at what are people nervous about in the next 5 years. We have a lot of scenarios here. For that, I apologize. But keep in mind, most of these are things that people worry about, not things that people would like to have happen. So most of these scenarios are negative. It doesn't mean that our expected scenario is negative, but as we go through it, it might start to feel that way. Because I think of the 9 scenarios we have, perhaps 7 of them are not very favorable. Because people worry about spikes in inflation, emerging markets having problems, big political problems in the Middle East causing negative supply shocks to energy markets. These are the types of things people worry about. Are we over-accommodative in our monetary policy, and that's going to cause problems down the line? So we're trying to look at what could be the impacts of that over the next 5 years, and how would your current portfolio behave in that, again, versus this kind of straw man of a simple 60-40 stock bond mix. And try and show you how the numbers look. You're going to see a lot of 5-year returns that aren't 7.5%, I'll tell you that, because we're looking here at negative scenarios, not positive ones. Okay. So here are the scenarios. The optimistic one that everyone would love to see is blue skies, and that is a nice economic outlook going forward, moderate to low inflation. And then we have 3 low demand scenarios in increasing order of severity, starting with just growth being kind of bland, but not falling into recession, an obvious recessionary environment, but one that we have a recovery afterwards. And then finally, what we call black skies, which is even worse in 2008. So we're talking very deep recession that does not have an immediate recovery. So what are kind of the repercussions of how you might behave in these? And then we're looking here at some various topical scenarios. High inflation, which people worry about a lot, so that's energy and commodity prices pushing everything up. What would you need to be in to do well in that market? Rising yields, folks just kind of losing confidence in the bond market. There's been a lot of outflows from those markets. That continues and people just aren't reinvesting. What are we going to see? Ultra loose monetary policy, so not causing immediate disruption, but eventually, if we're not tightening, is that going to cause market performance to suffer? What if we have something bad happen in the emerging markets and we see a strong divergence between the developed and the emerging markets? And then finally, stagflation. And here what we've modeled for stagflation is a supply side negative shock in energy that leads to high inflation. Okay? So I'm sure you can come up with something we didn't think of. But I apologize in advance. I will try to go through these quickly, but there is a large number here. But what we wanted to try and show you is how this moves through. So here's, if we were to look at this in terms of inflation and real GDP growth, you can see how everything shakes out. And I should point out we have this central scenario, which is our expected economic scenario over the next 5 years. Obviously, everyone would love blue skies, lots and lots of real GDP growth without the associated inflation. We've got some rather ugly inflation scenarios up here, and then obviously quite a bit of low growth environments here. If we switch our lens to the impact that it has on Treasury yields over the next 5 years, and again, GDP growth here on the horizontal axis, again, our blue skies is always going to be your most attractive. We do see yields going up quite a bit under several of these scenarios, and then as you get into the poor growth scenarios, you rarely have anything looking very favorable. And again, our central scenario where that lands. And then finally, equity returns, what we can all probably relate to the most easily. Looking at, this is annualized 5-year equity returns. You can see in the black sky scenario, we're looking at an annualized 5-year return of negative 15. That puts the financial crisis of 2008 to shame. So hopefully that's an extremely low scenario. And then obviously blue skies, which everyone would love to see. But a rather tight clustering here in the middle. So here's our central scenario. Basically here you're going to see this in all of these. So here's the macroeconomic factors. So how does inflation fare? Up about 2%. How is real GDP growth? Up about 2.5%. And then we've used here this kind of liability hedging. This is more for our corporate clients, but it gives you a sense of where bonds are going, long corporates, long treasuries, long tips. And then all the different asset classes, looking at the various levels of risk assets. And so hopefully folks can read this, but we start over here on equity, U.S. and global, high yield, bank loans, EMD here, real estate, commodities, hedge funds, private equity, infrastructure. Okay, so think alternatives over here, fixed income here in the middle, equity over here. So this is how you look versus, again, that 60-40. You're the red bars. And if you want to look just at one plot point, look at this one. So wherever you see the red bar being higher, that means that you would have done better. We're looking at a 5-year scenario of about 6% out of that, of your current, versus 5.4 out of a more conservative 60-40. Again, this is 5 years. Blue sky. Everyone loves this one. So the blue skies are the red. That central one we just looked at are the blue. Okay, so just to change your perception here. So how is that different from our central scenario? Well, not surprisingly, more growth. Inflation's a little higher. But I think what people get most excited about is over here, that you've got a lot of strong performance in the equity markets versus that central scenario, and things such as private equity, infrastructure, hedge funds all fare well also. In that environment, you would also do well. You'd be looking more at a 5-year return of about 11%. But interestingly, even under that, you do better than a 60-40 portfolio, predominantly because of your private equity allocation being a rather meaningful component of your program. Below trend growth, so we start to get into these negative scenarios. And here what you see, of course, is growth being quite a bit lower than our central scenario. Inflation also being a little bit lower. But here's where it starts to hurt a bit. So we're seeing poor equity returns, poor bond returns, poor alternatives returns versus the central scenario. So a low growth environment is really hitting all of these asset classes. There aren't a lot of places to hide that look meaningfully better. Under that scenario, again, your policy does do better than a 60-40, but it's quite an anemic 5-year return. Now, when we see here, what you do see is basically a poor first year, but then going into somewhat more robust returns in the years that follow. Recessions, not surprisingly, is a somewhat less, a nastier version of what we just looked at. Again, poor GDP growth, lower inflation. Really, treasury bonds are your one, long treasury bonds are your one area of solace in those types of markets. nothing performs well. In that environment, you're looking at a flat return. Now, what we do assume as a reminder here is that we basically go into recession in this year, but then there's a recovery. And then the black skies, worst case scenarios. Here looking at actually negative real GDP growth, flat inflation, treasury bonds, your one place to hide. We'll talk about fixed income structure later, but I think some of these more dismal scenarios are a good kind of reminder of why we do have a conservative fixed income component, albeit a relatively small one, but to protect you. A lot of people in 2008 were surprised to learn their bonds didn't protect them very much because they'd risked up the portfolio. Everyone had core plus bond portfolios that had virtually no exposure to treasuries because those weren't earning great returns. Why would I be in such a thing? Well, obviously, your more conservative bonds are your retreat to safety. This is one of the few in which you earn actually a worse return than 60-40, but not meaningfully so. But it's just a horrible scenario regardless of where you are. Okay, so now we get into the topical scenarios. High inflation, people are basically saying, what happens if we start to get in a more inflationary environment? Not surprisingly, what does well are things that you would consider to be real assets. So obviously here we've got a nice, not nice, but we've got a high inflation scenario. Real GDP growth isn't necessarily that much higher. TIPS, not surprisingly, do quite well. You have things like commodities, infrastructure, real estate, some of the EMD areas doing quite well, and then your stock markets not doing as well. So this, again, getting back to portfolio structure. You have a lot of things to protect in a real asset framework within your program. They aren't necessarily all categorized as real assets, but you have things in the real estate component, in your commodities, within your hedge funds. Obviously, any tips are going to be protecting you in this sort of an environment. Because you have that more diversified type of structure, this is one where you do quite a bit better than the 60-40. Again, not necessarily a pretty picture, but protecting more in these downside scenarios. Rising yields, folks starting to lose confidence in the bond market. You see real GDP growth being a little bit less, but really where you get hit is on these long bonds, not surprisingly. We would not anticipate equity markets to do very well in this. So this is another one of those kind of ugly markets that don't really do well for anyone. Here we would anticipate that your returns, again, would be comparable to what you're looking at for a traditional portfolio. We're getting to the end. Ultra loose monetary. We just have a few more. So this is again, basically in the short term, this doesn't hurt you, but in the longer term, that we start to see inflation creeping in and start seeing it impeding our GDP growth. Again, this is a type of scenario where you're better protected by real assets, such as real estate, commodities, infrastructure. You wouldn't anticipate the equity markets doing as well. And again, better results out of that. So you can see in the short term, it's not hurting us, but that over time it really could cause some dampening of the equity market returns. The last two, emerging markets crisis, really a bifurcation between the emerging and developed markets. We see this coming predominantly, potentially from China. Not surprisingly, this materially hurts emerging markets' debt. Has a slight impact that's negative on the developed markets because of the export issues that could arise. And in this scenario, we would anticipate you earning a comparable return to a 60-40 portfolio. Our last one is stagflation. Basically, slow growth, high inflation, because of a probably military action in the Middle East that would cause a negative supply shock in the short term in the oil markets. And hopefully over time we have a little bit more self-sustainability in that, but this would be more of a short-term choice. Not shockingly, that causes a big jump in inflation and perhaps a decline in real GDP growth. And you can imagine where that comes through. Commodities, real estate, again, these real assets that you have an allocation to. And that helps you as well. So I wanted to close that section with just, we've gone through a lot of dismal scenarios that probably are causing everyone to be a little bit nervous. We continue to think the central scenario is really the most likely. But if you were to ask us to score from the most likely to the least likely of these scenarios, I thought you might want to see that. So we see in the short term the rising yield scenario as being probably one of the most likely of these somewhat unlikely scenarios, followed by ultra-loose monetary policy and a possible emerging markets crisis. You might be interested to see that blue skies ranks right in the middle, and that black sky scenario that no one wants is the least likely of them all. We do model that more as a bookend, just to kind of show if everything went, excuse my language, to hell in a handbasket, what would we end up with? So again, is there any single thing you can do in the portfolio that'll help you in all of these? No. I would say that if you didn't have long treasuries, if you didn't have real assets, you need to put those in the portfolio. If you're relying heavily on equities instead of the other asset classes to drive your returns, you need to put other things in the portfolio. You have a well-diversified portfolio. The question is, are any of these that you would try to protect materially against are going to start to incur drags on your returns? So let's think about long treasuries, for example. That's going to be an area that we can almost guarantee will do poorly in the next couple of years. However, there are economic environments in which it protects you massively. If you put a lot of money in that, you obviously are dragging down your portfolio return and causing other forms of risk. So it's trying to balance all of this together, and I wish I could tell you there's a magic bullet, but there isn't. The good news is you have a very well-diversified portfolio that protects you to a better extent than a simple portfolio in virtually all of these scenarios. And that's what we say here. So why don't I stop there for a second and see if there are questions? I have 10 more scenarios to show you. No, that's it. Sorry, there's so many. Our economists got carried away with themselves.
Hey, Suzanne, this is Curtis.
Hi, Curtis.
I'm trying to square that, what we're really looking at here is the 3 to 5 years. That's what seems to be what bothers us the most. And yet, later in the day, we're going to be talking about how we tend to solve that, and that's by putting money into real estate, which certainly won't be mature in 3 to 5 years. It may not be barely even started, since we're fundable ones, be developing property, all that kind of stuff. So how does that help us with this 3 to 5 years?
Yeah. Well, real estate does help you. The implementation of the real estate portfolio we'll talk about a little bit later. But what we see, and I didn't go into this, but for example, in real estate, what we think is attractive right now, and we see that as one of our favorite alternative areas, is particularly if you invest in value added, so things that have got a little bit more leverage, maybe a little hair on them, and you're improving them. And being selective of which markets that you're in, that can be a tremendous source of value added in the next couple of years. And it doesn't have the volatility elements associated with traditional stocks and bonds. Can produce some nice income depending on how you're investing. But actually, I believe we're looking at feathering that in relatively quickly. Right. So I think it will help you. It doesn't instantaneously give you exposure because you are building the portfolio, but it is something that we think is actually quite an attractive source of value added. Also, what ends up happening if you invest in properties that you've improved, perhaps you choose to sell them, but perhaps you choose to hold them. And once they're core, high-quality, income-producing properties, that's something that helps you in an economic downturn as well. So there can be some nice elements that help protect in that type of a portfolio, but we'll get into the specifics when we talk about the managers as well. But it's a great point.
But isn't there?
Yeah, if we're looking at, if we were to max out both those real estate, that's $900 million. If we're going to get $900 million in the ground, and I don't know, maybe we're prepared to start tomorrow. But when I read the Greystar, and again, I don't want to litigate those issues yet. I'm not trying to. I just want to make sure I'm clear on this. That's a lot of money. If we're going to be building, buying all these things, I just can't imagine where we're going to have. Let's just say we've never put that kind of money in real estate in the ground in the past, and with single accounts, with us having a negative veto and the back and forth. I just can't see what's going to be meaningful to us. I'll be quiet, because, I mean, I'm sure you're right on these things. I just can't see how that fixes this 3 to 5 year problem.
Yeah, no, it's a great issue, and I'm sure we'll talk about it as, you know, how it's going to be implemented and how quickly they believe they can invest up the portfolio.
And I
Well,
think,
isn't there one other aspect of this? I think perhaps what the treasurer is perhaps assuming is that if we invest in this real estate, that this is all on the come, when in fact, a lot of the real estate that we're going to be investing in will be income-producing real estate. In other words, whether they be apartments or mortgages or whatever, these investments have the ability to throw off a significant amount of cash. So it's
Well,
not.
if you start building one today, how long does it take you to get an apartment complex up?
Well, yeah, but Curtis, some of these things that we're going to be looking at are already in existence. They're not all construction.
Correct.
right, and so the point too is a very good point, and it comes down to the timing of cash flow and getting capital to work. And we also know that in commitment funds, that there is a call down investment period and then there's a harvest period. And so you start getting money back sometimes sooner than you can actually get money to work. So one of the advantages, and Eric will get into this in a lot more detail, of having a fund of one structure is you're not forced because of a contractual term to sell out of a property as if you're investing in a commingled structure. So here we can actually have much more longer duration assets to help offset those things for when you do have inflation impacts in the future, so you're not racing and trying to catch up. So it is a longer term strategy, and it may not be fully implemented within the next 3 to 5 years, but it's a path we think is worth going down, so you don't get caught in these strategies. But the other part of it is that inflation aspect piece of it too, which is real estate is one part of it, but then also tips and the commodities piece, which we can allocate to, and those are very, very liquid. So we can allocate there fairly quickly.
And even through your overlay, you can do
And
that
the
very
overlay.
quickly.
Right.
But, oh, please.
Do you have the staff currently to handle real estate, or how will that be staffed?
So we have 2 people in real estate right now, and so we are not taking on real estate operations. So we are not going to be an operator. We're going to be investing in a customized solution where we have more rights than a typical LP, so we have a lot more control, look through, et cetera. We also have a veto right basically on the investments. If it's one, we already have too many multifamilies in a certain market, we can actually redirect the portfolio, so you have a lot more control. We are not going out and doing the underwriting. We're not sitting down and being an operator of a property. That's what we're outsourcing.
So how does that decision-making work? Does that come through you? Does that come to the commission?
So
what are the decision-making?
So the negative consent is through the CIO. So the commission would approve to do the strategy, just like you would approve whether or not you invested in TA's commingled fund. We approve whether or not to do a fund of one with TA. Then what we do is we reserve the right through that negative consent to veto properties if we'd like to. And that would happen at the CIO level.
And it's certainly not anticipated that this is all developmental properties at all.
Yeah.
This is a well-diversified mix. So if you were looking at something that was, we're going to give money to them and they're going to go out and start developing properties, that of course would take quite a few years and has a fair amount of risk associated with it. That's one of many strategies they can use, but it's certainly not the core component of what they'll be doing for you.
And so
Is it owner operator?
right, yeah, I think they're definitely the largest in the U.S.
Yes.
Maybe the world, I'm not sure.
Yeah.
But I think, Peggy, there's certainly some valid points with respect to the structure and the implementation. I know Eric will get into a lot more of that here in a little bit as well. But we're actually trying to find a way that we can actually have longer duration assets, and we're not forced to liquidate a property that we'd want to hold on to for, say, 15 years.
Right.
But we still serve as an LP with much better rights and protection than investing in a fund.
Right.
So that's what we're trying to structure.
Great. Shall we move forward? These are great questions. I know we're going to go into it in greater depth on the real estate, so I don't want to steal the thunder.
Just a couple of comments and
Of course.
a question on your sort of scenario analysis, right? Because, I mean, everyone sort of shows the correlation table and then they get off of it as fast as possible because it's a point estimate, right? And yet it's a critical point, right?
How do they
We're looking
move
at
when things
5-year
are bad?
Scenarios with 10-year assumptions, So if you look at equities to short bonds, short-term government bonds, right, you get a long-term correlation of like zero, right? Because you've run it out over enough time, but over, shorter horizons, it's not only there, it's negative, and it's a strong negative. And I think and that's probably one of the most important correlations, right? Because Fed starts hiking policy. I mean, you think about 99, hike, you get a turn down, 2000, 2002, 2004, 2006, hike. Nobody's paying attention that the relative value of short rates is improving. Market rolls over, right? 29 crash, hike, rolls over, right? Japanese crash, hike, it rolls over. So I mean, that's a real important correlation assumption, with some leads and lags, right? That over long periods of time just gets sort of minimized, but it absolutely impacts the way you economically model, because it's one of the primary drivers of the business cycle.
I'm glad you raised that. So if you just naively assumed that, hey, this bad scenario is going to happen, these are our expected returns, maybe I jack up the standard deviation a little bit, but I leave the correlation assumptions alone, how is that going to behave? We all know that's going to be garbage, because in many economic scenarios, you see increases in correlations between assets that traditionally have not behaved in lockstep. So the reason we got all these smart people debating this stuff, if we just did that, we'd need less people. They debate how correlations are going to change as well. So when I showed you the correlation table earlier, that's our base case. When we're looking at some of these more extreme scenarios, you see very big differences in those correlations. So they're trying to ask themselves, when we've had this happen in the past, what have correlations done? They don't always behave the same, even in similar circumstances. But what do we think might happen today? So there's a little bit of art, a little bit of science on that, but we definitely adjust the correlations for the differing market dynamics in crisis situations, because those, fear drives everyone away from return-seeking assets. We saw that. You couldn't even do cash management well in the crash at its worst. So we're trying to, look at that as well. Different people might adjust it differently, but we do try to adjust for that.
But I think, again, we should focus on the fact that having a diversified portfolio obviously has its disadvantages in the kind of equity markets that we saw here recently. On the other hand, the fact that we have had more frequent disruptions in the market, 94, 2002, 2008, than we've had historically, mitigates towards having a diversified portfolio to protect you against the unknowns, the things that may happen, the frequency of this occurring. So I think that, as you've described it, is very accurate.
And thank you. And I think the other thing to keep in mind, we didn't talk about so much here, is when these dire economic scenarios do potentially happen, how capable are employees of increasing contributions? So, obviously we don't want those increasing any more than they absolutely have to if we have a very difficult economic scenario. So one thing this portfolio does is tries to minimize to the extent we can, while still creating a good long-term return assumption, how you get hit when things do go sideways or poorly, and that the state and the employees are not in the situation of having to up contributions more than absolutely necessary in a difficult economic environment. And we all saw that in 2008 is unpleasant. Nobody likes that. So how do we make sure we mitigate against that downside scenario as well? Okay. Shall we go forward? So possible asset allocation changes. So we have seen a decline in your expected return, not because of you, but because of the capital markets. Everyone has seen a decline in their expected returns over the last 2 years, unless they're using some unusual numbers. And the basic issue is that when you think about the core drivers of the capital markets, the stock and bond markets, the stock markets have been going up, up, up. That's great. They don't go up forever for no reason. They have to have growth behind them. They have to have a good engine behind them. And then bonds obviously have dropped in terms of interest rates over time. So, the other question is, how do we get to that 7.5? Now keep in mind, everything we've shown you thus far is what we would consider market returns. This does not include any sort of alpha that you add over your policy. And over time, you have been able to do that pretty well. Hedge funds, private equity, real estate. We would not invest in these asset classes if you didn't think you could add some alpha over these assumptions that we make here. So that's something that's not accounted for in these statistics and hopefully is a positive. It's a very difficult thing to model, so we don't model it. But keep in mind that is included. And also, as I mentioned earlier, this issue here on your inflation assumption is 2.75. Ours was 2.2. You're about 50 basis points higher. If we move everything up by 50 basis points to reflect that differential in inflation, you're much closer to that 7.5%. So if we compare your...
But why is that meaningful to us, though? As investors, the actuarial return can't dictate what we do. I mean, I know it's always been that connection.
Correct.
And people expect to control. But I brought this up to the actuaries at the time when we all changed our, both the actuarial and our assumed rate. And everybody made clear to me, it doesn't matter, doesn't matter, doesn't matter. And then all the things I've been told over the last 3 years, it didn't matter. They're now all important. And I don't understand all this. And this is why I keep asking these questions. I hope I'm not out of place.
No, absolutely.
It's just, I don't see how you can say, well, let's add that 50 basis points.
Okay.
That's just made up 50 basis points.
Yeah, no, I wouldn't just tack on 50 basis points. So let's say if the actuary saw the world the same way we did in terms of inflation and said, okay, 2.2 is the right number, they would be unlikely to be using 7.75 as your actuarially assumed rate of return. They would probably be dropping that by about 50 basis points. So normally when actuaries drop their inflation assumptions, they drop their actuarially assumed rate of returns as well. So all I'm trying to do is just kind of level the playing field. So but you're right, this is our best thinking. They have to provide their best thinking. You should not try to manage your asset allocation around what the actuary is using for their number. We're just trying to show you where there may or may not be disconnects.
Yeah, they're not. I mean, they're not taking into account what we make. They're taking into effect what has to be paid to make Peggy's shop work. And so I think when we link these two things together, we need to be careful. And I just go back to all these things. There was a time when if I said, "Hey, we had a bad quarter," things aren't looking so good, we got to look at our AIP. Everybody would laugh at me. Now, of course, 4 months from the last time we passed the AIP, we got a change. And everything's like a 3 to 5 year problem. We're going to take something that's probably, I talk to 4 or 5 real estate people in New York, and they say, no, you don't get meaningful returns back in 3 to 5 years. And now we're talking about this inflation, like it's meaningful to what we do. I just don't see it. I don't understand it. I'll be quiet. I don't want to interrupt you again. I just wanted to say that, and I'll just let it die if that's all right, because unless you feel like you need to say something with it. It just doesn't jive with what I've been able to research and experience.
Okay, you raised some good issues. Let me try to address them. So first of all, I agree with you 100% that actuaries should be doing their job separate of this commission. However, they're going to be looking at what your asset allocation is and asking themselves, is this assumed rate of return realistic? So I would never suggest that you change your asset allocation to meet an actuarially assumed rate of return. That's like getting into this death circle that doesn't make any sense. However, it is important to say, how do those two things align? Are we looking at an environment that can produce that? The reason we're looking at 5-year returns for these modeling was because honestly, that's about all we can model under these economic stress scenarios. You go out any further than 5 years, it gets really ridiculous. They're just not meaningful numbers. So you shouldn't be making investment decisions based solely on what you think it's going to earn over the next 3 to 5 years, but you should care about it as an entry point. We're looking at long-term returns here.
A strategic policy versus tactical.
It's really important to realize that long-term, and with all due respect to people who make 30-year assumptions or 10-year assumptions, they're almost meaningless.
Yes.
It's guesswork at best, and very poor guesswork. And if you go back to what a lot of very smart people and economists talked about where the 10-year was going to be, 10-year Treasury was going to be at the first of this year and where it is now, they're virtually all wrong with very few exceptions. And that was only 9 months. So when you start talking about 5-year projections or 10 years or 30 years, you have to take them with a great deal of skepticism. And
Yeah, I agree with you 100%, Mr. Chairman. Thanks for saying that. But let me remind you how I had my head beaten in by the Senate because we had 10 and 30-year projections that showed these great returns. And I kept saying, well, 10 years, 30 years, a lot of firms don't even do 30 years. I mean, it's just, what I'm seeing today, and I really wasn't going to say anything back, but I do appreciate what you said. What I'm seeing today is everything that we kind of argued over in the past, it's now flipped over. And I'm okay with it because I have a lot of trust in you guys, no matter believe it or not. I vote no lots of times, but I just think it is important that we kind of look at this stuff and say, well, geez, just a year ago, so many of our precepts were different than they are now. And so, it's just important for me to say that. So again, thanks for the time to say it.
So I think, let me just pause and reiterate probably the most important element to all of this. The investment program that you have right now gives you a lot of the upside when stock markets are doing well. It's not going to give you as much as someone who is more heavily invested in equity, but you're going to get most of it. When we have strong one-directional markets, you're not going to do as well as your peers. We all know that. Hopefully that's not a surprise to anyone in the room. When we have any economic disruptions, and we've tried to show you a lot of different scenarios here, and many of them are not pleasant that anyone would wish on us, but you need to be protected. So what we've created is a portfolio that is more efficient, return per unit of risk, and that protects you better in a wide variety of downside environments, including the equity market giving up, but also inflationary environments, emerging versus developed markets doing poorly, et cetera, et cetera. And that's what we think is important, that we don't want to just rely on expected scenarios, that the stock market's going to go up and we just should have more of that to meet our needs. You need to make sure that you have a well-diversified portfolio that meets your needs in all of the markets that we can have. And that's what we've attempted to do here. So I think it's a long-term discussion. Trying to get the number right in advance is just not going to happen, but we can show you how we believe those things are going to evolve. All right, so let me see, was there anything else I wanted to do here? So we do show some different policy portfolios here, but now that we've all poo-pooed 10 and 30-year assumptions, I'm not sure you want me to talk about it. But sometimes people say, what could we do to increase our expected return? And should you have a question like that, this is what we would look at. I think, though, you immediately get to this discussion, which is here is where we are currently. Here's what you've got in alternatives. And alternatives to us here is private debt, private equity, real estate, and this is your target allocations, commodities, hedge funds, anything that's not traditional stocks and bonds, long only. And then how much is illiquid? To get a higher return, and here's our projected nominal returns from where you are. In almost all these cases, you have to increase alternatives or illiquids. And in the discussions we've had over time, I think where you are is about the right spot. But if all you cared about was trying to oomph that return a little bit more, that's where we would suggest you need to go. And probably the areas in which it would have to happen the most, are in private equity, which is currently 9. And as you may recall, that's one of the stronger performers. And a bit in private debt. So we're talking more illiquids, more long-term lockups. You do have the liquidity capability to do so. However, just from a comfort standpoint, that may not be the right answer. And I think that where you are is a good place to be. Sometimes people will jump to, well, the bond market's a loser's game. Why am I in that? I think we've hopefully demonstrated that there are markets in which even a low yield environment, bonds will help you. So right now what you have is 3% in global fixed income, 7% in pretty conservative core U.S. fixed income, and 5% in cash and short duration. We recommend that you maintain that. That's only 15% of your target. And as we saw earlier, from a risk budgeting standpoint, it's not having a huge impact at that. Where it will have a huge impact is on tail events. So that will protect you a bit more in some tail events. We're going to talk more about fixed income structure, I believe, in later today,
yeah.
because it involves manager-specific issues. So we'll address that more.
Can I ask a question there?
Of course.
I mean, this kind of pushes us into that uncomfortable thing, right? I mean, we saw on that risk chart earlier, right? Even with that big of an allocation, we don't get much oomph, right? So back to, does it actually help in that risk scenario, right? Do you consider things that give that more leverage, right?
Yeah, it's an interesting point. Mike and I were actually at a conference, and that was actually one of the topics, and going back to more of a balanced risk approach, an all-weather approach that we hear from Bridgewater and others as well. And there are a lot of plans either incorporating a risk parity type approach in their asset allocation, which we've had for quite a while, or they are actually moving their entire plan that direction. With that said, I think that leveraging at a 2.3, 2.4 yield on the U.S. Treasury right now, if you do get a rate rise, then that's going to be painful. I think one way that we could possibly look at that, as opposed to leverage at this point, because of where rates are, is we'd have to look at the numbers, but are you better off actually extending duration, going out a little more on the curve? The other component to it is how you might better get a little more protection, as we saw also in one of the earlier slides, is that if you take a look at developed sovereigns, the U.S. is the best game in town.
Right.
At multiples. I mean, if you look at Germany at 80 basis points, Japan at 50, Switzerland 50, does it make sense to possibly consider either from a tactical implementation perspective or more from a strategic policy perspective, moving that 3% of global fixed into the U.S. markets? Because I would tell you from a tactical perspective, having an allocation to get a higher yield, and if I think about less sovereign risk, I'm still thinking the U.S. is a much better trade, if you will, from that aspect of it. Right. So I think there are a couple ways. But then to your point of, do you get in a drawdown scenario, is this enough to help balance out the returns? Probably not as meaningful, to your point, if it was a much larger allocation or even levered. With that said, it still will provide a tremendous amount of liquidity. So I'd like to have at least 15% from my perspective on that, because we still have about $2 billion of unfunded commitments, and annually we pay out about a net difference of employee contributions versus the distribution of benefits going out. The net difference is about $1 billion. So we still need a decent amount of liquidity.
Right.
So, but I'm not sure if that answers the question or if there's a different thought.
No, well, I mean, we've had Goldman in before, right? I mean, on different options trades that you can put on, you know, levered structures. So not necessarily leveraging the assets, but maybe taking some of the assets and putting them into a leveraged structure, right? That gives you more bang in certain scenarios.
Right. We can certainly analyze it. Oftentimes the drag, either the insurance cost, if you will, is sufficiently punitive that it kills your upside enough that it's not worth the downside likelihood. But we could certainly look at it. It just really depends on what's being proposed.
Yeah, I think too, with volatility being lower, exploring possibly buying puts for certain assets, and even actually buying calls for possibly on longer duration treasuries, things like that could be part of what we could incorporate.
Right.
Yeah, I mean, the scenario that probably upsets the market is central banks do something unexpected, right? So that's probably an unexpected short rate increase, right? I mean, that's the one that catches the market off sides.
So, well, for short rate, yeah.
Right?
Yep. Yeah.
That's where we're likely to get to.
Yeah.
Yeah. Over the next 12 to 18
years.
months, we're going to get, short rates are going to go up.
Right. But if they do so in an unexpected way, that's what's going to catch everybody.
Right.
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 So, and we have, starting 3 years ago, started building in some of the more floating rate, the bank loans, things like that. With that said, there's still about, because those have a LIBOR floor of roughly average of % right now, we call LIBOR 25, you still have about 75 basis points that rates would have to move up before you start having that impact there. But there are there's the shorter duration component to it that will adjust much faster. And then we do have some floating rate, depending on just how fast rates go up, that can actually provide some of the protection. And I think, kind of looking at why are the short rates going up? Is it driven by growth or inflation? I think that too will be part of, looking at the presentation here, thinking about we probably do want to find more inflation protective type assets and lag in. Now, we do have a 3% target to commodities. We're slightly underweight. They have sold off significantly, but I think that with the ranges, we can actually go up to, I think it's 6%. So we do have some flexibility with the current policy to actually, build in tactical positioning as well.
Alan, just, you probably know, but we made over the last couple of years some very interesting investments in middle market lending. And they're structured, I mean, they're beautiful, really, in the way they're structured, because they're all floating rate. I think it's on like, most of it's 6 months LIBOR, I think, or whatever it is, let's put it short.
Right.
And the way it's structured is, we're very high in the capital structure, and the money comes in, we're the first guys in line. So, and the returns on those probably will be in the mid-teens. So, in essence, that's one way, I guess, we can help us, that can help us in a rising rate.
Exactly. You've got hedge fund managers doing that, private debt managers, some of your credit managers. So when you ask yourself, how do we address these challenges, and just, this is my last slide, it very quickly gets you to the long-term strategic versus the short-term tactical. And how are you addressing the tactical without being overly knee-jerk on the strategic, right? So it's setting up a structure that's sufficiently flexible so that you have things that staff can do to add value, operating within a range, working with overlay managers to quickly affect market exposures if we have those opportunities. And then I think a big one is making sure that you are using broadly diversified managers in categories where you believe they can add value. So hedge fund managers is a classic example. If you're using folks that can take advantage of those sorts of opportunities, or explicitly hiring managers in that space if you see it as an attractive area. Global managers, global tactical asset allocation, and risk parity. Those are all things where the manager is in the position to be pulling those strings when needed, and probably has the best on the ground knowledge. Now, of course, they could be wrong. So that's the trick with broad mandates, is you want to only use those where you have a lot of confidence the manager is going to be able to add value. So we think that goes hand in hand with being smart about where you're choosing to use active management versus passive or low-cost market exposure. So combining those two, and Herschel talked earlier about reducing the number of managers, those things go hand in hand. We're not using active management where there hasn't been persistent value added. But we are using it for your alternatives areas where they can be more flexible, take advantage of unusual structures to try and protect their downside and take advantage of market opportunities, such as all of the credit facilities being kind of pushed out of banks' books. So I think all of these, when I say possible approaches to addressing challenges, these are all things you're doing already. So we were trying to really find anything else that you could be doing. The fixed income component we'll talk about later. Honestly, what you have right now, tweaking that one little bit to one side or another, as Herschel was talking about, doesn't really do anything to your expected return, but in the short term might be more of a, anything to your long-term expected return, but in the short term it might have some benefits as well. So that concludes my comments, unless there are questions. And then for those of you really excited about it, we have all the data in the back. I'm not going to go through that.
Anything you want to add?
So, I think there's been a lot of information discussed. I guess I'd want to make sure that all the questions for the commissioners have been answered. And, we have a motion for approval if the commissioners are comfortable approving today. If not, and commissioners like a month or so to digest it, we can always come back either with a special meeting or follow back up in February. But there is a motion for approval if the commission is comfortable going forward.
Approval of what?
I'm sorry, that. It would be the current portfolio, so approving the current portfolio we have in place today.
More an affirmation.
No changes.
There's no
Sorry.
changes.
Sorry.
It's an affirmation probably more than an approval for a change.
Right.
Correct?
And I would say that even in some of the areas where the private markets is that if you do think about the bands from these current targets, that we do have room to move slightly beyond those already. And if we did elect at some point in time to increase real estate, that's one of the things that we would have to stage in over time as well.
I guess, I mean, that kind of is, I mean, I know you're trying to balance the illiquids versus the liquids, but,
Yeah.
I mean, this goes back a little bit to that correlation table, right? I mean, real estate y'all have with a low long-term strategic correlation, and yet it has a very small weight, right? But, like, when you look at your correlation table, it has a, you know, your assumption is it has a small correlation to your equities, right? Which would seem to argue that over time you'd expect a bigger weight if you can get there without the illiquidity trade-off, right?
Yeah, and I would say if today we were at capital and ground at 5%, we would be seeking an increase. But we're about 3.5% today, so we're catching up that allocation.
So we might very well come to you, since we
Yep.
do this annually, when we do it for 2015, we may come with a small increase in real estate. But we're not basically recommending things that can't be implemented today without value added.
What did you say we're at presently in real estate?
About 3.5%.
3.5? Oh. Okay, I was under the impression that we were a little
For
higher.
actual market value.
Oh, for market value?
Right.
Oh, okay, but actual capital allocate.
Or committed is-
Committed is like 5?
5.
Yeah, okay. Any other questions? If not, do you want to read the motion?
Based on that, I believe, and Herschel, correct me if you think that it should be different, that the motion should be to reaffirm the current asset allocation as listed in the current portfolio.
Yes.
Okay.
And to keep the same benchmarks and target weights and ranges as well.
Right. And keep the same benchmarks, target weights, and ranges.
So all that's consistent with what we put in the AIP.
What's currently in this AIP right now, or the SIOP.
Any discussion? Or motion? You need a motion?
Any further discussion? If not,
Hey, Mr. Chairman,
Yes.
one little quick simple question.
yes.
Is, so are there gonna be any changes today?
No.
No, we're affirming the present asset allocation with no changes.
No
Am I
changes.
correct?
Correct. Yes,
All
sir.
right, that,
Thank you.
all right.
Thank
Any further comments, discussion before we ask for a motion?
Yeah, you need
Do
to-
do we need to read it? I don't think.
I don't think you need to read it again. I think
Okay, no, I don't think
somebody
we
make
need,
the
it's not
motion.
necessary to read it again, but if we have a motion, please to reaffirm that. All right, second? Second, all in favor, signify by saying aye.
Aye.
Aye, opposed? Are you voting, Mr. Treasurer?
Oh, yes, sir, I was in the ayes.
All right, fine, it's,
From where we are.
very good, it's
And
unanimous.
is it safe to say that Brady is gonna be given the 30-year expectations from now on?
I love that. I will do
All right,
that. Let's just
the-
do that going forward and not tell him.
The motion is carried to reaffirm the investment. Okay, fine.
And now would be time to break.
I think we will now break, and we're running a little behind schedule, so what time do we want to reconvene? At 1 o'clock?
Yeah, 1 o'clock.
All right,
Yes.
we'll
I think we're
reconvene at
about to
1. All right, we will now reconvene, and we're going to be taking up item 7, investment items, and the first item on the agenda is real estate, and that's TA Equity, TA Realty, excuse me. Eric Ravelli will brief us on that. You're on.
All set? All right, thank you. Okay, so today I'm actually going to be presenting two new investments in the real estate. Both of these are fund-to-one accounts, and both are with existing managers. Before I do that, though, I want to talk a little bit about what fund-to-one accounts are, their structure, their advantages, and a couple of the considerations that you need to look at when you're underwriting these. And then I'm going to follow that up with a little discussion on the process that we went through in selecting these two managers. So fund-to-one accounts are joint venture partnerships between the RSIC and an existing manager. We're the major LP. 90% plus of the capital. The manager will act as the GP and the manager, and will commit 1 to 10%. That's typical on the real estate side. They are limited liability structures, so the main vehicle that we'll be investing in will be a limited partnership could be an LLC. In our case, in the real estate, it's a limited partnership. Below that, each individual investment will be held in its own special purpose vehicle, an LLC. And they're operated, in the real estate world, we call it discretion in a box. So basically, the manager has discretion within predetermined parameters that we provide them in the documents. And that is important because we want to make sure that it's understood that the manager is managing this account and that we have certain things that we get. And this will talk a little bit about that, this slide here. So you can negotiate certain approval rights in the fund-to-one type structure. Versus the funds, you don't get much to do in that in terms of negotiating it. And one of the things you can negotiate is acquisitions. You can see every deal that goes into the account. You can approve every deal that goes into the account. We'll do that through what we call a negative consent, which is basically 10 to 15 days. They'll present the investment to us. We'll look at it. We'll see how it fits in the portfolio. We'll see if we have any issues with it, and we say yes or no. And then they go forward with the investment from there on. We also can negotiate certain approval rights on dispositions, leverage. We can suspend capital for new investments if the market turns on us. We can have approval rights for budgets and investment plans. We can terminate the joint venture, and we can also purchase the GP's interest. So on the left are the advantages to a fund of one account, and there's actually many of them. And then on the two, I'll talk a little bit here, is the two considerations that you need to take in when you're looking at these structures. So one of the bigger advantages is, the top bullet point there, is that you can define a fairly broad investment strategy. So it's really between you and the manager. You can basically come up with a strategy that fits them and something that you're looking for. And you'll see that when we get to the two managers, when I talk about the two managers for Bring. The other thing is because you are using an existing manager in the marketplace, you can partner with best-in-class managers. As I said before in the previous slide, you can negotiate certain approval rights. And there are also, like I said, limited liability structures, which are for our protection. These are the second, fund of one accounts would be the second most liquid of the vehicles we could get into, behind direct investing. Direct investing is basically you own 100% of the assets. Here we own 90% plus. And we have a small limited partner, or a GP, and a limited partner in the GP in some cases, that we would have approval rights with. These are meant to be indefinite life vehicles. They will have an initial term, but basically at the end of that 10 or 12-year period, the two parties will get back together and decide how much longer they want to go. So it could go on forever. It's really meant to go on for as long as possible. One of the things about this is that because we have, the flexibility, we also have greater visibility into valuations. In the case of the two that we'll be seeing the appraisals. We'll be reviewing the appraisals with the managers, so we'll know what the valuations are. We also have greater transparency in the reporting. We can go all the way down into the actual asset. The fund level, you typically stop at the fund level. We will be able to see what's going on at the asset level. On the right side is the two considerations that you need to look at when you're looking at these structures. And you're basically underwriting these to make sure that you're comfortable with them. The first one is asset-specific risk. And this is, because this is a fund of one separate account, you own 90% of the assets, you will own less assets, which means you will have more equity in single assets. You have to get comfortable with that. The second consideration is rotation risk. These are managers that have other clients. They have funds, they have other separate accounts, other fund of one accounts. You will be competing with them in some fashion. You need to get comfortable with that rotation. Where are you in the rotation? And we've done that, of course, on both managers, but I'll talk about that when we get there. So those are basically the basic structure of a fund of one account. Sure.
I hate to interrupt you, but
No, go ahead.
It seems like after you just explained it, I might go ahead and Peggy had to leave, but I think she left me with a list of questions to ask you
Okay, good.
about these, and they are very, very good questions. So one of the questions she mentioned, you talked about the negative consent, but she specifically asked about the decision-making process, and what is the decision-making process for that? Does it go through the internal investment committee, or?
My understanding is I'm not as familiar with the strategic partnerships. My understanding is it's similar to the strategic partnerships in terms of how they do it.
Yeah, for the fund of
the fund of one.
All right, so
Are you talking about our internal process or theirs? Or bet-
Separately managed for the fund of one, this particular fund of one account.
Right, in terms of how well, I hope I'm answering it, so tell me if I'm not. So basically, the manager will source these deals, and they will underwrite them. And then, after they've done their initial underwriting, they will, because they're really acting in fiduciary capacity for us. So they're looking at what investments they're seeing in their account. They are selecting, because they know what we want, they're looking at what they're seeing, and they determine, okay, this is a good fit for South Carolina. They'll bring it to us, and we'll have 10 to 15 days to analyze it, talk to them, and see if it fits. At the end of that 15 days, we can either say no or yes. And if we say no, they move the property onto somebody else. We say yes, then they will take it through all the rest of their process, just as they would any asset they do. So that's how we work with them. And that'll be the case with both managers, TA and Greystar.
I think, was she referring to internally, how do we make that
I
decision?
think she was also referring to the internal process as to how we would determine
When
whether
you
or
say
not.
we, is that Herschel or is that the internal
Right.
investment committee?
Right.
Is that you and
Right.
Herschel?
Yeah.
Right.
The basic understanding is that, and this was done for reasons of being able to not miss deals. So what we always had to do is we have to be able to move fairly quickly. 10 or 15 days is, fairly quick. And so what we've done is we set it up where basically the real estate staff would look at the deal, and then we'll bring it to Herschel, and then Herschel and us will discuss it, and then we will decide on the negative consent. So it'll basically be Herschel's decision. There will be a lot of things, though, anything to do with the actual structure, like amendments. If we're going to do, if we want to put on another LP into the thing, or if we want to terminate the joint venture, all those major decisions will go back through the board. Okay, yeah, through the commission, either at the chairman level or, through the commission itself. What we've tried to do is keep the day-to-day stuff down so that we're not bringing it to the commission or to the investment committee, because we have to move fairly quickly. So we're for example, approval budgets. This is going to be every year we're going to get together with the manager. We're going to go through all the assets. We're going to go through the budgets, the investment plans, and then we're going to basically approve those, because we're taking their recommendation and then we're having discussions, and then ultimately we're just approving their budgets. Dispositions would also be down basically at Herschel's level. So we tried to keep the main decisions of just the day-to-day stuff down below the the commission itself. The major stuff that affects the account, those would have to rise up. So I hope that answers that.
Do you, or do you remember her other questions, or I think I wrote them down so I wouldn't forget.
I think our biggest concern was about how we would exercise the negative consent, and that just making sure that we're comfortable that we would have the staffing necessary to do that, and I think that I think that we would, and also I think that
and she also mentioned that, and I think HEK in their memo they indicated that we would have to develop a level of asset concentration we'd be comfortable with, and establish guidelines around those levels. And I think they wanted to know if we have done that, either informally or formally, or if there are plans to do that.
So maybe I can actually add something to it as well, because I think the framing of how would you actually go about investing in real estate, and so what have we done to date, and that is to actually go and find a manager, and we would invest in their commingled structure. A lot of the terms are set. You have to negotiate the LPA in the contract, if you will, and try to get the best that you can. But once you sign that contract, you're in. Those structures will have an investment period and then a harvest period. So that's certainly one way that we and many other pension funds and investors invest today. And we would continue to have that as part of our investment basket, if you will. What we're trying to do here is actually take that and improve upon it, and actually give ourselves much more rights with respect to the negative consent. So you actually get to see the deals they're working on. Where's the location? What's the property type? What does the cash flow look like? What are the environmental studies? You get to see that kind of information. And so we're better informed to say, we're not really trying to make the decision for the real estate manager. we're setting in place guidelines that are customized to meet our specific needs for the types of properties, locations, et cetera, things that we're looking for. We want to make sure that for those guidelines, we're picking the best managers to execute on that strategy. Then we want to build in place a customized solution with the most protections as possible. That's really all we're trying to do. And so, again, all the things I've talked about with respect to the transparency, a lot of the control rights for negative consent. So if we do see a TA, for instance, saying they're going to build or buy a multifamily in Dallas, and we take a look at our portfolio and go, we don't need any more multifamily exposure to Dallas. We don't want that property right now. Then we have the ability to say, no, we're not going to pursue that. And then that would go, like Eric said, to either another investor or fund, et cetera. With it, that said, we have a lot of control with respect to if you're in that fund, you've got that investment period, harvest period. We're thinking about longer duration assets, and so we're not forced to sell because of a contractual term. So we can literally hold these assets for 8, 9, 10 plus years, as opposed to being in an asset for 5 or 6 years. The core mandates that Eric had mentioned is we're trying to get to a core strategy. Where we're currently at in this market cycle, the cost of core, meaning the rates you actually get paid off of core, are very low right now. So the idea is to actually go find good, solid properties in good markets that you can actually come in and actually bring them up and build them to a core asset and then hold them long term. So you're effectively getting a core asset that needs a little bit of work at a value premium, if you will. And so that's the idea behind the strategy. For decision making, it's different from the partnership in the fact that we actually, in the fund of one, we have a negative consent. There is not an investment committee at the partnership level that votes and so on and so forth. It's not a very broad mandate of go anywhere, do anything like the partnerships. These are very defined. It's real estate, it's these kind of properties, the sizing, caps on leverage, et cetera. So we get a lot of control features. And so that's the main difference. The strategic partnerships themselves, there's a lot more interaction, if you will, with respect to how broad of a mandate, where we can go to seek assets and good opportunities and go anywhere. All of those actually come back into the IIC on a fully underwritten basis because we're making more of an active decision on that asset specifically. Here, the negative consent or discretion in a box, as Eric is saying, is we're not going to that level. The manager has gotten to a point that they will invest in this property. It's either going to be in this strategy with us or with another investor. Also, once we get a yes, they're continuing through the process. So it's not just a done deal once we even get to that point. And there are trigger points along the way that things could happen that come back and you go, we're not going to proceed anymore with this investment. It's a dead deal anyway. So that's the overview.
Yeah, I mean, for example, in the TA, we'll have really two trigger points. We'll have the initial negative consent, and then as they do further due diligence, as they get their their pricing down, as they go in there and do their real due diligence, they may find certain things that change the IRR. And with us, if the IRR changes, I think it was by 20 basis points lower, then we have the opportunity to say no again to the deal. So, whereas in Greystar, which is going to be the development of multifamily, there's many points in there because that process is just a lot more involved. And so they themselves will be going through multiple investment committees because each level they're getting more and more information. But, we probably would say early on, we like the deal, we want you to do it, but we have many outs because as they find information, if they go in and they do an environmental and find out it's not good, they come back to us and we basically say, no, we don't want to do that, and we're out. So that's the things we put in here was basically to allow the manager to do what they do best, but we have the big levers. For example, if the market turns on us, that's one of the things you can't do in a fund. If you start to see the market turning on you, you can't tell the manager to stop investing. He's going to invest. We do in this case. We can say no. We can also we can't, of course, stop the flow of money into assets they're already working on, but new investments we can say no to. So we've tried to build in as many mechanisms that, one, are not going to hinder them from doing what they're doing, because ultimately we want them to be successful. It doesn't make sense for us to put a lot of stuff around it that's going to create problems. But just, kind of going through it, I'm just going to, just in general, so you understand, we talked about a lot of the big approval rights, but we're also telling them how much they can allocate per year. So we're saying to them, don't spend all the money in 1 year. We got to get this out over 3 years. So we basically set that so that it's 3 years or 5 years, you know, in between there. For example, with TA, we set the limit on development. Development is not what we were wanted to do in the TA account. It's mostly 80% acquisitions. And I'm getting into some of the stuff we're going to talk about. But, you know, so we set those guidelines. There was many of those guidelines, and you can kind of see that in the memo, but also in the term sheet. Was that the only two?
I think that you mentioned staffing levels, but
Yeah,
I
I think that, you know,
I can talk about that.
You know, and Herschel and I, in developing, you know, the org structure, what we perceive it to be, we're building in some operational flexibility so that if there is an instance where, you know, we need that, you know, Eric would need that support, that we'll be able to do that and cover down, and also give an opportunity for staff to have some cross-sectional exposure too. So, you know, I think we've got that in mind in the way that we're moving forward on the org structure too.
Yeah.
So.
The other thing is, let me say this first. Let me answer that first, I guess, and then I'll go back to this. So, for example, the development. Most likely what we're going to end up doing is hiring a firm to represent us to monitor the construction along with the manager. So that way, staff's not, you know, out there doing that kind of work. We have a professional, you know, engineering firm who's going to do that for us. They're going to look at the budgets. They're going to monitor the construction. They're going to see that it's going the way it's supposed to go. They're representing us, not the account. Even though the manager is still acting as a fiduciary, they're going to be looking out for our interest. That's just an added protection. The whole thing, and so from a staff point of view, we don't really see that as going to be a lot of extra time for us. I think just setting it up and going all the work up front like we've had to do has been mostly where it's going to be. If you're talking about, you know, like this one's 10 to 20 assets over 5 years, you know, that's not really that many assets that we're going to be looking at in a yearly basis. And we don't have a lot of time. We've got, you know, most likely we'll have maybe 2 weeks to a month before the deal comes to us because they'll be talking to us. And then we'll have the negative consent period. And after that, we'll just be monitoring as they progress through. Now, the whole reason that we're doing this, I mean, is that, and I'll get to it in a minute, is because the portfolio is so structured right now into funds, into value and opportunistic funds, which I'll explain has been a very good decision. But we've got to transition the portfolio into a more balanced portfolio. That means we got to get core. If you go out and just buy core, it's expensive. But we are looking at core commingled funds. So there's really two things, and I'm kind of jumping ahead here, unfortunately. There's two ways we're going to get the core. We're going to do it through core and core plus commingled funds. But you're going to get broad diversification with those, but you're going to give up a little return. On the other piece of this is the fund of one accounts, where we want to take advantage of the markets, take advantage of a manager's skill, and basically build the core. We want to take it, you know, core plus, a value add, maybe a little bit of development, and turn that asset into a core asset, and then keep it. And between the two, we'll meet our goal, basically getting to about 50%. So that's the whole reason we're doing that. The problem is that when you look at your options, and I'll get into that a little bit further too, when you look at the closed-end funds that we value in the development, a value manager is going to do, he's going to lease it up, he's going to try to get rents up, and as soon as that asset is stabilized, it's on the market, it's gone. So we never get the benefit of that through our closed-end funds. So we have to have another vehicle to do this. And that's what we've been trying to come up with. What vehicles make sense? Now, when we talk about staffing, and we'll get to that in a little bit, direct investing is staffing. If you were going to directly invest in these assets, we'd have to have a team of 10 people, you know, and then you got to build a support team around them. It's a very expensive and time-consuming process of hiring the staff to go buy direct assets. And that's where you would have those issues. What we're doing is we're letting the manager do what they do best, and then we're basically just trying to put the box around them to keep it under wraps and make sure that they're going in the right direction. So hopefully that helps. So what I'm going to talk about now is I'm going to probably jump through on some of these already, but back in June at WAMP, we basically presented our 5-year plan. And that 5-year plan came out of basically when we analyzed the portfolio when I first came here. This is what we found. This is what I mentioned. We found we have very heavy non-core, value-add, and opportunistic. That structure, and then what we wanted to get to is in 5 to 7 years is a more balanced portfolio. We want 50% of the assets to be in basically what we call stable income-producing assets. And then the other 50% of the portfolio we have available to take advantage of markets. And most likely those are going to be in funds, opportunity funds, value-add funds. And that will come a time again. We're going through this cycle, and then the next cycle we'll be able to take advantage of it. We want that capital available to do that. Now, the question is how, was this a good choice, basically having the portfolio we have? Yes. The answer is yes. Because we broke down the returns of the portfolio, pre-recession funds, things that we committed to pre-recession, and things that we committed to post-recession. On a net IRR basis, pre-recession funds gave us a 6.4% return. Post-recession, a 13% return. So this was a good decision. But this is something I think that we need to move towards. And then the question of this whole conversation is really how do we get that 50% to make sense without going out and basically buying a commingled fund and getting 6.5% yield. That's what you're going to get in some of these commingled funds. Okay. Now there's benefits to that. I don't want to say there's not because, and we'll get to that in a little bit, there are reasons that you want to be in those funds. We just don't want all of our money into those funds. We'd like to take advantage of the markets and try to build that ourselves. So the goal is to get core. Then the next thing we did is we worked with HEK, came up with our 5-year pacing schedule. That told us how much money we had available to do what we wanted to do. And then we built a 5-year plan, and we basically took those 4 items, funded one accounts, REITs, open-ended funds, and closed-end value funds, and we projected out 5 years to see how this is going to work. Okay? And so that was the next phase. So then we had good information. Then we said, okay, what are our options? And I kind of talked about these, so I'm going to go back a little bit through them. Is we really have 3, open-ended core funds, core plus funds. We have the direct investing, and we have the funded one accounts. So the benefits of an open-ended core fund is that, one, it's broadly diversified. Some of the best assets are held in these things. They're also some of the largest assets. We would never be able to buy a Manhattan building in the separate account. It's not going to happen. And they hold some of the best stuff, CBD office, regional malls. The part, and it's partially an issue too, because I've kind of heard that there's a little bit of confusion maybe on the timing of this. But any of the core that we're looking to build now is going to take a little while to build. If I were to go today, if I were to bring it today to get a core fund basically approved, it would take us 12 months to get capital in the ground because these funds have queues going in now. And that's why you're also going to be getting a little bit less return because there's a lot of people wanting to put money into core assets. So in that sense, it will take you a little longer. I can't just go there tomorrow and get a broadly diversified portfolio. And again, the pricing is a little rich. The direct investing we talked a little bit about. We're not pursuing that. We're really pursuing open-ended core funds and fund of one accounts to get our core. The direct investing, we just basically didn't go in that direction mainly because of the time it would take to build the staff and also the cost. It's the most expensive of the 3 options.
Eric, if I could just chime in.
Sure.
The build to core strategy, I think people that are in the real estate area know that one well, but it doesn't imply that everything that you're doing is going to be built.
Yeah,
it is
right.
Buying existing properties in many cases that are not core currently and then building them, if you will, or improving them to the point where they become a core property.
Absolutely. I mean, maybe when I get to TA, maybe I'll get it when I get to TA, you'll see what I'm talking about. And this is where we work with the manager. The manager is looking at us and saying, guys, this is what we recommend you do if you want to build a good core portfolio. And so, we're of course listening to them. So I'll talk a little bit about that. So now that we knew what our options are, what are we looking for in a manager? So that was our next step. We got to figure out what are we looking for. So we wanted a manager or 2 managers with national capabilities and scope. We wanted them to have experience not only in core, but core plus, value add, and these are just a little bit higher return and risk type of investments, and then development too. We were looking really for both a generalist, somebody could do all 4 property types, office, industrial, retail, and multifamily, or a specialist. And in both of these managers, we actually had that. We have the generalist in TA and the specialist in Greystar. We wanted an operator, not an allocator. And not an allocator is bad, but allocators will, a lot of times for their own investing, hire an operator. and then we're paying kind of more fees than we want. So we wanted to find 2 managers or 3 managers at the time we were doing this that were operators. And both of the managers that we were looking to get approval for are operators. We also wanted somebody that was we were currently had a relationship with. Didn't make sense to add another manager on. We want to keep the relationships that we have with our best managers. TA, for example, was when we did the value add search, that was our recommendation back in 2012. That was the manager that we hired after looking at the value add managers. So we already liked them, and it made a lot of sense to use them because of how good they are and their capabilities. Greystar, same way. This is a current manager of ours, and so they, it just is a natural fit. Of course, we were looking for a successful track record, and we wanted to minimize rotation risk. So quickly, basically, when we did this, we now had all this information. We went out and did a search. We looked at 6+ separate account managers and ended up, in the end, choosing these 2. So TA Realty is headquartered in Boston, but they're a national firm. And when I get to TA, you'll see that they just went through an organizational change, which I'll talk about. We're invested in their Fund 10. And as you can see, they've done very well since inception, a 12% net IRR, which is exactly what we like about them because they're very stable in their returns. This would be a $300 million commitment, and we did this on purpose. I want to understand, too, this is not a development necessarily type of strategy. It's basically, we sized it so that we're getting more acquisitions and then development on the multifamily side, which is where we feel the most comfortable with doing development, is multifamily. You start developing office buildings, you could run yourself into a lot of trouble. So that's the way we size this from 300 to 150. The TA Realty strategy is 80% acquisitions, up to 20% development. They may not develop anything, but they're up to. And it's going to be in the U.S. only and the 4 property types. Greystar, on the other hand, is headquartered in Charleston, but they are a global firm. Okay, they are the largest property manager of multifamily units in the U.S. by far. They, through their recent acquisition of Riverstone, they are managing 400,000 units in the U.S. The closest competitor, I think, is Lincoln. They're 150,000. So these guys are all over the country. They've also expanded into Latin America. They have a relationship now with Prudential in Chile and Mexico, and they're also in Europe. I think sounds like mostly in the UK, doing student housing and rental apartments. So these guys are, headquartered in Charleston, but they are a large firm, and they got 10,000 employees. So, not small by any stretch. They have done really well in their value add fund that we're invested in. They've got a near 20% net IRR since inception. This will again be a $150 million commitment, up to. And then it'll be development of Class A multifamily in good primary markets and in your better secondary markets. Class A is like your more expensive apartments. In essence, you're probably looking at somebody who's got household income above $45,000 to be able to afford the rents. So it's not your suburban stuff. It's not your middle income. It's going to be your more professionals, more urban. We're going to want it closer to the downtown where the professionals want to be. We're going to be picking markets that are growth-oriented and population growth, where people want to be next to transportation. Those are the areas we're going to be searching for.
This will be development.
This will be 100% development, but
Greystar
is it? Well, Greystar is when I get to Greystar, I'll kind of mention it right now. Though they are really 3 things. They are an investment fund. They have their value add funds. They have that big, large property management side, and then they have a development group that they started back in 2005. A lot of those guys came from Trammell Crow. That's where Scott Wise came from. And so they have a very large development group. We will be dealing primarily with them. And then part of the reason is they in their rotation, they will not allow you to compete in acquisitions with the fund. But the fund also is not doing development. So we're basically using them for the development side. Okay. So now I'm going to just kind of go specifically into, and we've kind of talked about this a lot already, but basically the TA Realty Fund at one account. And then at the end of this, I'll open it up for questions and then any motions and approvals, and then we'll move on to Greystar. So I'm just going to talk about the structure. We've talked about it already. Probably go through it a little quicker. The strategy, I've talked a lot about it already, and the objective, their history, their performance, and then the considerations that maybe are specific to them. So this will be a $300 million equity commitment, but we reserve the right to come back to the Commission for approval for another up to $300 million during the initial term. And the initial term in this case is about 12 years. And the reason that we did that is we want that money available so that when we want to invest it, it'll most likely be in the second cycle. It won't be in this cycle. It'll probably be in the next one. It'll probably be years 5 through 10 or closer to 10. But we can invest that money and keep it in the same structure that we've already negotiated. So that was important to us, and we've done that on both of them. Yes, in essence, we have the right to do it. Of course, you have to come back to the Commission for approval, and which we do. I don't suspect that we're going to do that until probably anywhere between 5 and 10 years from now, because we want that capital available for the next time the market starts to turn down and we can take advantage of this. TA is going to co-invest 1% with us. We're going to put in 99% of the capital, so we are the major LP. It's a 5-year investment period. And again, it's initial 10-year plus 2 1-year extension options. So we talked about discretion in a box, and basically, again, we've talked about how we've letting the manager do what they do. We've put the guidelines around them, and then we'll monitor them, and we'll work very closely with them as they invest. We've negotiated certain key decision rights. Okay, we talked about these in general, but we've negotiated these in really both our documents. Is that we have the negative consent acquisitions. We can basically push for dispositions. We can suspend capital, which is always a concern. You don't want to get stuck in the next downside if you can't help it. And this allows us to say no, and we're not going to give you any more capital. We'll take the properties we have and we'll just wait till the next time. And then we will be involved with them on an annual basis, looking at budgets and plans. And we can terminate the joint venture. Again, that would come through the Commission, and then purchase TA's interest, which also would come through the Commission. So the strategy, we talked about build the core. Suzanne was talking about that. The whole concept here is really we just don't want to take all of our core allocation and just go buy core, because it's always expensive. This is a problem I had in my past job, too. It's always expensive. And so one of the ways you can deal with that is that you can try to use your managers to do work on things, to take advantage of the markets, to do some work on that asset, and then you hold it once it's core. And you'll gain that spread above that both a yield and a return, rate of return above what you would go buy that same asset for in the market. And that's the whole premise, is that we are going to take advantage of the skills of our managers to do that. Now, these guys will be investing in the 4 property types. We kept it at 4. We didn't want to get into senior housing or hotels or anything like that. It's 4 basic food groups here. And it's in the U.S. only. Nothing anywhere else. And you see, if as you look at the markets we're going to be in, these are going to be the top markets. There's going to be the Californias, it's going to be Oregon, it's going to be Seattle, it's going to be Boston, it's going to be Dallas and Houston probably for some of it, Denver. So these are going to be your bigger markets. The whole objective here really is, again, to outperform our benchmark, our core benchmark. Our benchmark for the whole real estate is Odyssey. Odyssey is an open-end diversified core equity index. It has about 20 plus investable funds. And these funds I've been talking about with these core funds that we're going to invest in, they're part of that 20. Okay, so that's our benchmark that we want to outperform on a long-term basis. And our target is 100 to 150 basis points above them, net of fees, along the long term. There's also a second thing that we want to do is, as I said, when we get to that asset being stabilized.
Can I ask a quick question?
Oh, absolutely.
What's kind of the current yield of core, right? Meaning is 100 basis points, I mean, I know these are both, the underlying's illiquid, right? But we're picking up some complication, but.
Right.
I mean, what's 100 basis points? I mean, is that 12%? Almost
No.
Yield, or is that
For example, the
4%
funds
yield?
right now, net of fees,
Yeah.
if I were to invest in just the median kind of average manager, and Suzanne can tell me if I'm wrong here, is we see a net of fee of 6.5 to 7. Okay? So if we go out and buy core assets, that's what you're going to pay. Your cap rates are down in the 5s. You're looking at maybe 1 or 2%, growth, maybe 3%, but then you take off 100 basis points of fees, you end up back at 6.5 to 7. We're going to try to outperform that on a long term, basically, with TA, because TA is not going to be, a whole bunch of development, a whole bunch of value add. The manager really wants to start off with a good base of core and core plus assets, and then build upon that as they see other assets. So, 100 and 150 basis points above, let's say, a 7. Okay? And then you mix that in with Greystar, where you're taking a little more, risk because it's development, but you get a higher return. There, we're targeting 12 net. Okay? So the combined effect is that we're going to get, with some moderate leverage, 9 to 10 over a 10-year hold. That's the idea. So we're going to do it, again, through those 5 things you see at the lower part there. The build a core strategy. We're going to take advantage of the rent growth. We're right now as a kind of in the cycle where, and this happened in the last cycle, you have a lot of capital come into real estate, but the fundamentals didn't really catch up yet. Apartments have done well, CBD offices have done well, but like office and industrial in general, and retail hasn't really picked up in rent growth. That's coming. And I think they're forecasting that's coming as the economy just gets better and better, as it goes. So we want to take advantage of that now. And there's some other reasons. I won't get too much into the other reasons, but basically there are things that we can do on the rent growth side. The other thing is that we've negotiated with these guys to get, a 20% discount to what we would pay in funds to get these same type of assets. That's kind of our analysis that we did. And then we've picked 2 managers that were operators and have proven that they can do this. And then we are going to use a modest level of leverage, in this case with TA up to 50%. But interest rates are the best you're going to see for probably a long time. And so we want to take advantage of that while they're still here. Ultimately, as the interest rates start to increase and leverage doesn't make as much sense, we can monitor. That's one of the approval rights we have. That's one of the things that we'll have with these accounts. We can start to slow that down and say, we don't really want to lever. We'll put more equity in. So that's one of the reasons that we felt comfortable with that, because you don't really have those mechanisms in funds to do that. You can't.
Can we ask a quick question about that?
Oh, yeah.
The way the memo is written, that's at the fund level, not the property level?
Yeah, I don't, I think that we did set the individual apartments at 60, and the other assets basically 50.
So y'all have provided for that?
Yeah, I'm pretty
and
sure
then
of
in
that.
terms of the leverage recourse, that's just to the fund, not to the plan? Is that how it's set up?
Oh, the fund, yeah. The limited liability structure will take care of that. Because you got to remember that each one, and maybe I'll explain that real quickly. So we'll have the fund, right, which is going to be a limited partnership. Under the limited partnership will be all individual assets held in their own special purpose vehicle. And we'll start out, I think that was one of the questions that I heard, is that, how that leverage will be. We'll start out, probably, in Greystar, probably all of it will be individual mortgages, construction loans, and then eventually a full-term mortgage on that asset in that LLC. So the lender will only have recourse back to that property. They won't have recourse to other properties. Now, TA will consider, as we get big enough, that because they do this at their fund level and they use it pretty good, is they will consider using some pool debt, where they'll take a certain fixed amount of assets, and they will basically have those assets collateralized for a loan. The benefits of that is that it allows us to prepay, because that's one of the problems you have here. When you buy an asset, you're thinking you're going to hold it 10 years. What happens if year 5 you decide you want to sell it? You're going to pay a prepayment penalty. So that's one of the concerns that we have, is the manager has to really, for us, is to determine how we want to structure those loans. And basically, from what we're hearing, is they're going to stagger them. They don't want all the portfolio maturing with debt in 5 years or 7 years or 10. They're going to stagger them. But they do have some ways to open up that window of prepayment. But the way that they do it through the pooled loans is, because they are pooled loans, they can sell one asset and either replace it with another one, or they can, I guess, pay it down. So it just gives them more flexibility. But we're going to have to wait until the portfolio is probably, for TA, probably at least $150 million of equity has been done. So it's large enough for us to even do that. And they will come back, and that's a discussion we'll have. In terms of, do we really want to do that, or we just want to continue putting mortgage debt on it? So did that answer that, I hope? Okay. So here's TA's separate account history. As you can see, they've had 14 mandates. They've done it since 1992, so they've had a long history. About $5.6 billion has been invested across those 14 mandates, and about 217 assets. These are, and this is important because the next slide is the kind of their performance. These are predominantly core strategies. We're asking them to do a build-to-core. They do have some newer, some of these are newer build-to-core strategies. But again, remember that TA is a value manager and a core manager. They do both. So they have development background. So we're not really having them go outside their core competency. This is their separate account history since inception, time-weighted returns. They've earned an 8.6%. Again, these are comparable. Odyssey is a core index. Their mandates have been primarily core. So 8.6% versus 6.8 for the Odyssey. And that number that I gave you, Alan, the one that was about 6.5 net of fees, well, that's basically what you're seeing right there historically. And that spread is about 180 basis points. So that's why, one of the reasons people like them, besides the fact that they've done very well in their value. There's really three considerations. I'll try to go through these as quickly as I can. We talked about asset-specific risk, rotation risk, and the third, actually with TA, there's actually four because we'll talk about their organizational change. In this account, for the initial amount of money we're talking about, $300 million, with some 50% leverage, up to 50%, you're talking about 10 to 20 assets and ranging from 10 to 45 million of equity. So this is where we're talking about you have more equity exposure. If you go out to our fund today, the largest exposure we have is 18 million. It's not that much smaller than these, but it is a little bit smaller. So you are taking a little bit more equity risk. We're comfortable with that because you can see that if you take that 45 million, go all the way up to the $30 billion fund, it's only 16 basis points. TA is very good about risk control. That's one of the benefits we like out of them. They're not a volatile manager. And they've been doing this since 1992. The second risk is rotation risk. So we had to get comfortable with how we were going to fit into their rotation. In TAs, for example, we can compete with their fund. Their policy is that there's nobody that gets priority, okay? So we had to get comfortable with where are we going to be, where's our strategy relative to their strategy and all that. And so basically what we found is that TA, the funds, typically are smaller assets, 20 million gross asset value. Equity, debt, the gross asset value. We're going to be looking, because of the size of we're looking at 20, I misprinted your 80, but basically 20 to 90 million gross asset value. So we're going to be on a larger size than what's going into the fund. Also, then they also have their separate accounts. Oh, I'm sorry, I didn't hear so many questions. Of about 225 million. Those are predominantly core investments. We're going to be above them in a lot of our strategies, so we won't be competing with them either as much. We'll compete some. And then finally, we've had it with them, and this is also with Greystar, that we will see quarterly where they're allocating their assets. So we'll know where they're allocating assets, and if they start allocating assets in a way that we don't like, we'll let them know.
Eric, is there any debt or leverage in these two? Is there any leverage involved?
In the account, definitely.
Yeah. To what extent?
Well, up to 50 loan to value. So TA, yes, Greystar's a little bit more on the development side and the same in there. So basically, if we put in 50 million equity, they can go get 50 million of debt. It's a $100 million asset. Now, there's benefits to that too. We'll be getting some good assets and good markets. If you want some of these better assets, you're going to have to, you're going to be paying more. If you go into like a 20 million gross asset, you're probably talking secondary markets, which is where TA goes in a lot of their funds. But that works for them because that's what they do. They go in, they buy it, they fix it, and then they sell it. What we're trying to do, though, is hold this long term. We don't want to go buy something that, in 5 years we're going to be out of that market. And so we have to be careful that when we look at these things, and the TA is looking at things, and the Greystar is looking at these things, that this is a long-term hold for us. And 50% leverage is pretty as you can see here, it's pretty moderate. For example, if I took a value-add manager in the funds, they can go up to 65% loan-to-value. In an opportunistic, so if let's say the TA does a development, that would be in an opportunity fund. They can go up to 75. Okay, now would they do that? I don't know, but they can. Long-term, we're looking at 30 to 50. This is not a leverage play. We want to manage the leverage. So we'll take advantage of the debt when it's good and positive for us, and then when it starts to not be so positive, we'll reduce it, and we'll work with TA to manage that process. The last consideration is really not a consideration. It was the reason that this fund didn't get to the October 23rd commission meeting, because right before that we found out about this organizational change. We didn't know who it was, but we knew that there was something in the works. So once we figured that out, we were able to look at it and then bring it today. So basically, TA Realty is a private firm. The equity is basically owned 95% by Michael Ruane, who was the founder of the firm back in '82. And so there was really all these kind of senior and junior partners that didn't have any equity in the fund. So that was kind of an issue. I think HEK may have had some issue with that. And so what happened is that Rockefeller Group, which is basically Rockefeller Center, the guys that developed Rockefeller Center, and 14 or so of the buildings around it, they're a big U.S. Class A, premier Class A type developer. They are wholly owned by Mitsubishi Estates, which is basically a global developer. I mean, they have, I think it was 60% of their operating profits are coming from building. That's what they do. They own 30 premier office buildings in downtown Tokyo, in central Tokyo. Okay, so that's what Mitsubishi Estates is. What they were doing as a group, Rockefeller and Mitsubishi, is they wanted to find a core and a value-add manager in the U.S., and they had already found one in Europe, in a Europa fund, basically. TA is going to fit that. So TA is going to be their value and core manager in the U.S. exclusively. The thing that was important to TA is an operator. They did not want to get in with an institutional, somebody that bought them out as institutional, and that was going to change their process. So what they ended up doing is really they do not have any ability to get involved in their investment and their operations. The stuff that they will get involved with is like if they want to do a new initiative. So they made sure that nothing's going to change. And we talked to them, and basically nothing's going to change. The only good thing, the good thing, and there's not any bad things, the good thing is now 13 or 14 of those senior partners who maybe, wanted to get some equity now have up to 10% of the firm. And then parts of the carry, I believe, also. Now, this is not a small firm. TA was a $10 or $12 billion firm before. Now, combined, they're a $32 billion firm. So these are not small. So our recommendation is that in order to gain core, to take advantage of the markets, to utilize leverage, have more flexibility and control at a reduced fee structure, is to invest $300 million with the TA Fund of One account, and then reserve the right to come back to the commission at a future date within the initial term for up to another $300 million. So I'll stop there and answer any further questions.
Yeah, what's the minimum number of assets there'll be in there?
Well, it's a little bit of a guess because it depends on what they, but let's say 10 to 20. Okay. That was a question we had early on is, well, when do you start to diversify? And everything we've seen is, I think, and maybe Suzanne could tell me if that you would agree with it, I think is once you start hitting 15 to 20 assets, you're fairly diversified. Because these are going to be, they're going to be, one of the constraints is that you can't go into certain regions. For example, it's like 40% office, right? And up to 40% office, up to 40% in the west, up to 40% in the east, because those are the coastal markets. We want to be in those. We set the guidelines. And then we say you can't, invest this much. So we've basically given them those guidelines to keep it reasonable so that what we end up with is 10 to 20 assets are fairly diversified across property types and geographically.
Yeah, when you're staying in the higher end of the quality spectrum, so the higher 50%, which is really what this one's more focused on, and you're diversified to staying with the core asset categories within real estate rather than moving into the esoteric, you're well diversified with 15 to 20 at the most.
Yeah.
Are there any further questions for Eric? Any discussion? If not, do you want to read the motion? Refer to the motion?
Yes, sir, Mr. Chairman. It's not too long. I'll go ahead and read it.
Yes, Mr. Treasurer.
Concerned. Yes, sir?
Go ahead.
Can you hear me okay?
Yes,
sir.
Oh, thank you. I'm very concerned about this because there's a lot of talk about what we can expect, but you know, there's also, when you're in the real estate business, and that's what we would be in, there's a lot of risk. I think it's a further than some might think. I like TA, I like Greystar, love the commingled funds, but we're the owner. There's a lot of risk. I mean, there were a lot of really smart people building in Las Vegas in 2006 and 7. And a lot of and I think that we have to look at this, not case basis, but the worst case. You know, we have to hope that we get a manager who look. And a real, it is a fee stream. You get paid when you buy, you get paid when you develop, you get paid when you rent, then lease it, when you sell it. It's just this big fee stream. If you're not careful, that's what it becomes. I worry about the risk of leverage. We know that we're going to use, or we know we're going to use more than the average. And of course, in a good world, it's okay. But if things go badly, you know, it's not good. I think that, you know, you have the appearance of diversification in these things, but what happens is you start having a small group of people, a lot of decisions. Groupthink is very prevalent there, and if you're not careful, when the market does turn, you've got more in common with each investment than without it. One of the has recently sold all of his core properties. Sold them on Wall Street, sold them downtown San Francisco, everywhere. Fantastic wealthy guy, known him for years. You know what he's buying? He's bought 350 mini warehouse complexes. But he said the money's gone in core. And so, I mean, that's just his anecdotal experience, and that's what he tells me. I just think that we may have the talent now, but we don't know that we'll have it in 2 years. Who knows what's going to happen. And it's just a real risk to the system. And I think before we go down this road, you know, it's different from a commingled fund, it's different from a hedge fund, like we've done. When you go down this road and really being involved, having that negative sense, it'll, you know, if you think about a guy who's been in real estate 40 years, I'm sorry that I forget the guy's name in Atlanta, who just died last week. The biggest American contractor in the country, built half of Atlanta, but a lot of big towns as well. He used to say, all I say is no. And especially when he got to the chairman of the board type of thing, he didn't need to work and quit working and just had these thousands of people working for him. That was his job, was just to say no. But he had 40 years, millions of dollars of his own money invested in the projects. And I think this just sets us up to be in the real estate business, not an allocating business for pensioners of South Carolina.
Do you want to respond to that?
I think I heard most of the concerns, and my thought is that you're right, there are a lot of risk. A lot of the things that you've talked about are the risks that we have when we invest in a commingled fund anyway. This is not a way for us to become a real estate operator. I thought the presentation was very clear that we do not want to be in that business. That in itself would require a tremendous build out of staff, budgets, so on and so forth, and trying to recruit a very specific skill set. We are not doing that. We have found an existing manager who's been very, very successful at actually implementing these exact same models with 14 other clients over some 15 plus years.
20 plus.
Allocating over $5 billion, and I think 217 plus deals. And a lot of the risks that were spoken to, we've actually built in control features for the fund of one to help us mitigate those things. So if we do see things we don't like, we can suspend additional new investments. In a fund investment, you don't have that option. We have a negative consent, so we're actually seeing the properties before they go to closing and they're transacted upon, and we have optionality that we can say, no, that's not a property that fits with our portfolio, or we think it's too much risk, or it's in a market that we're not comfortable with. So we've intentionally built in a lot of mitigants to a lot of the risks that were actually just mentioned. So the idea was to create a better mousetrap. Now, with that said, and as Eric outlined, there are some additional risks that you will take on. If you're in a core fund, when you allocate, you get diversification to many markets and many properties and property types. Here, this is a build-to-core strategy. Does not mean that the TA strategy is doing all development. They are acquiring existing properties and bringing them from a value add or core plus strategy to a core property type. And that's where you're getting some of the value creation, and that's where a lot of their expertise resides. So we think this is a better way to approach building into the core as opposed to allocating directly into core right now today. That still will be part of our overall strategy, is to find core funds to allocate to. But again, those have very long queues to get in, and you're looking at a year plus before you could actually allocate to those strategies.
And there are a few core managers who have outperformed by maybe 50 basis points over there.
I read up on him with the first TA memo the other day. And so we'll just disagree, and I want to put it out there that I don't think it's an appropriate path for a pension fund of South Carolina to go to. And I'll leave it at that. And I'm listening to you, and of course, I'll trust you, but let's just disagree. And we move on to whoever else we got to help. So,
Well, just to be clear, Mr. Treasurer, I get, your objection is to the, is that if we pursue real estate, we should be in a fund rather than the fund that we're presently describing? Is that your concern?
yes, I just think that we represent working people, and this pretty far on the curve. This is very sophisticated investing with a lot of risk. I know about that already, but it's more in our wheelhouse. I love Russell, but I've always asked some questions about him, and I've never had a question that couldn't be answered. So that makes me feel real good about stuff, about those things. But when you get in that real estate world, especially the big real estate world, it's a world into itself. It's their local market. You may be a big wheel in New York, but you go to Miami and you're nobody. And it's just one of those things that I just have heartburn about for the people we represent. If we were to be caught up in, a 2007-8 event, look what they could do to us, and it just troubles me.
Thank you.
Yes, sir.
Let's see, Eric, anything more you'd like to add?
No, I mean, I think, I understand what he's saying, but
Go ahead with the motion.
I think it's not that much different than what we do in the funds. It's really that asset-specific risk that you're
All
going
right,
to
we have a motion about to be read.
Yes, sir. In regards to TA Realty, one, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated November 20th, 2014. 2, authorize a commitment not to exceed $300 million through the use of a fund of one structure. 3, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the creation of the fund of one structure as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal. And 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014, or as the review period may be amended or superseded by the commission. And 4, authorize the chairman and or the CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the obligations of the South Carolina Retirement Systems Trust Funds with respect to the investment.
Okay. Is that for TA? And
That's just for TA.
Okay, this is just for TA, all right.
You have a motion.
May I have a motion to approve?
Mr. Williams.
And a second? Second. We have a second. All in favor signify, please, by saying aye. Aye. Opposed?
I'm a no.
If there's, all right.
I don't think she's there yet.
Oh,
She can vote anyway, yeah, that's right, yeah. Right.
All right. So we can now move on to,
Yes, sir.
we will now move on to Greystar.
Yep, okay. That's it. All right, so the thing is, I'm going to go through this a little quicker because we've talked a lot about it, but at the end of this thing, ask any questions you have. So I may go through it a little bit quicker, I'm going to highlight the stuff that's different than TA. It's basically the same type of structure, same type of approval rights. It's all similar in those ways. The difference is in the strategy, the objective, in terms of what we're trying to do. And of course, they're a different firm, so they have different performance and so forth. So I'm going to just talk about those things mainly. This is a $150 million equity commitment. As with TA, we would come back to the, reserve the right to come back to the commission for approval up to another $150 million during the initial term. Again, this is probably not something we would use in this cycle, but we would like it there so it's there available, basically on the same terms as what we've negotiated now. Greystar will co-invest alongside of us 5%, and we'll put in 95%. Still a 5-year investment period, an initial 10-year term plus 2 one-year extensions. Now, I can tell you we probably are going to use all 5 years of that investment period. With the development, we do not want, this is, one of the things that we had to get comfortable with ourselves, is we do not want to be building too many buildings at the same time and the market changes on us. So this is something that we're going to be working heavily with Greystar on, is to figure out what that needs to be. If that means we don't have anything more than 2 going on at the same time, then that's fine. We'll just extend out the investment period for 5 years, or maybe all the capital won't go out. So, that's what we have to figure out. We just don't want to take that risk that I think the Treasurer was talking about, is you don't want to be overexposed. So, these, again, I'm not going to go through this. This is the same structure, discretion in a box. We have the same approval rights. Okay. Now, this strategy is truly a build the core. We will use Greystar to develop the asset. They'll purchase the land. They'll develop the asset, they'll stabilize the asset, and then once it's core, we'll hold it. It will be Class A multifamily, and it's going to be mostly urban infill or, basically close to urban infill. We're not going to be going out and doing too much in the suburbs. Now, some of these assets will be larger. For example, we are looking at one in Dallas that's going to be a mid-rise, right? That might be an investment they do for us. At the same time, they'll probably do one that's maybe a little bit outside of like a CBD, but it's going to be, maybe a $25 million equity. So they're going to be spreading that across that. We'll also be spreading it across geographic regions. You can see here the markets that we're talking about: California, Seattle, Portland, Denver, Phoenix, in the central, Texas, Chicago, Minneapolis. Of course, everybody knows the energy markets are going bad. The technology markets are going really good. So, try to get in those markets where there's a lot of population growth, a lot of job growth, mainly. And then, of course, on the east side, Boston, D.C. D.C.'s been hit, but that may also be an opportunity, because that's a good time to be doing stuff when the markets are having problems. Charlotte, Raleigh, Atlanta, and Florida. Again, this is the manager sourcing these deals. They'll do the underwriting. They'll bring the deals to us. Okay. This wouldn't be any different than they would do in their funds or for any of their merchant bill clients, which I'll talk a little bit about. The only difference is that they're acting as a fiduciary in capacity for us. That we're relying on them to find the best deals they're seeing and bringing them to us. Then we'll retain these assets once they're core. So this one is a little different in terms of the objective, and so I think just maybe a little bit of explanation to understand how this is Greystar has, across the country, they have regional development teams. Okay, and their job is to source deals, and then once those find a home in either a merchant build investor like a Carlyle or a joint venture structure like ours, their job then is to build it and stabilize it and do it based on what they thought they could do. So that's their job. So this is, the returns are really broken down in two, and you'll notice the fee structure is also that way. If you had a chance to see the fee structure, it's basically development phase, investment phase. Development phase is development, stabilization. Once it's 93% occupied, it becomes investment, and then we hold it from then on. So we're looking at trying to, as a target, 20% gross IRR during the development phase, up to its 93% occupied, and then after that, 10% gross. Our long-term 10-year net IRR is 12. Okay, so that's a pretty reasonable number based on what we're seeing in the market today and the fact that it's a 10-year hold. Upon stabilization, this of course is looking for a little bit higher stabilized yield above what you can get in the market for a 93% Class A multifamily product, which is, I can tell you, is very expensive. We're looking for 100 to 200 basis above that. And again, these, I'm not going to go through, these are really the same type of combination of things that we're going to be doing. The only difference really is that this is not an acquisition strategy, but it's truly a development strategy across those 6 to 8 assets. Here are the assets. This shows the realized assets. They've done 44 developments to this point. 13 of them have been realized. And you can see by the little bubble thing or whatever they call that, they've achieved a 1.9 times multiple on that. So they've done well. And again, it's going to also depend on the markets. If you were developing a project, and this was important for us too to understand, is that as they developed projects that got kind of right before the recession, we tried to understand what happened to those assets. And in the end, they did okay. They got a 1.3 multiple. And only one of those, I think it was a half a dozen of them, that actually had like a 0.8 multiple on it. And the whole trick to this is you do not want to sell at a bad time. You do not want to sell, first of all, when it's in underdevelopment, and you do not want to sell before the market does it. If you're going to hold these long terms, you'll make your money. I mean, you may not get your 2 multiple, but if you happen to be developing and right before the recession, you're still, at least based on what we see with Greystar, they were able to get back your money plus a return. Okay, so that's part of the reason that I said I don't want to be building all at the same time. That we just can't do that. So we want to just put that over 5 years and see where the market goes, and we'll monitor it. But they've done very well.
Talk about these assets long-term and realizing them. Obviously, that means that at some point in the future after acquisition that the properties are sold.
Well, you can't hold them for a long time.
Well, I guess that's the point at which I'm a little confused on. When you've got that column up there talking about realized, if you develop a property, you construct a property, develop it, and you hold on to it for 10 years, and then you sell it, obviously you've realized, hopefully, a gain. But if you continue to hold on to it for some period of time and collect the rents during that period, how does that fit into the realized portion of the performance?
Well, the first thing, these are probably, I need to explain this. Greystar has 2 lines of business in their development fund. Okay, they have joint venture partners like us, like a fund of one account. They have a couple big Canadian funds that they have a partnership with. It's 250, about a little bigger than ours, 250 million, and I think they had originally another 250. So they have those clients, and we would be one of those clients. They also have what they call their merchant build business. And for example, Carlisle, I think most people are familiar with Carlisle. They would hire or partner with Greystar to build them a building within one of their funds. So their objective, and probably a lot of these assets are that way, is these are probably not long-term holds. I don't have, what says average hold is 3.5 years. That fits within what you'd expect from a and then look at the multiple over 3.5 years. That's pretty good.
But where this is important to us is in the performance fee. Whether we sell or not, there's a theoretical performance as if it's sold, right, effectively to us, because that's how they get paid.
Well,
right?
Yeah, and for this one, that's kind of why I started out with the discussion on the regional development crew. The development teams, at the time this is stabilized, so in this case, the 3 to 4 years when it's finally stabilized, they can take their part of the promote that's earned at that time out. What we did is we negotiated with them to say, yes, 25% can go to the development team to pay them, but 75% has to stay in the deal with us. And so that's really that's why you see kind of a fee structure during that phase, and then another one at the end of like 10 years or 12 years. So what happens is 75% of that promote that may be earned on this period, that goes in with us. And that's going to be the guys, the senior guys, not the development team. They most likely will take the option of getting paid out because that's what they do. That's their job. They're not working necessarily with the West region or the East region. Their job is to find the best stuff, develop it, stabilize it, and then they're out, and they can move on and do another one. The job of the guys that the senior guys that we're working with on the team, their job is to find the best assets among those groups and then stay in with us the rest of the way. So So, and when we talk about rotation, that's another thing. So the merchant build clients would be like Carlisle, is they would would partner with them. They would build the building. As soon as it's stabilized, that's probably on the market, which is, again, part of the problem we have with closed-end funds is we never get to see them as core assets because they've done what they wanted to do. That's really what you're seeing mostly here. The stuff that's kind of new, like the joint venture structures that we're doing with them, those are relatively new things for Greystar. This was primarily their business, I think, going back to 2005, and some of the Canadian funds, that's a little newer, maybe in the last 2, 3, 4 years. Okay, so I don't know if I answered the question. Okay. So, again, they've done well. To have a multiple over 3.5 years, that's pretty good, and they've done that across these 13 assets. We, on the other hand, will probably get a higher multiple, but the IRR will come down because it's going to be a 10-year hold or a 15-year hold or whatever. The basic process for us to understand is that once first of all, these will be locked out. Neither Greystar or us can sell this asset before it's developed and stabilized, really. So it has to get to stabilization before we can force a sale. And it's really for our protection. We do not want to be selling this asset in the middle of it being constructed. And same with them. We don't want them to be able to do it. And the way, if you saw on the term sheet, is that we can sell it earlier than they can. I think ours is basically once it's stabilized or 5 years after the documents are signed, so 5 years from now. They are like 7 years out, okay? So the objective is that we don't want to do that. So I was bring it up there. Okay. So these are really the same risks that we talked about before. I'm going to go through these fairly quick. They really are the same risks. The asset-specific risk, this one is 6 to 8 assets, again, 10 to 45 million. And so, you're talking about each individual asset only being 16 basis points of the total fund. Again, we want those to be diversified, and we want those to be in the best markets that we can get. We want those to be in long-term markets, not cyclical markets that, 5 years from now we're going, oh boy, we don't want this one. Oh, what I was going to say is and I go back to this real quickly. Every year, and this is TA and Greystar, every year we get with a manager, they will run a hold sell analysis. They'll look at that asset and say, should we hold it? Because they're not going to be 100% perfect on every asset we buy. We know that there's maybe some that maybe didn't exactly do what we wanted to do. So at that point, we would make the decision to sell it, reinvest the capital. Okay, so the chances are these will be long-term 10-year holds, but there will be some assets that we might sell before that, if it makes sense to do that. Rotation risk is different here because the Greystar Value Add Fund cannot do development, and the development, our account cannot do acquisitions. So the fund is out of the equation. We don't have to worry about the fund. Where our real competitors are those two funds I talked about. There's the Canadian folks. And there's another one that they've done recently for about $250 million. Some of that's already been identified. The Canadian guys, basically, they're going to be at a higher end. They're going to be at our higher end. Is going to be their lower end. So they're in like the best markets, but they're also got larger assets. And the one that we're going to compete with is the second one they've just are basically coming up with now. Where we could compete for the same deals. But they are the same as us. They cannot have too many assets in the same regions. So we will see a lot of assets that they're not going to want to get because they already have exposure there. So that's the way that's going to work. What we were really concerned with is we didn't want to compete with the merchant build clients. They have a list of like 7 or 8 merchant build clients. Carlisle's, PIMCO, BlackRock. All these guys that basically are going to them and saying, we want you as our operator, you build the building and stabilize it, and then we'll sell it and we'll give you your promote. We did not want to be behind them. So the agreement is we'll compete with the joint venture structures, right? We will not compete with these guys. So we will see the deals before these guys see the deals. Now, it won't be every deal. It'll be what the Greystar brings to us that they think are the best deals for our account. And then we'll look at that and we'll say, great. And then if we don't want it, then it can go down to the merchant bill clients. So that was the main thing. We want to make sure that we were in a good part of the rotation. And again, we'll also be able to see where they're allocating these assets. So that's an important thing. And then lastly is the leverage. Same thing. The difference is that it's very typical in a construction to have 60 to 65% loan to cost. These are probably floating rate debt for the most part with banks, with big banks. And then once the assets are stabilized, they turn that into a permanent loan, and that has to be 50% loan to value maximum. So now once it's core, 50%. And again, we're going to manage that down to 30 to 50, most likely over the long haul. If this development was in an opportunity fund, they could go up to 75. Now, would they? I don't know. Again, that's up to the manager, but they could. So we're actually coming in lower than what they are. And then finally, like TA, we'll have the ability to manage the leverage through our approval rights and through our monitoring. So I'm going to finish up here and then answer any questions. I know this is even more so, a little more, involved than TA. But we're recommending basically $150 million initial commitment, and for the same reasons. Build the core. Take advantage of the development markets. You can build today to get a higher spread when those assets are stabilized than you could if you just went and bought that Class A multifamily project. And then we get the benefit. One of the things that I've seen in the research is I think 60% of the multifamily units in the U.S. are older than 1990. They're like 24 years old. We're going to end up with new product that we can hold for a long time. And we're not competing with somebody who's doing 24 years old. That stuff is starting to lose its, probably lost its momentum. So there's a market for us to be able to, even when you hear about all this development for multifamily is just coming back to where it was before. And there was like 3 or 4 years where there was very little development in multifamily. So, and there's this whole urban trends that are going on. The younger people have high student debt. They saw their parents losing their homes, not too happy about that. They want to be mobile. They want to be urban. That's just a big trend that's happening. Is it going to be every young person? No. But we're not trying to get every young person. We're just trying to get those ones that are probably professional, want to live closer to downtown. They want to be near transportation. And that's what we're basically looking at going towards. And then we reserve the right to come back to the commission at some time during the initial term for another up to $150 million. That's the recommendation. I'm open for any questions.
Questions for Eric?
Yeah, I want to make sure I just kind of understand, because there are different types of fees clearly going to different types of parties. Obviously, real estate in this sense is different than a real estate manager who presumably is, some of the other issues we've talked about, SEC registered, right?
Well, these are both SEC registered.
They
managers.
are.
Yeah.
Okay. Right. And so, if I understand it, there's 5% of project costs. So let's just walk through an example. $150 million gets put to work. We're going to pay 5%, right, for the development. So $7.5 million, right?
Yeah, the project cost. Yeah,
right.
Total project cost. So let's say.
And then the management fees, right, to get the building leased up and everything else. I don't know if that's a reasonable rate or not at 2.75.
Yeah,
of rents,
yeah,
gross rents.
It looked to us to be pretty reasonable.
Huh?
It looked to us to be. You're talking about Greystar in particular or TA?
Just any of them, right?
Well,
like this building. I have no idea what a property manager gets paid as a percent of gross receipts. I don't know. Is that a
well, a building like this is going to be a little lower, but it's also greater income.
Right.
So they'll get a little lower percentage, but a higher, be a higher rent. You get into apartments, I think the 3 to.
I don't think they make higher rents, higher percentages on rent when they own the building. That's a whole different thing. If you're a construction manager, so like it is with the West Campus Village, he's in the 2% range, but he didn't own it. Somebody else owns the building. If you own the building, you will get less.
Yeah, no, I'm sorry. We're talking about property management fees, correct?
Yeah.
Okay. Yeah, there's different fees.
I'm talking about the 2.75.
Yeah.
Right, because there's a development fee, there's a property management fee, and a performance fee in here.
Yeah,
right?
basically what first of all, you kind of break out the stuff that you're going to pay anyway.
Right.
If it's a building, for example, with it's Greystar, or TA is probably an easier one, where if you don't own this asset, if it's owned in the funds, somebody, the fund, and ultimately us, still has to pay a property management company to manage it and a leasing agent to lease it. You're going to pay that in no matter how you own this asset. That's not going to go away.
Yeah, I understand that. I just don't know what those.
And then these fees looked reasonable to us.
Right.
Okay, so that's why we looked at that too. That was one of the comparisons that we did, is not only just the property management and leasing fees, but also the trying to compare the fee structure relative to like other clients of like Greystar, for example, or if we were to take those same assets and run them through our funds and pay the fees through our funds, that was our comparisons. We were trying to look and see how does this fee structure compare to that. So once you get now to the development side, for example, anytime you do a development, you're going to have basically a developer, a general contractor who's going to build the building. Then you're going to have a construction manager. Sometimes those are the same. And Greystar, that will be, in some cases, that will be the case, right? They're going to develop the building and they're going to oversee it. And that's part of that fee. So they get a fee for that because, it's part of just building. You're going to pay that no matter where you go. What we did was just try to make sure that was reasonable to us. And then also, they get, I'm trying to remember the other, I think if, for example, they use another general contractor and they're not the GC and they're just the construction oversight, they get 1% or 2% of hard costs. So, and I'm trying to think if I missed one of the fees there.
Well, then there's the performance fee.
Then there's the performance fee. And the management fee.
Stabilized, right?
Right. Yeah, and again, as I explained with Greystar, it is a little complicated. They basically, at the time, if this thing stabilizes, you go get an appraisal, so an independent appraisal, that value, because we're not trying to sell it, we're going to hold it, so we have to get an independent appraisal. Based on that appraisal, they'll calculate the promote, that first section of the fees. Then 25% of that will most likely get paid out to the development team. 75% will stay in and just basically go into the future deals that we have with them. At the end, let's say that we went 10 years and we decided we're going to sell everything. Well, then we would have another calculation basically where they could, get their promote out. A little different than TA. I don't want to go back to TA, but TA is what we did there was a 3-year rolling. Okay, that's pretty typical for a separate account type of manager, where they don't want to be in a deal for 10 years before they see any promote. So we set up basically a 3-year rolling type of a calculation, and that's pretty standard, I think. This deal with Greystar is the way that they've set their accounts up, and it's good for us because they stay in the deal longer. We have the 25% that phase leave, but they're in it for the rest of the way.
With 75%.
75% of that promote, and then basically they're putting in their 5%, and then at the end, they'll do another since inception calculation on the whole portfolio, and then it'll run through those tiers. Okay, so that's like a 10-year, actually further away when you decide to sell. That's the real calculation is once there's distributions, they will run through these different portfolio tests, and they'll see, okay, for example, you look at all your assets and you have a distribution. Let's say you sold one of those. What happens is that they'll run through the calculation, they'll take all the assets, they'll go back since inception, and if it's above 8%, then fine, they can, at that point, we've got all our capital back. It's not going to happen with one asset, but we would get all our capital back and we get our pref, then they can take some money out. But the chances of that are slim, just like in the funds. They have to sell many assets to pay us back all of our money plus a pref of 8 or 9. So I hope I didn't throw you off on that
I'm
one.
just trying to visualize just in terms of cash, right? Because all right, 150, we're paying 5% development, and is that on equity or is that on the cost of the project, right?
The development fee,
Yeah.
that'll be on the, it'll be used on the hard costs, which is basically the development cost.
So we're really talking about 300 million, right? So we put 150 in the ground, we're paying 5% on 300, right? Because
Right.
they have 50% or 65% leverage,
Right.
right, on the project.
But those are standard. Nobody's going to develop a
Right.
building without getting that kind of a fee. That's a typical
Right.
general contractor
Right,
fee.
but I guess my question is, all right, we're trying to build to hold something for a cash flow, right? So I'm trying to think, okay, what's cash effectively out the door, right? So it's 5% of 300 million, $15 million of cash out the door, right? We have asset now, 285 $1 million of assets out there. It gets stabilized. Let's say gross rents on that are, I don't know, $30 million might be a reasonable number, gross rent, right?
Probably not, no. I think the example that we used for kind of our template, the NOI was at $6 million. So you can figure that maybe 10 total annually.
10 million on
gross rents, gross income, and then you take out expenses, and NOI is like $6 million.
Right. After expenses, right?
Yeah.
Right.
Yeah, let me just find that so I can.
Right, so then you're gonna come back with appraisal that's gonna take that to what sort of cap rate, right? And we're gonna have to pay the performance fee then, right, even though we haven't sold the asset. Right? Huh, yeah,
Bless you, bless you.
yeah. I mean, I'm just having trouble like seeing it in my head here. Kind of what that looks like. Meaning, like, where's our break even, right? Like, how many years on a cash basis? We're gonna have to hold this thing to get to.
Oh, no, I
break
mean,
even after all that.
once it's stabilized, the way this thing will work, for example, the one we were talking about, Dallas, that's because it's a mid-rise, it can take a little longer to develop it. It might take like an extra 6 months. So you're talking about 2 to 3 years to develop it. Because it's a mid-rise, they probably won't be able to do a lot of leasing while it's being built. But they can still lease that up within, I think in their example, it was, the one example we got was 44 months. But let's just say 3 years. It'll be completely occupied at 93%. You are cash flowing at that point. Okay, I mean, you're getting your $6 million NOI or whatever it is. Okay, so, and the good thing about apartments is you don't have a lot of it. An office building, you're paying for, that's one of the reasons that office are tough, is because you're getting a tenant and then you got to pay like $25 a square foot to put them in the space. And you got to pay a leasing commission. And so it's just going to be expensive. Apartments, no. I mean, you got on-site leasing agents that are leasing these spaces. They turn over, units. Basically, about 50% of those guys will move out during the year. That's kind of their average. And then so you're basically retaining, over a full year. And then they go into another lease. And so the churn of these isn't really that bad. They go in, they maybe have to put new carpet. Chances are not with the new development. So the expenses will be lower. But you're going to cash flow as soon as you get to that, that occupancy. Actually, before that, but once you get 93, then you're pretty much at full occupancy.
Right, but at 93, we have to cut a check for 25% of the performance fee.
Yes, for that period, yes,
Right.
Absolutely. Right, and that's part of our calculation. When we analyzed this, we analyzed it.
There's a development fee of 5%. Does that cover any of the general contracting and construction management?
Yeah, that is the general contractor and the construction management. It's basically, and that's why I said if they hired a separate GC and they still retained construction management, I think it was 1%. Yeah. So if they were to do it all themselves with their construction group, then they would charge the 5%. Or less, I think, depending on if there's in that particular market, it's actually less than that. But that is the fee to do that. There is a development fee that they can earn too. See, that you have to break these up. This is construction though. I mean, this is not unusual. You basically have a building you're going to build. You need a contractor, then you need the people on the ground oversee that asset. So as they're building it, you need to have on-site staff. That's going to be the GC and the construction manager fee. The development fee is what they earn for basically doing all this work, working with the architects, putting the financing in place, all the work that it takes on more of a larger level. And so that's what they get. I have to, forgive me, I have to.
I'm sorry, this is Peggy. My meeting took a little bit longer than I expected, but I can hardly hear you.
You can hardly hear me? Oh, okay. So I want to be clear, okay? Now these are I would say these are normal costs, right? You're not going to necessarily get away from these costs. If you want to develop a apartment building, a Class A apartment building, you're going to have these costs. So basically there will be
Can you move closer to a different microphone?
I'm sorry. Can you hear me now or?
Yeah, that microphone is difficult. I've been able to get it picking.
Okay, you may want to just move, you can move closer to this mic and closer to them.
Oh, okay.
That's okay.
Okay. Can you hear me now?
Is that better?
Yes, sir. Thank you.
Okay, sorry about that. So basically, just like when you buy acquisition of properties, there are going to be expenses that you're going to pay. I don't care what the structure is. You're going to pay them in a fund. You're going to pay them outside of the fund. You're an owner of that asset. That's what you're going to pay. If you want to develop an asset and be able to, earn a return of 12% net of fees over a 10-year period, there are going to be more costs for that because there's more work. So developing a building, I'm sure, is not an easy thing, and so there will be really two fees. The GC fee and the CM fee are combined. Those are the 5% of hard costs, and then there is a 5% fee, which we may try to negotiate down. We thought that was a little high, but that is something we're going to try to negotiate down. What we didn't want to do is bring the terms to the commission that we're going to get any worse. So we probably will go back on them with that and try to whittle that down a little bit. The 5% GCM fee, that's pretty normal from what we could see. The development fee was a little high. So what we may do is go back to, and that is basically paying them for the all that stuff I talked about, working with the architect, coming up with the designs, all the loans, everything that comes in with that. They're doing everything on that thing other than.
Written, and I believe this is standard. The development fee is separate. The development fee here is 5% of the total cost,
Right.
excluding land and fees paid to Greystar and cost overruns. Then the next paragraph is general contracting and construction, and that's either 5% or 1% if they hire the manager. It's a different thing. I went through a deep dive on this at the university, and I had the same trouble with fees. They came to us with a $440 million deal, which turned out to be an $880 million deal after you figured in the rents. Everybody's fees and income on the other side doubled and tripled when you figure the gross, not the net. And these fees, now I might be wrong, but I spent a month studying these things. I think these fees are not in line with TA Realty's fees and other people's fees. I think these are high.
Well, they won't be in line with TA. TA is a value and a core manager, okay? And you have to look at, first of all, TA is not going to, their return expectation most likely is going to be in the 9 to 10 range. They're not going to make a bunch of money off the promote.
As an example of other commercial real estate.
Right. No, what we did is we compared these fees, and I think it was in the material that went out. I believe it was, where we had looked at the fees of other Greystar clients. We talked to Carlisle. We looked at other people who were doing these kind of assets and doing this kind of construction. Now, there aren't too many that do this full 10 years like we do. A lot of these guys are in it for the the 36 or 40 months, 50 months, and then they sell. But their fees, when we compared them, they were fairly comparable. A lot of those were in the 9 to 9.5 pref. But again, their fees are really our first part of our fee.
Yeah, I mean, this is where I kind of am on this one. I mean, those fees don't bother me as much. I mean, those are clearer to me, right? It's the performance fee, right? Like if you look at their table, right, on their other development deals, right, 4-year average life and a double, right? Right? I mean, that's a, if that's going to be the mark, right, from construction where you're at cost to a double, right? I mean, that's going to be a hell of a performance fee, right?
Well, but
it's going to dwarf these fees, right?
No, which fees are we talking about? TAs?
No, well, TAs or even this, the construction cost fee, the management.
Well, you got to remember what
like go to your slide that had had their prior performance deal by deal up there. Right? So 144 million in.
Right.
Sold on the market 276.
Right.
Right. Average life of 3.5 years. Right. We get a 9% pref. Right. So we're $27 million. So you got $100 million of performance fees marked. Right. We're going to pay $20 million. Now they're only going to take $5 million because they're going to leave 75% in the fund. Right. But I mean, we're going to pay $20 million in the first 3.5 years, effectively, right, on top of the construction fees, right? I mean, if that's what it wound up looking like.
I don't think those numbers are correct, but you also got to compare it to the way we looked at it. And I'm sorry, I'm a little close to this. What we did is we took these assets and ran them through their performance structure, the whole 10 years, and then we did the same thing through a fund. Let's say a Carlisle fund.
Right.
So Carlisle is going to also pay them for the time that this asset is in their fund. They're going to get the promote. Their promotes are very similar to what we're paying them for the development phase. But then, then when they sell that asset, it's going to run through their fund promote too. Through Carlisle's. So what I'm saying is what we compared these two was what we would pay if that were to run through that fund. In essence, if we were to own that asset in the Carlisle Opportunity Fund, how are those fees relative to these fees? And we could feel comfortable that we were getting a discount to those fees. Either party is going to pay development fees. Now, you could argue that maybe the development fees are a little high, and we can negotiate that down. but they're going to pay those fees, and probably very similar to
Oh, I
those
get the
fees.
development fees, it's the performance fee.
Well, but then if you, but the
what you're
difference
saying
is,
normally we'd be paying Carlisle the performance fee.
yeah, we'd pay, Carlisle would pay Greystar, and then we would pay them.
If you were in a fund.
I doubt Carlisle's paying a performance fee to
Yes.
a developer.
Well, because I talked to them, yeah.
Huh?
When they're doing a development and you don't have development capabilities, you got to hire these developers, and that's what they're going to get. And now, the question is I guess if you wanted to do it, you don't necessarily have to. But
And
Carlisle, I
think
know,
the other
does pay
difference
this.
is, right, I mean, if we sold the asset at 276, right, it's different. You have the cash to pay. If we're just holding it and cash flowing out at $6 million a year, right, I mean, we're gonna have to hold this thing a hell of a long time, right? I mean, so there's just a cash, like, that's the difference in paying the performance fee on something that's sold, right, and you're getting the full 300 million back or whatever the value's back.
Well, first of all, I don't think, when we ran this analysis on the target property, which is basically a 15 gross, 10-year gross, and a 12 net, the 25% that came out of this, it was $800,000. Their calculation of the promote at that time was $3 million total. 75%, basically $2.2 million, goes into the deal with us. The $751 is what gets paid out. So I think part of it is that maybe your numbers are just really large as you run through this.
Well, I don't understand. Well, I mean, I guess a lot of it gets to that mark, right? I mean, that's going from an invested to a market value.
Well, you got to remember that these are also over certain thresholds. They don't get, like in a typical fund, they would get, not only would they get, let's say if you had a typical fund would have an 8% pref, okay? And then basically they'd have a catch-up, usually 50-50. So once the cash flows exceed that 8%, they're going to get 50% of those cash flows, and they're going to get back to that original 8%. So they get not only the first 8% that you got, but then they get after that. So they're going to get 20% of the total profit. These ones are excess of 8. They're not getting into they're not touching our pref. They're only getting a pref once we go above an 8. And they're multi-tiered too. The first one I think is a 9 and a 15. Okay, so they have to go over a 9 to get the first tier, and that's 20%, and then that's split 75 to them that's coming in with us, and 25 goes to the development team. After that, and then over a 15, they get 30%, and that's split again 75-25. So when you total those up, and unfortunately I thought I brought it, but I had so many papers. That calculation is about $800,000 on a deal that's going to be this very typical size for us. 30 million equity. It's like a let's say an 80 million or whatever size gross, and then they ran that through their fees, so I could see how it worked. And then of course I did it on my own, but that's what it came up with. Now, yes, if they're going to give you basically an asset that over 10 years is giving you a 15 gross. That's a pretty good return, and they should benefit from that, as a performance. The structure itself is not that much difference. It's better in the sense that we're not allowing them to have a catch-up, and also they can't get into the first 8. But in the end, when you kind of analyze them together, it's a discount to us relative to if that were to run through the Carlisle fund. But the other problem with the Carlisle fund is they have no benefit from it once it's core. They sell it. So the whole idea is to take advantage of this apartment market and the low cost of debt, and then basically that they can build to a higher yield over the current market. If I were to go out and buy that asset today, I'd be paying a 4 or 5 cap on that. Expensive.
My point.
But I'm going to build it to a 7.
Performance fee, right?
No, but
you're not going to get the cash, huh?
Participating in that.
Yeah, we're participating in that. In essence, we're. And so are they. They got 5% in the deal too.
Right, but I'm just saying, like, where's our cash on cash break even? Because our plan is not to sell our $150 million that's in the ground.
Yeah.
Right? So, I mean, we're generating cash on that, but we're paying as if we sold it, but we haven't sold it, right? So it pushes out our cash on cash break even.
Well, if you're talking $750,000, and in that year of stabilization, full year of stabilization, you're getting $6 million NOI, I think you covered it. You just got to get to stabilization because, again, with a development building, for example, if it's out in the suburbs, what they call like a wraps, the ones you see a lot of, the 3 above, they can start leasing those up early because they can build it, be working on some other building, and then they can lease out the ones they have. In a mid-rise, which we'll probably do some mid-rises and some not, They really can't do that. It's hard for them to have tenants in there when they're doing the construction. So, it may take another 6 months to lease it up, but basically, within that, 3 years, you're going to get that thing leased up, and that's, $750,000 versus $6 million. And that's what you're going to get, NOI each year. Unfortunately, I wish I had that because I could give you more direct numbers, but I think your payback is a lot sooner than you think. And, I'd certainly be willing to provide you that example so you could see how that would work. But unfortunately, I left it.
Well, Alan, do you got any further questions?
No, I think as far as today, my questions are answered. Kind of where I am. I don't think I fully I'd like, I kind of need a spreadsheet. I think to kind of see it.
Right.
So
yeah, I wish I had that.
I'm not necessarily in the pose, but I'm not in the yes camp right now. I just kind of tell people kind of where I am. I wouldn't mind it coming back later, but if we're voting on a up or down, I'm not on the up yet, and I don't think I'll get there today. Right? I think I might be able to get there over with more data points, but
yeah.
No. Mr. Treasurer, did you have something? Okay.
What's the better of the two deals?
I'm sorry, you're fading on us.
This one bothers me.
Okay.
Again, we talked. Let me get off. We talked a lot about fees and things. What's our share? What's their share? What? And again, this you were looking at $900 million between the two investments for real estate. And I think if we go to 5 each states, we're not going to find anybody that owns real estate. They don't know. Well, Alabama does. Very. Anyway, I don't want to keep this up too much. Again, I just don't think it's appropriate for to pass. So, thank you.
All right, well, if there's no further questions or discussions for Eric, let's read the motion.
Yes, sir. The motion would be to adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated November 20, 2014. Authorize a commitment not to exceed $150 million through the use of a fund of one structure. 3, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the creation of the fund of one structure as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014, or as a review period may be amended or superseded by the commission. And 4, authorize the chairman and or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the obligations of the South Carolina Retirement System's trust funds with respect to the investment.
Is there a motion to approve?
I move.
Second? Okay, any further discussion? If hearing none, all those in favor of the motion signify by saying aye. 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 Opposed?
I'll abstain.
All right, we have 1 abstention, and Mr. Treasurer, are you voting?
No, I vote no. Thank you.
All right, that's recorded. Okay, it is the motion is carried. All right.
1 abstention. Okay.
Can we have a 2-minute stand-up before we go on?
Go for break.
Staff is pleased to present 2 private equity funds for your consideration. Both are 2 existing managers in which RSIC was an investor in the prior fund, and now we're recommending the successor fund. This is consistent with what we've explained to you all in the past, that we seek out high-quality managers and try to invest with them over multiple fund cycles. And we believe both Crestview and Bridgepoint fit this approach. I'll be going relatively quickly through the slides, and so please feel free to ask questions at any point. So staff is recommending a $75 million commitment to Crestview Partners 3. They have a private equity buyout strategy. They target middle market U.S.-based companies that have a value bias. They define that as enterprise values up to $2 billion and equity check sizes of between $100 to $400 million. When I say value biased, they're focused on buying businesses at discounts to what they believe the true value is. When we go on later and talk about Bridgepoint, they have a slightly different strategy, which I'll discuss as well. But again, their focus is to buy right and then to improve the business while they own it, and typically with some debt pay down. So the key fund terms are: there's a 6-year investment period, a 10-year term plus 2 one-year extensions. The management fee is 1.75% on committed during the investment period, and it drops to 1.5% on investment thereafter. There's an American-style waterfall, so carry is determined on an investment-by-investment basis. They have an 8% preferred return, 20% carry, and 100% catch-up. And HEK has rated this as a buy. They have also given it a pass, as has the operational due diligence officer. So as we discussed back in June at WAMP, we have active pacing plan to reposition the portfolio over 5 to 7 years, and we believe a commitment to Crestview and to Bridgepoint are consistent with this. And as you can see, the large bucket on the first slide has us growing our exposure and buyouts to slightly over 50%. So we will be updating commissioners in February regarding our pacing, and we'll be working with HEK in this regard. So the manager background: it's a New York City-based manager raising its 3rd fund. The investment commission was an investor in Fund 2. It's a privately held partnership that was established in 2004. 4 of the 6 founding partners had worked together at Goldman Sachs, and 2 of the other partners had private equity investing experience. They came together to form Crestview. To date, they've invested more than $4 billion across 27 investments. They've also, and we'll come to this discussion, they've also made 2 investments in Fund 3, which is what we're recommending the commission invest with. So they have a history of acquiring businesses at multiples lower than the current market. We view this as an important distinguishing characteristic. They avoid paying up for businesses, especially in today's environment where leverage is very plentiful, and they have a history of buying businesses at almost 2 turns lower than what the market is. So they've built out a relatively strong team. Today there are 26 investment professionals, 8 partners. Two of the younger investment professionals have since been promoted to partner. They also have a model, a senior advisor role, or operating partner, as we say, who help with sourcing, and also who work with the portfolio companies after they've been acquired. And one of those senior advisors is the former chairman of Goldman Sachs. So here is both the June and September performance. September's on a preliminary basis. I should say that we began looking at this investment back in 2013 when they had started fundraising. Commissioner Giobbe and myself went to New York and spent the better part of a day doing an on-site. After coming back, and after there were some concerns expressed regarding the performance, they had not. We wanted to evaluate their performance, or they talked a lot. They had a lot of unrealized investments, and we wanted to see them realize some of those investments. And so we deliberately held off investing in Crestview 3 until the final close. And we'll go into this more later, but it's fair to say that their performance in 2014 has been really quite strong. They've generated significant liquidity to their existing investors, generating more than $2 billion in realizations. And if you go back to slide 3, or slide 6, they've generated over $800 million in the third quarter alone. So again, strong performance by the manager, which we were waiting to see. The other concerns we had, I think about it, we were concerned that some of the deals they led were not as performing as well as some of the deals they co-invested with other private equity funds. So we wanted to see the performance of these Crestview-led deals. And I can say the performance has really been quite strong in 2014, so that concern was largely alleviated. They have led almost all of their most recent deals and with an average equity check of 75%. As I mentioned earlier, there are 2 deals done in Fund 3. There are 3 deals that they're in the process of closing. All of them involve relatively limited use of leverage, and so that is why they've been able, in one way, to purchase the businesses at a discount. Their strategy is not to lever them up as much as they can. So this is consistent with buying right, avoiding use of excessive leverage, and staff likes this disciplined approach towards investing. So here's another graphic of their performance. They've made money in they focus on really 4 or 5 sectors, and they've made money principally in all those sectors, and some rather substantial. So the green bubbles reflect how much they actually invested for each of their verticals. They have partners that are dedicated to these industry sectors, and within there, they have additional team members that support the partner in each of these industry sectors. So we're going to look at a few performance slides. Fund 2, this is what RSIC is an investor in, and we use a methodology where we try to look at every time the manager draws down capital, and we assume, or we presume that we invest in the market simultaneously, so that we can actually look at the timing of each cash flow and look at their performance. So what you'll note here is their performance is largely consistent with the Russell 2000 and the S&P 500. This is a 2008-2009 vintage fund, so timing was very good. But as we all know, the public markets have been on a tear, and so as a consequence, their performance really did not exceed the public markets. Here's another one on a net IRR basis, and you can see something, again, relatively similar. I think internally we view the current stock market returns as reverting to norm over time, and we believe that Crestview's performance will continue to be strong. So here's just a very brief fundraising update. The manager has closed on $2.5 billion in its third fund. It has a target of $3 billion and a hard cap of $3.5 billion. Principally, they've closed on this with existing and new investors. They're also talking to one large investor who may commit as much as $400 million to the fund. The 2 deals that have been done in Fund 3 are both consistent with what the manager has said it's doing, and both were acquired at attractive prices. The manager is holding a place for the investment commission and pending approval by the commission, and we expect to participate in the final close in late January. And again, just to reemphasize, we've been looking at this manager or this fund opportunity for more than a year, and that we wanted to see realizations and get an early look into the portfolio. So this is something we will do on a regular basis going forward if we feel it's appropriate. So the investment rationale. First of all, we think their strategy has an attractive diversification benefit for our PE portfolio. They're disciplined. They seek to work with their portfolio companies, and we think it complements some of our more growth-oriented managers. Only 2 deals, they've only done 2 deals that had they sourced as limited auctions. The remainder of their deals were all sourced on a proprietary basis. They've got deep industry contacts, and they work those contacts to generate deal flow. So value creation, returns, as I said earlier, are driven by buying right. and then working with management to improve the business. One concern that I think we also had last year is they tended to buy businesses and watch them go sideways for several quarters. I think they finally figured out that sometimes something that's even at a value, that's purchased at a value multiple, may be valued there for a reason. So what we really like, there's a very large GP commitment, 6% of the capital, or $200 million. So this is it drives a strong alignment, and this is unusually large for a middle market fund of this size. So our concerns, and some of the concerns, as I addressed before, were what we were evaluating. The first one is their first fund underperformed, was not a top quartile fund. It was a 2005 vintage. It's not going to be a great fund. We expect part of what happened is they had an overweighting to financial services going into the financial crisis, and many of those businesses struggled and were challenged in the wake of the financial crisis. So that was one concern we had to get comfortable on. Obviously, we've seen the strong performance of Fund 2. They also have a provision in their LPA for leverage at the fund level. They've told us they won't use it, so we feel reasonably comfortable with that. Typically, we don't like to invest in funds that have leverage at the fund level, in part because they're levering up the portfolio companies, the individual portfolio companies. And again, as I stated earlier, Crestview had generated stronger returns on the deals it co-led versus the deals in which it was the sole lead. That concern has largely gone away, and because of the strong performance. Our final concern had to do with the age of some of the partners. 3 of the partners are in their 60s, and 3 of the partners are in their 50s. We're making a 10-year commitment, and so there were concerns about succession. I think we got comfortable with it, but if we decide to invest in the next fund, Fund 4, we're going to take a very close look at this to make sure we're comfortable. They have been promoting some of their junior folks, so we feel encouraged by that. Sure.
Some of those concerns. With the Internal Investment Committee, we discussed this investment, I think, the first time around March of this year. And there were several of these concerns that we talked about and we didn't get comfortable with at that time. And Lewis and HEK have been monitoring these. We've seen some additional realizations, so we've gotten more comfortable. We've spent more time with the manager. We've walked through the portfolio companies in more detail, even the minority positions. And it became clear to us that they are still adding a lot of value and they are sourcing these ideas themselves as opposed to being a shadow co-investor. In addition to succession planning with the partners there, that we think for Fund 3 where we're at, that we're fine, and seeing what they're doing for the staff below to pull them up to the next level. We'll see that happen in this fund as well. And then Fund 4, again, that would still be an area that we would focus on if we elected to look at Fund 4. So I did want to highlight that for the commission, that this deal was looked at about 9 or so months ago at Internal Investment Committee. We elected to hold at that point in time and continue to monitor. And then here in the fall time, we came back and have gotten comfortable making the recommendation.
Okay, just to put Fund 1 in context, they've beaten both their indices, comparable indices. While Fund 1 is clearly a disappointment, they still have outperformed the public markets. Here's another one where you can see they've outperformed. Oops. And so the recommendation is for RSIC to invest $75 million. This is a re-up from Fund 2. We did $100 million initially. We've kind of sized it to reflect our current pacing plan, and so we think $75 million is appropriate. This is a manager who's generated solid returns for its investor, and we believe the strategy it uses complements our other PE managers. With that, I'll take questions.
Any questions? Comments? If not, Mr. Hitchcock, would you read the motion, please?
Yes, Mr. Chairman.
As written. Waiving the reading.
Waiving the reading.
is that the sense then to waive the reading?
Yeah, they were posted.
Is that a motion?
Yeah, they were posted. I'm okay with that.
Is that, everybody all right with that? Well, we don't really need to vote on it? All right, well then, I guess that
We just need
makes
to vote
it
on the
simple. Then
motion.
we can just go ahead and vote?
On the motion, yes.
All right, well, all those in favor of the motion signify by saying aye. Aye. Mr. Treasurer, are you voting, sir? Mr. Treasurer?
Mr. Treasurer, are you there?
Yes, sir, I'm here.
We're voting on the motion to approve the Crestview Partners L3 LP. Everybody's voted.
I'm sorry it took any special attention. I'm with, thank you very much. It's a yes.
All right, it's unanimous.
Thank
Well, I'll go on to the second private equity recommendation. Again, this is to an existing manager. RSIC invested in the fourth fund, and we like the manager and its strategy, and we'll get into it here shortly. The manager spun out of National Westminster Bank in 2000. They had, while in the bank, had made a number of investments. Since 2000, they've raised 3 funds, and they're raising their 5th, Fund 5 now. Fund 4 is projected to be anywhere from a 2.2x to a 2.9x multiple to invested cost, which we think is very attractive. And the IRR is also very attractive. Their strategy here is to pay full price for companies, but they have a very active investment plan for growing the earnings and generating value. So we like that strategy, and we think it's complementary to our portfolio. They're also doing it in Europe, which as we all know, has struggled from a growth perspective. So just the investment overview, we're recommending 75 million euros to Bridgepoint Europe 5. Again, private equity growth strategy, looking for businesses, smaller businesses, enterprise value from 150 million euros to 650 million euros. The fund is targeting $3.5 billion with a $4 billion hard cap. They have already closed on $2 billion, and they have demand of $6 billion. So this is a highly sought-after manager. Key fund terms are a 5-year investment period, 10-year term, 1.5% on committed management fee, and a 1% on invested thereafter. They have a European waterfall, which means they have to return all of investors' capital before they can begin to share in the carry. And they have an 8% preferred return with a 20% carry and 100% catch-up. HEK also rates this as a buy and has given it a pass, as has RSIC on the operational side. So as we said before, this is consistent with the pacing plan we presented to the Commission back in June. We intend to grow the buyout. We find their strategy here will help us do that. So just general background around the manager. It's a European private equity buyout fund raising its 5th fund. RSIC invested in the 4th fund at 50 million euros. It's privately held, 100% employee owned, and they have been that way since 2000. Over the last 14 years, they've invested more than 10 billion euros across 132 investments. So we have plenty of performance to evaluate and to judge. They have a very large team with over 70 investment professionals, and they have offices, individual offices throughout most of the major cities in Europe, including London, Frankfurt, Paris, Madrid, Istanbul, Luxembourg, Stockholm, and Warsaw. They also have an office in Shanghai. This is a recent initiative. They're not necessarily investing in Shanghai, but they use, from a procurement perspective, view this as a resource for their portfolio companies who might be looking for either products or other things that come out of China. So here's their track record since 2000. What you can see is that the earnings growth is the principal driver of value. They do typically get a bump up in valuation multiple, but there's fairly limited amount of deleveraging that's going on. They are focused on growing the businesses and generating good returns therefrom. So if you see the performance at the bottom here, they've generated some strong performance. RSIC is an investor in the fourth fund, and it's generated to date as of 6/30 a 1.4x multiple to cost and a mid-teens IRR. We expect it, again, at the end of the day, to generate a 2x plus net IRR from this fund. They've had recently two major realizations that have increased the distribution to paid-in ratio from 0.57 to 0.47 to 0.57. So we view that, again, a strong performing fund, and we see it continuing on into Fund 5. So here's just looking at their sectors. They've made money in all their main sectors that they focus on. They've invested considerable sum in all of them. So the investment rationale. This provides RSIC with some European exposure at the smaller end of the middle market. We like that. It's focus on growth in an economy that is otherwise slow growth is something we like to see. Their sourcing abilities, they have local professionals who speak the language on the ground in all these countries, and they're developing relationships with business owners and entrepreneurs. So it's a very kind of hands-on approach. And the value creation, we like to see earnings growth because we believe that is a good driver of value. And the GP commitment here is 100 million euros, which is 2.5%, which is still substantial. They have the European waterfall, as mentioned before, and they have 100% fee offset. So I think this speaks a great deal as to how the portfolio has performed relative to European markets. As you can see, there's been strong earnings growth, 10% plus over the last 4 years. So here again, it's consistent with what we're looking for. Meanwhile, Europe earnings growth has been somewhat disappointing. Performance. So again, we're dealing with a similar time period as Crestview. You have some very strong public market performance. Still, they've managed to beat the public markets, but it's been a challenge for many private equity firms to generate returns comparable to the public markets. Here's another thing that basically, on a net TVPI basis, reflects their performance relative to European benchmarks. Here you can see the value creation over time. It's been fairly consistent and has exceeded the performance of the MSCI Europe. Steady value creation is how we would characterize it. This is their quartile ranking. They are ranked as a top quartile, and they have been ranked top quartile for several quarters, so we feel very good about that. So, investment considerations. We spent a great deal of time on this. They have a very kind of entrepreneurial culture. They have offices scattered throughout Europe. They have had, though, more turnover than we would otherwise like to see. Again, 70 investment professionals. They've had 35 departures since 2008, which appears to be a high number. 9 of them were at the partner level. Several of the departures were retirements. And then in many instances, as you'll see, they have a meritocracy sort of culture. So if you don't perform, you're not likely to hang around there. The next concern was Fund 3 performance. Their Fund 3 underperformed. They put a great deal of the money to work at the top of the market, and as a consequence, a number of the companies struggled coming out of the recession. They also had an office in Italy, in Milan, but their the performance of their Italian investments have been pretty abysmal, and so they've made a very conscious decision to not invest in companies that are based in Italy. They will invest in companies that have operations or activities in Italy. It's just if the business is headquartered there. They also shut the Milan office, and some of the departures, I think 5 or 6 of the departures that I mentioned earlier, were related to this. The final concern we had was the loss ratio. Historically, they have had more write-offs than we'd like to see for a buyout manager. That said, Fund 4 has had very limited amount of losses, and we expect that to continue into Fund 5. Let's see. It's also worth noting, and we'll mention this, of the partners, of the 21 partners, they have an average tenure at Bridgepoint of 17 years. So we believe that's a further indication why this isn't, the employee turnover is less of a concern. We also went so far as to look at the performance of the of the stayers, the joiners, and the leavers. And what we found here, I think, confirmed our concern about the turnover, that the leavers' performance was suboptimum relative to the joiners and the stayers. So we got comfortable with this investment based on that. In part on this analysis, HEK was very helpful in that regard. So the other concern I mentioned is that they had invested a great deal of the fund kind of at the market top, and in Fund 4 they approached it in a much more balanced approach, investing fairly consistently over the life of the investment period. So we feel Fund 4 is and they learned their lesson during Fund 3. So just a few other comparables. Again, net TVPI relative to the public markets, they've easily, Fund 3, which again is the underperforming fund, still outperformed their European benchmarks rather substantially. And here again, you can see for Fund 3, negative returns for Europe, at least the MSCI, and fairly low return for the FTSE 100. So we also looked at Fund 3 and wanted to get a better sense of what the ultimate outcome of Fund 3 will. As I said, we're expecting a 2x net multiple of invested capital on Fund 4. Fund 3 will, I think, overall at the end of the day, have a high single-digit IRR and a gross MOIC of anywhere from 1.6 to 1.8. So again, not something we'd like to see certainly going forward, but nevertheless, they have recovered the fund fairly nicely. So the recommendation, staff is recommending a 75 million euro commitment. As I stated earlier, this is a re-up from Fund 4 where we committed 50 million. This is an oversubscribed manager. They have more demand than supply. They value the relationship with RSIC, and so we view this as a high conviction manager, and we're recommending a meaningful step up in our overall commitment to them. We would expect to maintain 75 million euros going forward in subsequent funds as well. So we believe this is an existing manager that provides us with attractive European exposure, which complements our overall program. This is a manager who is buying high-quality businesses that are cash generative, growing them organically, and then making add-on acquisitions at accretive multiples. With that, I'll take questions if there are any.
Does anyone have any questions for Louis? Comments?
I move adoption of the Bridgepoint motion.
All right.
Second.
All right, we will then vote on the Bridgeport Europe 5 motion as it is written.
Mr. Williams made the motion.
Yeah, and a second. So all those in favor of the motion signify by saying aye. 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 Mr. Treasurer, are you voting? Mr. Treasurer?
Mr. Treasurer, are you there?
How do we count them? Yes. All right, if we need you, we'll call you. Are you yea or nay on Bridgeport?
Staying on this one.
Staying?
Hello?
You're breaking up. I'm afraid we can't hear you.
Did I hear abstain?
Did he say abstain?
Can you hear me? I'm abstaining.
Yes, sir.
All right,
I
okay,
got you.
yes. All
Yes,
right.
sir.
Can you hear us?
All right. All right, well, anyway, the motion's carried. All right. And-
5-0, one abstention.
Yeah.
Okay.
All right, then the next item is,
Integrity.
Mr.
Marino.
Yes, sir, Mr. Chairman.
Herschel, will you carry on with integrity?
Steve Marino's here. There you go. We'll present Integrity. It's an existing manager up for contract renewal, but instead of just a pure contract renewal approval, thought we'd give Steve the opportunity to present Integrity to the commission.
Good afternoon. Thank you for your time. Today I'll make the recommendation to renew the small cap value investment management agreement with Integrity Asset Management. For a little background, Integrity was hired in February of 2005 by the Commission. It was again renewed in February of 2010. Over that time period, this strategy has delivered approximately 300 basis points on average of gross excess returns relative to the Russell 2000 Value Index. The strategy is currently closed and HEK maintains a hold rating on it. Today I'll provide a brief overview of the strategy, an update on the firm, present the strategy's performance, and make a formal recommendation to renew. Integrity is a fundamental small cap value equity manager. They have a seasoned team of sector-focused analysts with an average of 18 years of industry experience, focused on buying the right company at the right price and at the right time. This philosophy shapes their process of identifying companies with attractive valuations, with strong management teams, and identifiable catalysts. Since the Commission last renewed the contract in 2010, the investment process has remained unchanged. They've retained their boutique-like structure and their cohesive investment staff. The strategy has generated approximately 400 basis points in excess returns over the 5-year period, but 300 basis points over the life of the investment. In addition, the strategy continues to provide the flexibility for staff to implement our structural allocation to small cap asset class, which we believe to be less efficient than the large cap space. And lastly, the strategy is closed and not accepting new money, but Brian Moore was able to negotiate a 1 basis point fee reduction on a blended basis, which equates to about $25,000 a year in annual savings. Before I move on, there are 2 updates we'd like to identify, just mainly because of the proximity to the contract renewal. The first, is, as you were made aware of previous commission meeting, was that Munder Capital Management, the parent of Integrity, was acquired by Victory Asset Management. The transaction closed on last October 2014. And staff and HEK reviewed this transaction, are comfortable with the transition. And as part of it, Integrity employees will receive additional equity ownership in the business, as well as retaining their boutique-like structure. As always, we'll continue to monitor this, but at this time don't believe it to be detrimental to the process or the performance. The second item involves a minor technical compliance issue that occurred in the 3rd quarter of 2014. This is documented in greater detail in a memo from Andrew Chernick. In summary, Integrity held an underweight position to the financial services sector. The underweight allowable by the guidelines is plus or minus 10% the sector weight of the value, Russell 2000 value, and they violated this by 5 basis points. The violation in this case was not from a pooling of risk, but rather de-risking the portfolio. Integrity exited 2 positions within the financial services industry, one of which benefited tremendously from the resignation of Bill Gross, while the other underperformed significantly. At the same time, they received dividend inflows, which ultimately increased the portfolio cash balance, and the resulting effect of that was the financial services sector became underweight, less than 10% of the allowed guidelines. The portfolio was subsequently corrected within the 45-day period, as stated in the SIOP, and that happened in parallel to a $50 million rebalancing redemption for normal rebalancing purposes. We're comfortable with their processes and procedures that are in place, but again, wanted to highlight this mainly due to the proximity to the renewal and recent transaction. So moving on to performance portfolio statistics. The chart at the top of the page illustrates the rolling 36-month excess returns. The area highlighted in red is the time that they have been managing money for South Carolina. On average, the strategy has generated excess returns, gross of fees, of 300 basis points. In addition, the table below, you can see the 1, 3, and 5-year time periods has recently returned 480 basis points in the 1 year, but 420 basis points on the 5-year average, with an information ratio of 1.5, which highlights their consistency of excess return generation. And in closing, for a shorter presentation today, we're recommending the Commission renew the small cap value investment management agreement with Integrity Asset Management. It expires February 2nd of 2015. These assets will remain in a separately managed account held in the custody at Bank of New York Mellon. We're asking for the additional term of 5 years at the updated fee schedule, which is provided in the memo. And in addition, staff would like to notify the Commission that during the renewal process, we may make minor guideline changes to enhance internal reporting of our external managers. And at this point, I'll pause and take any questions that you may have.
Steve, just one question. The performance numbers that you had on that prior, now the 1 year, okay, that's as of 9/30.
Yep.
Do you have any? Do you have what they've done year to date? Calendar year to date?
Year to date, so when the market kind of sold off throughout October, they
pretty much pulled back.
Yeah, they underperformed, or
caps.
they outperformed on the way down and then underperformed on the way up, which is what you'd expect from the value manager there. But I don't have an updated number. I can get that for you in 5 minutes after this, if you'd like.
Any other questions, discussion for Steve? None? All right, then, Mr. Hitchcock, would you read the motion, please?
Yes, sir. Adopt the recommendation in regard to Integrity Asset Management, adopt the recommendation of the CIO and the Internal Investment Committee as set forth in a memo dated October 31st, 2014 regarding Integrity Asset Management. Authorize a renewal of the Commission's existing contract with Integrity Asset Management for another term of up to 5 years. 3, authorize the chairman or its designee to negotiate and execute any necessary documents to implement the renewal of the investment as approved by the Commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the Commission on May 1st, 2014, or as the review period may be amended or superseded by the Commission.
All right, may I have a motion to approve that motion? Second.
Second.
We have a second. Any discussion? Hearing none. All those in favor signify by saying aye.
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 Mr. Treasurer.
Mr. Treasurer?
Aye.
All right. All right, it's unanimous. All right, very good. Yeah.
Okay.
All right. May I have a motion to, as it's written here, to go into executive session?
So moved.
Second?
Second.
All in
If
favor?
there's no discussion, we will now enter into executive session. All right, we are now back in open session, and we have several motions, as I...
Yes, sir. The first motion, Loomis, okay.
Yes, sir.
First motion would be adopt the recommendation of the CIO and the Internal Investment Committee as presented with regards to the Loomis Sales Multi-Sector Full Discretion Trust to 1, authorize the restructuring of Loomis from a commingled structure to a separately managed account structure. 2, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the decision approved by the Commission upon documented approval for legal sufficiency by RSIC Legal, and upon expiration of 3 business day review period as approved by the Commission on May 1st, 2014, or as otherwise amended or superseded by the Commission. And 3, authorize the chairman and/or the CIO or the designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the South Carolina Retirement System Trust Fund's obligations with respect to the investment.
You got all that right. Sold.
All right, is there a motion to approve in a second? All right, no further discussion, I understand. Hearing none, all those in favor of the motion signify by saying aye.
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 Right, 4?
Who says aye?
All right, it is passed unanimously. If
right.
there is no further business to come before the...
whoa,
Wait a minute, I beg your pardon, there is one more motion.
All right.
Yes.
Authorize the staff to make any technical revisions to the Commission's governance policies, the SIOP, AIP, and other documents consistent with the organizational chart presented by the Executive Director.
So moved.
Second?
Second.
Any discussion? Hearing none, all those in favor signify by saying aye.
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 Treasurer says aye.
All right, is unanimous.
Fine.
All right, any?
Motion to adjourn.
All right, fine. Second. All in favor? Aye. We are adjourned.
Very good.